text base, so they're going to read the text code on a live stream.
It's fun.
All the text stuff to highlight how think you're in compliance with all of that stuff is it's too complicated. 70,000 feet
Say again?
a political angle.
We're good. We are live.
No angle.
All right, ladies and gentlemen, we are good to go. All right, we are on about a 15-second delay. Absolutely. We are on a 15-second delay. Brandon, go ahead and sit down. Thank you guys all for being ridiculously patient. And we've now figured out all the technical difficulties, and we will begin the most boring 12 hours of our entire lives.
Test audio?
Tax imposed. Okay, it's dark here. You may want to turn on a light from that one.
It's going to make no difference relative.
Really? Oh, okay. So,
It's just, I mean, it's because it's
do we want to just bring the canopy back a little bit to make it a little lighter?
to make the sunshine on it. Yeah. I mean,
Okay.
If you guys are okay with that, I mean, I don't think we really need this. So we could just
Yeah.
we could bring that back up far enough that you can see.
Yeah.
Then you can see the sun.
Exactly. All right.
Good hand?
Oh, good. Oh, that's
Better?
bright. Yeah, it's bright. That's good. Is that good on camera?
I just want to read.
It's going to look shadowy for everything else because it's like shadow from his waves. You know what I mean? Like look at the thing, like everything's dark. So it kind of makes sense to just take the canopy like completely away.
Okay. So just move it over that way?
You have to break it down. I'm going to block the sidewalk.
Yeah. If I knew the shadow would be out. So I guess
Watch out for that leg over there. All right. Pretty good then. Does that work for it?
there's still shadow on him from this. So
Okay.
maybe more this way.
Where are we going? All right, I just want to get down. Or just break it down.
Okay.
Can we do that with it over?
I'll be right back.
Yeah, help us out here, Brandon. Jeff left at the most frequency zone. Alright. We're popping these, right, to bring it down? Oh, yeah.
Be careful if this is a snatch on.
Great. Well, we'll just need this one. That's bad. Take it out. Alright. All right, sit down, Brandon.
All right, you start.
Bring the board.
Yeah.
Bring the books in. A little more. There we go. There it is.
Bless you. I'll read this to you instead. Tax imposed. A. Married individuals filing joint returns and surviving spouses. There is hereby imposed on the taxable income of 1. Every married individual, as defined in Section 7703, who makes a single return jointly with his spouse under Section 6013. And 2. Every surviving spouse, as defined in Section 2A, a tax determined in accordance with the following table. If taxable income is not over $36,900, the tax is 15% of taxable income. If taxable income is over $36,900, but not over $89,150, the tax is $5,535 plus 28% of the excess over $36,900. If taxable income over $89,150, but not over $140,000, the tax is $20,165 plus 31% of the excess over $89,000 and $150 as well. If taxable income is over $140,000, but not over $250,000, the tax is $35,000.50 plus 36% of the excess over $140,000. If the taxable income is over $250,000, the tax is $75,528.50 plus 39.6 of the excess over $250,000. B. Heads of households. There is hereby imposed on the taxable income of every head of a household, as defined in Section 2B, a tax determined in accordance with the following table. If taxable income is not over $29,600, the tax is 15% of taxable income. If taxable income is over $29,600, but not over $76,400, the tax is $4,440 plus 28% of the excess over $29,600. If taxable income over $76,400, but not over $127,500, the tax is $17,544 plus 31% of the excess over $76,400. If taxable income is over $127,500, but not over $250,000, the tax is $33,385 plus 36% of the excess over $127,000. If taxable income is over $250,000, the tax is $77,485 plus 39.6 of the excess over $250,000. C. Unmarried individuals, other than the surviving spouses and heads of households. There is hereby imposed on the taxable income of every individual other than a surviving spouse as defined in Section 2A or the head of household as defined in Section 2B who is not married an individual as defined in Section 7703, a tax determined in accordance with the following table. If taxable income is not over $22,100, the tax tax is 15% of taxable income. If taxable income is over $22,100, but not over $53,500, the tax is $3,315 plus 28% of the excess over $22,100. If taxable income is over $53,500, but not over $115,000, the tax is $12,107 plus 31% of the excess over $53,500. If taxable income is over $115,000 but not over $250,000, the tax is $31,172 plus 36% of the excess over $115,000. If taxable income is over $250,000, the tax is $79,772 plus 39.6% of the excess over $250,000. D. Married individuals filing separate returns. There is hereby imposed on the taxable income of every married individual, as defined in Section 7703, who does not make a single return jointly with his spouse under Section 6013, a tax determined in accordance with the following table. If taxable income is not over $18,450, the tax is 15% of taxable income. If taxable income is over $18,450, but not over $44,575, the tax is $2,767.50 plus 28% of the excess over $18,450. If taxable income is over $44,575, but not over $70,000, the tax is $10,082.50 plus 31% of the excess over $44,575. If the taxable income is over $70,000 but not over $125,000, the tax is $17,964.25 plus 36% of the excess over $70,000. If the taxable income is over $125,000, the tax is $37,764.25 plus 39.6% of the excess over $125,000. E. Estates and trusts. There is hereby imposed on the taxable income of 1. Every estate, and 2. Every trust. This subsection a tax determined in accordance with the following table. If taxable income is not over $1,500, the tax is 15% of taxable income. If taxable income is over $1,500 but not over $3,500, the tax is $225 plus 28% of the excess over $1,500. If taxable income is over $3,500 but not over $5,500, the tax is $785 plus 31% of the excess over $3,500. If the taxable income is over $5,500 but not over $7,500, the tax is $1,405 plus 36% of the excess over $5,500. And if the taxable income is over $7,500, the tax is $2,125 plus 39.6% of the excess over $7,500. Phase out of marriage penalty in 15% bracket adjustments in tax tables so that inflation will not result in tax increases. 1. In general, no later than December the 15th of 1993 and each subsequent calendar year, the Secretary shall prescribe tables which shall apply in lieu of the tables contained in the subsections A, B, C, D, and E, with respect to taxable years beginning in the succeeding calendar year. 2. Method of prescribing tables. The table which under paragraph 1 is to apply in lieu of the table contained in subsection A, B, C, D, or E, as the case may be, with respect to taxable years beginning in any calendar year, shall be prescribed. A. Except as provided in paragraph 8, by increasing the minimum and maximum dollars for each rate bracket for which a tax is imposed under such table by the cost of living adjustment for such calendar year. B. By not changing the rate applicable to any rate bracket as adjusted under subparagraph A, and C. By adjusting the amount set forth the tax to the extent necessary to reflect the adjustments in the rate brackets. 3. Cost of living adjustment. For purposes of paragraph 2, and cost of living adjustment for any calendar year is the percentage, if any, by which A. The CPI for the preceding calendar year exceeds B. The CPI for the calendar year of 1992. 4. CPI for any calendar year. For purposes of paragraph 3, the CPI for any calendar year is the average of the Consumer Price Index as the close of the 12-month period ending on August 31st of such calendar year. 5. Consumer Price Index. For purposes of paragraph 4, the term Consumer Price Index means the last Consumer Price Index for all urban consumers published by the Department of Labor. For purposes of the preceding sentence, the revision of the Consumer Price Index, which is most consistent with the Consumer Price Index for calendar year 1986, shall be used. 6. Rounding. A. In general. If any increase determined under paragraph 2A, section 63, C4, section 68, B2, or section 151, D4, is not a multiple of $50, such increase shall be rounded to the lowest multiple of $50. B. Table for married individuals filing separately. In case of a married individual filing a separate return, subparagraph A, other than with respect to section 63C4 and 151D4A, shall be applied by substituting $25 for $50 each place it appears. 7. A special rule for certain brackets. A. Calendar year 1994. In prescribing the tables under paragraph 1, which apply with respect to taxable years beginning in calendar year 1994, the Secretary shall make no adjustment to the dollar amounts at which the 36% rate bracket begins or at which the 39.6% rate begins under any table contained in subsection A, B, C, D, or E. B. Later calendar year. In prescribing tables under paragraph 1, which apply with respect to taxable years beginning in a calendar year after 1994, the cost of living adjustments used in making adjustments to the dollar amounts referred to in subparagraph A shall be determined under paragraph 3 by substituting 1993 for 1992. 8. The elimination of marriage penalty in 15% bracket. With respect to taxable years beginning after December the 31st, 2003, in prescribing the tables under paragraph 1, A. The maximum table income in a 15% rate bracket in the table contained in subsection A and the minimum taxable income in the higher taxable income bracket in such table shall be 200% of the maximum taxable income in the 15% rate bracket in the table contained in subsection C after any other adjustment under this subsection, and B. The comparable taxable income amounts in the table contained in subsection D shall be half the amounts determined in subparagraph A. G. Under certain income of children taxed as if parents' income. 1. In general, in the case of a child to whom this subsection applies, the tax imposed by this section shall be equal to the greater of A. the tax imposed by a section without regard to this subsection, or B, the sum of I, the tax which should be imposed by this section if the table income of such child for the taxable year were reduced to the net unearned income of such child plus 2, such child's share of the allocable parental tax. 2, child to whom subsection applies. This subsection shall apply to any child for any taxable year if A, such child, I, has not attained age 18 before the close of the taxable year, or double I, has attained age 18 before the close of the taxable year and meets the age requirements of section 152C3 determined without regard to subparagraph B thereof, and whose earned income as defined in section 911D2 for such taxable year does not exceed 1/2 of the amount of the individual support within the meaning of section 152C1D after the application of section 152F5 without regard to subparagraph A thereof for such taxable year. B, either parent of such child is alive at the close of the taxable year, and C, such child does not file a joint return for the taxable year. 3, allocable parental tax. For purposes of this subsection, A, in general, the term allocable parental tax means the excess of the tax which would be imposed by this section on the parent's taxable income if such income included the net unearned income of all children of the parent to whom this subsection applies over the tax imposed by this section on the parent without regard to this subsection. For purposes of Clause 1, net unearned income of all children of the parent shall not be taken into account in computing any exclusion, deduction, or credit of the parent. B, the child share. The child share of any allocable parental tax of a parent shall be equal to an amount which bears the same ratio to the total allocable parental tax as the child's net unearned income bears to the aggregate net unearned income of all children of such parent to whom this subsection applies. C, special rule where parent has different taxable year. Except as provided in regulations, if the parent does not have the same taxable year as a child, the allocable parental tax shall be determined on the basis of the taxable year of the parent ending in the child's taxable year. 4, net unearned income. For purposes of this subsection, A, in general, the term net unearned income means the excess of 1, the portion of the adjusted gross income for the taxable year which is not attributable to earned income as defined in section 911D2 over 2, the sum of 1, an amount in effect for the taxable year under section 63C5A relating to limitation on standard deduction in the case of certain dependents, plus 2, the greater of the amount described in subclause 1, or if the child itemizes his deductions for the taxable year, the amount of the itemized deductions allowed by this chapter for the taxable year which are directly connected to the production of the portion of adjusted gross income referred to in clause 1. Pause. B, limitation based on taxable income. The amount of the net unearned income for any taxable year shall not exceed the individual's taxable income for such taxable year. C, treatment of distributions from qualified disability trusts. For purposes of this subsection, in the case of any child who is a beneficiary of a qualified disability trust as defined in section 642B2C2, any amount included in the income of such child under section 652 and 662 during a taxable year shall be considered earned income of such child for such taxable year. 5, special rules for determining parent to whom subsection applies. For purposes of this subsection, the parent whose taxable income shall be taken into account shall be A, in the case of parents who are not married within the meaning of section 7703, the custodial parent within the meaning of section 152E of the child, and B, In the case of married individuals filing separately, the individual with the greater taxable income. Providing of parents' TIN. The parent of any child to whom this subsection applies for any taxable year shall provide the TIN of such parent to such child, and such child shall include such TIN on the child's return of tax imposed by this section for such taxable year. 7. Election to claim certain unearned income of child on parent's return. A. In general, if 1. Any child to whom this subsection applies has gross income for a taxable year only from interest and dividends, including Alaska Permanent Fund dividends. 2. Such gross income is more than the amount described in paragraph 4A21 and less than 10 times the amount so described. No estimated tax payments for such year are made in the name and TIN of such child, and no amount has been deducted and withheld under section 3406 and 4. The parent of such child, as determined under paragraph 5, elects the application of subparagraph B. Such child shall be treated, other than for purposes of this paragraph, as having no gross income for such year and shall not be required to file a return under section 6012. B. Income included on parent's return. In the case of a parent making the election under this paragraph, 1. The gross income of each child to whom such election applies, to the extent the gross income of such child exceeds twice the amount described in paragraph 4A21, shall be included in such parent's gross income for the taxable year. 2. The tax imposed by this section for such year with respect to such parent shall be amount equal to the sum of 1. The amount determined under the section after the application of clause 1, plus 2. For each such child, 10% of the lesser of the amount described in paragraph 4A21, or the excess of the gross income of such child over the amount so described, and 3. Any interest which is an item of tax preference under section 57A5 of the child shall be treated as an item of tax preference of such parent, and not of such child. C. Regulations. The Secretary shall prescribe such regulations as may be necessary to appropriate to carry out the purposes of this paragraph. 8. Maximum capital gains rate. 1. In general, if a taxpayer has a net capital gain for any taxable year, the tax imposed by this section for such taxable year shall not exceed the sum of A. A tax computed at the rates in the same manner as if this subsection had not been enacted on the greater of 1. Taxable income reduced by the net capital gain, or 2. The lesser of 1. The amount of taxable income taxed at a rate below 25%, or 2. Taxable income reduced by the adjusted net capital gain. B. 5% or 0% in the case of taxable years beginning after 2007 of so much of the adjusted net capital gain, or if less taxable income, as does not exceed the excess, if any, of 1. The amount of taxable income which would, without regard to this paragraph, be taxed at the rate below 25%, over 2. The taxable income reduced by the adjusted net capital gain. C. 15% of the adjusted net capital gain, or if less taxable income, in excess of the amount on which tax is determined under subparagraph B. D. 25% of the excess, if any, of 1. The unrecaptured section of 1250 gain, or if less, the net capital gain determined without regard to paragraph 11, over 2. The excess, if any, of 1. The sum of the amount on which tax is determined under subparagraph A, plus the net capital gain over 2. Taxable income. And E. 28% of the amount of taxable income in excess of the sum in the amounts on which tax is determined under the preceding subparagraphs of this paragraph. 2. Net capital gain taken into account as investment income. For purposes of this subsection, the net capital gain for any taxable year shall be reduced, but not below 0, by the amount which the taxpayer takes into account as investment income under section 163 D4B3. 3. Adjusted net capital gain. For purposes of this subsection, the term adjusted net capital gain means the sum of A. Net capital gain determined without regard to paragraph 11, reduced, but not below zero, by the sum of 1. Recaptured section 1250 gain, and 2. 28% rate gain, plus B. Qualified dividend income as defined in paragraph 11. 4. 28% rate gain. For purposes of this subsection, the term 28% rate gain means the excess, if any, of A, the sum of 1, collectibles gain, and 2, section 1202 gain over B, the sum of 1, collectibles loss, 2, net short-term capital loss, and 3, the amount of long-term capital loss carried under section 1212 B1B to the taxable year. 5. Collectibles gain and loss. For purposes of this subsection, A, in general, the terms collectibles gain and collectibles loss means gain or loss, respectively, from the sale or exchange of a collectible, as defined in section 408M, without regard to paragraph 3 thereof, which is a capital asset held for more than 1 year, but only to the extent such gain is taken into account in computing gross income, and such loss is taken into account in computing taxable income. B. Partnerships and etc. For purposes of subparagraph A, any gain from the sale of an interest in a partnership, S corporation, or trust, which is attributable to unrealized appreciation in the value of collectibles, shall be treated as gain from the sale or exchange of the collectible. Rules similar to the rules of section 751 shall apply for purposes of the preceding sentence. 6. Unrecaptured section 1250 gain. For purposes of this subsection, in general, the term unrecaptured section 1250 gain means the excess, if any, of 1. The amount of long-term capital gain not otherwise treated as ordinary income, which would be treated as ordinary income if section 1250B1 included all depreciation and the applicable percentage under section 1250A were 100% over 2. The excess, if any, of 1. The amount described in paragraph 4B over 2. The amount described in paragraph 4A. B. Limitation with respect to section 1231 property. The amount described in subparagraph A1 from sales, exchanges, and conversions described in section 1231A3A for a taxable year shall not exceed the net section 1231 gain as defined in section 1231C3 for such year. 7. Section 1202 gain. For purposes of this subsection, the term section 1202 gain means the excess of A, the gain which would be excluded from gross income under section 1202 before the percentage limitation in section 1202A over B, the gain excluded from gross income under section 1202. 8. Coordination with recapture of net ordinary losses under section 1231. If any amount is treated as ordinary income under section 1231C, such amount shall be allocated among the separate categories of net section 1231 gain as defined in section 1231C3 in such manner as the Secretary may by forms or regulations prescribe. Regulations. The Secretary may prescribe such regulations that are appropriate, including regulations requiring reporting, to apply this subsection in the case of sales and exchanges by pass-through entities and of interest in such entities. Pass-through entity defined. For many purposes of this subsection, the term pass-through entity means A, a regulated investment company, B, a real estate investment trust, C, an S corporation, D, a partnership, E, an estate or trust, F, a common trust fund, and G, a qualified electing fund as defined in section 1295. 11. Dividends taxed as net capital gain. A, in general, for purposes of this subsection, the term net capital gain means net capital gain determined without regarding to this paragraph. It's riveting.
Riveting? Exciting?
I'm having a ball. I mean, everyone is. Even
All right.
they are.
Keep it going. They want to know what happens next.
Can't wait to tell you. Where were we? Qualified dividend income. For purposes of this paragraph, 1, in general, the term qualified dividend income means dividends received during the taxable year from 1, domestic corporations, and 2, qualified foreign corporations. 2, certain dividends excluded. Such terms shall not include 1, any dividend from a corporation for which the taxable year of the corporation in which the distribution is made or the preceding taxable year is a corporation exempt from a tax under Section 501 or 521. 2, any amount allowed as a deduction under Section 591 relating to the deduction for dividends paid by mutual savings banks, etc. And 3, any dividend described in Section 404K. 3, coordination with Section 246C. Such terms shall not include any dividend on any share of stock, 1, with respect to which the holding period requires of Section 246C are not met, determined by substituting in Section 246C 60 days for 45 days each place it appears, and by substituting 121-day period for 91-day period, or 2, to the extent that the taxpayer is under an obligation, whether pursuant to a short sale or otherwise, to make related payments with respect to positions in substantially similar or related property. Qualified foreign corporations. 1, in general, except as otherwise provided in this paragraph, the term qualified foreign corporation means any foreign corporation if 1, such corporation is incorporated or in possession of the United States, or 2, such corporation is eligible for benefits of a comprehensive income tax treaty with the United States, which the Secretary determines is satisfactory for purposes of this paragraph and which includes an exchange of information program. 2, dividends on stock readily tradable on United States securities market. A foreign corporation not otherwise treated as a qualified foreign corporation under Clause 1 shall be so treated with respect to any dividend paid by such corporation if the stock with respect to such dividend is paid readily tradable on an established securities market in the United States. 3, exclusion of dividends of certain foreign corporations. Such term shall not include any foreign corporation which for the taxable year of the corporation in which the dividend was paid or the preceding taxable year is a passive foreign investment company as defined in Section 1297. 4, coordination with foreign tax credit limitation. Rules similar to the rules of Section 904B2B shall apply with respect to the dividend rate differential under this paragraph. D, special rules. 1, amounts taken into account as investment income. Qualified dividend income shall not include any amount which the taxpayer takes into account as investment income under Section 163D4B. 2, extraordinary dividends. If a taxpayer to whom this section applies receives, with respect to any share of stock, qualified dividend income from one or more dividends that are extraordinary dividends within the meaning of Section 1059C, any loss on the sale or exchange of such shares shall, to the extent of such dividends, be treated as a long-term capital loss. 3, treatment of dividends from regulated investment companies and real estate investment trusts. A dividend received from a regulated investment company or real estate investment trust shall be subject to the limitations prescribed in Sections 854 and 857. 1, rate reductions after 2000. 1, 10% rate bracket. A, in general, in the case of taxable years beginning after December the 31st, 2000, 1, the rate of tax under subsections A, B, C, and D on taxable income not over the initial bracket shall be 10%, and 2, the 15% rate of tax shall apply only to taxable income over the initial bracket amount, but not over the maximum dollar amount for the 15% rate bracket. B, initial bracket amount. For purposes of this paragraph, the initial bracket amount is 1, $14,000 in the case of subsection A, 2, $10,000 in the case of subsection B, and 3, half the amount applicable under clause 1 after adjustment if under subparagraph C in the case of subsection C and D. C, inflation adjustment. In prescribing the tables under subsection F, which apply to with respect to taxable years beginning in calendar years after 2003, 1, the cost of living adjustment shall be determined under subsection F3 by substituting 2002 for 1992 in subparagraph B thereof, and 2, the adjustments under clause 1 shall not apply to the amount referred to in subparagraph B3. If any other amount after adjustment under the preceding sentence is not multiple of 50, such amount shall be rounded to the next lowest multiple of 50. 2. Reductions in rates after June 30th, 2001. In the case of taxable years beginning in a calendar year after 2000, the corresponding percentage specified for such calendar year in the following table shall be substituted for the otherwise applicable tax rate in the tables under subsections A, B, C, D, and E. In the case of taxable years beginning during calendar year, the corresponding percentages shall be substituted for the following percentages. 2001, 28% is 27.5%, 31% is 30.5%, 36% is 35.5%, 39.6% is 39.1%. In 2002, 28% is 27%, 31% is 30%, 36% is 35%, 39.6% is 38.6%, and 2003 and thereafter, 28%, 25%, 31% is 28%, 36%, 33%, 39.6%, 35%. 3. Adjustment of tables. The Secretary shall adjust the tables prescribed under subsection F to carry out this subsection. Termination of amendments. For termination of amendment by publication 108-311, you know what? That part's boring. Let's just go to this part. There we go. Instructions for the Form 1040 series provide tables showing the amount of earned income credit for each type of taxpayer. 2. Excessive investment income. For taxable years beginning in 2010, the earned income tax credit is not allowed under Section 32(1) if the aggregate amount of certain investment income exceeds $3,100. 7. Rehabilitation expenditures treated as separate new property. For the calendar year 2010, the per low-income unit qualified basis amount under Section 42E3A22 is $6,000. 8. Low-income housing credit. For calendar year 2010, the amount used under Section 42H3C2 to calculate the state housing credit ceiling for the low-income housing credit is the greater of 1. $2.10 multiplied by the state population, or 2. $2,430,000. 9. Alternative minimum tax exemption for a child subject to the kiddie tax. For taxable years beginning in 2010, for a child of whom is the kiddie tax applies, the exemption under Section 55 and 59J for purposes of the alternative minimum tax under Section 55 may not exceed the sum of 1, the child's earned income for the taxable year, plus 2, $6,700. 10. Transportation mainline pipeline construction industry optional expense substantiation rules for payments to employees under accountable plans. For calendar year 2010, an eligible employer may pay certain welders and heavy equipment mechanics an amount up to $16 per hour for rig-related expenses that is deemed substantiated under an accountable plan if paid in accordance with Rev Procedure 2002-41, 2002-1 CB 1098. If the employer provides fuel or otherwise reimburses fuel expenses, up to $10 per hour is deemed substantiated if paid under Rev Proc 202-41. 11. Standard deduction. 1. In general, for taxable years beginning in 2010, the standard deduction amounts under Section 63C2 are as follows. Filing status. Married individuals filing joint returns and surviving spouses. Standard deduction, $11,400. Heads of households. Standard deduction, $8,400. Unmarried individuals other than surviving spouses and heads of households. Standard deduction, $5,700. Married individual filing separate returns, standard deduction, $5,700. 2. Dependent. For taxable years beginning in 2010, the standard deduction amount under Section 63C5 for an individual who may be claimed as a dependent by another taxpayer cannot exceed the greater of 1, $950, or 2, the sum of $300 and the individual's earned income. 3. Aged or blind. For taxable years beginning in 2010, the additional standard deduction amount under Section 63 for the aged or the blind is $1,100. These amounts are increased to $1,400 if the individual is also unmarried and not a surviving spouse. 12. Qualified transportation fringe. For taxable years beginning in 2010, the monthly limitation under Section 132 F2A regarding the aggregate fringe benefit exclusion amount for transportation in a commuter highway vehicle in any transit pass and under Section 132 F2B recording the fringe benefit exclusion amount for qualified parking is $230. 13. Income from the United States saving bonds for taxpayers who pay qualified higher education expenses. For regarding income of the United States saving bonds for taxpayers who pay qualified higher education expenses begins to phase out for modified adjusted gross income above $105,100 for joint returns and $70,100 for other returns. The exclusion is completely phased out for modified adjusted gross income of $135,100 or more for joint returns and $85,100 for other returns. 14. Adoption assistance programs. For taxable years beginning in 2010 under Section 137A2, the amount that can be excluded from an employee's gross income for the adoption of a child with special needs is $12,170. For taxable years beginning in 2010 under Section 137B1, the maximum amount that can be excluded from an employee's gross income for qualified adoption expenses furnished pursuant to an adoption assistance program and for other adoptions by an employee is $12,170. The amount excludable from an employee's gross incomes begins to phase out under Section 137B2A for taxpayers with modified adjusted gross income in excess of $182,520 and is completely phased out for taxpayers with modified adjusted gross income of $222,520 or more. See Section 303 of this revenue procedure for the adjusted items related to the adoption credit. You've earned yourself a drink of water. Wow, that's great. 15. Private activity bonds volume cap. For calendar year 2010, the amounts used under Section 146D1 to calculate the state ceiling for the volume cap for private activity bonds is the greater of 1, $90 multiplied by the state population, or 2, $273,775. 16. Loan limits for agricultural bonds. For calendar year 2010, the loan limit on agricultural bonds under Section 147C2A for first-time farmers is $470,100. 17. General arbitrage rebate rules. For bond years ending in 2010, the amount of computation credit determined under Section 1.148-3D4 is the proposed income tax regulations is $1,500. Excuse me. 18. Safe harbor rules for broker commissions on guaranteed investment contracts or investments purchased for a yield-restricted defiance escrow. For calendar year 2010, under Section 1.148-5E23B1, a broker's commission or similar fee for the acquisition of a guaranteed investment contract or investments purchased for a yield-restricted defeasance escrow is reasonable if 1. The amount of the fee that the issuer treats as a qualified administrative cost does not exceed the lesser of A, $35,000 and B, 0.2% of the computational base as defined in Section 1.148-5E23B2, or if more, $4,002, the issuer does not treat does not treat more than $100,000 in brokers, commissions, or similar fees as qualified administrative costs for all guaranteed investment contracts and investments for yield-restricted defeasance escrows purchased with gross proceeds of the issue. 11. Personal exemption. For taxable years beginning in 2010, the personal exemption amount under Section 151D is $3,650. 2. Election to expense certain depreciable assets. For taxable years beginning in 2010, under Section 179B1, the aggregate cost of any Section 179 property a taxpayer may elect to treat as an expense cannot exceed $134,000. Under Section 179B2, the $134,000 limitation is reduced, but not below zero, to the amount by which the cost of Section 179 property is placed in service during the 2010 taxable year exceeds $530,000. 21. Eligible long-term care premiums. For taxable years beginning in 2010, the limitations under Section 213D10 regarding eligible long-term care premiums includable in the term medical care are as follows. Attained age before the close of the taxable year, 40 or less. Limitation on premiums, $330. More than 40 but not more than 50. Limitation on premiums, $620. More than 50 but not more than 60. Limitation on premiums, $1,260. More than 60 but not more than 70. Limitation on premiums, $3,290. More than 70. Limitation on premiums, $4,110. Medical savings accounts. Self-only coverage. For taxable years beginning in 2010, the term high deductible tax plan, as defined in Section 220C2A, means for self-only coverage, a health plan has an annual deductible that is not less than $2,000 and not more than $3,000, under which the annual out-of-pocket expenses required to be paid other than for premiums for covered benefits do not exceed $4,050. 2. Family coverage. For taxable years beginning in 2010, the term high deductible health plan means for family coverage a health plan that has an annual deductible that is not less than $4,050 and not more than $6,050, and which under the annual out-of-pocket expenses required to be paid other than for premiums. The covered benefits do not exceed $7,400. Interest on education loans. For taxable years beginning in 2010, the $2,500 maximum deduction for interest paid on qualified education loans under Section 221 begins to phase out under Section 221(2)(b) for taxpayers with modified adjusted income in excess of $60,000 or $120,000 for joint returns, and this is completely phased out for taxpayers with modified adjusted gross income of $75,000 or more, $150,000 for more for joint returns. Treatment of dues paid to agricultural, cultural, or horticultural organizations. For taxable years beginning in 2010, the limitation under Section 512D1 according to the exemption of annual dues required to be paid by a member to an agricultural or horticultural organization is $146. 25. Insubstantial benefit limitations for contributions associated with charitable fundraising campaigns. 1. Low-cost article. For taxable years beginning in 2010, the unrelated business income of certain exempt organizations under Section 513H2 does not include a low-cost article of $9.60 or less. Other insubstantial benefits. For taxable years beginning in 2010, the $5, $25, and $50 guidelines in Section 3 of Rev Proc 2019-12, 1991, CB 471, as amplified by Rev Proc 92-49, 1992-1 CB 987, and modified by Rev Proc 92-102, 1992-2 CB 579 for disregarding the value of insubstantial benefits received by a donor in return for a fully deductible charitable contribution under Section 170 are $9.60, $48, and $96 respectively. 28. Expatriation to avoid tax. For calendar year 2010, an individual with above average annual net income tax of more than $145,000 for the 5 taxable years ending before the date of the loss of United States citizenship under Section 877 2A is a covered expatriate for purposes of Section 877A G1. Amounts allowed against unearned income and minimum tax exemption in computing the kiddie tax, which takes a minor child's net unearned income at the marginal rate that applies to the income of the child's parent, and the adoption credit, 4, the child tax credit, 5, the hope and lifetime learning credits, 6, the earned income tax credit, 7, the low income housing credit, 8, the alternative minimum tax exemption for a child subject to the kiddie tax, 9, the basic standard deduction amounts for different filing statuses, 10, the overall limitation of itemized deductions, 11, the qualified transportation fringe benefit exclusion, 12, the limitations on the exclusion of income from the redemption of United States savings bonds for taxpayers who pay qualified higher educational expenses, 13, adoption assistance program exclusions, 14, private party action bonds, activity bonds, the volume cap, 15, the personal exemption, 16, the eligible long-term care premiums, 17, medical savings accounts, 18, interest on education loans deductions, 19, the treatment of dues paid to agricultural or horticultural organizations, 20, the insubstantial benefit limitations for contributions associated with charitable fundraising campaigns, 21, funeral trust, 22, the expatriation to avoid tax, 23, valuation of qualified real property in decedent's gross estate, 24, annual exclusion for gifts, 25, generation skipping transfer tax exemption, 26, passenger air transportation excise tax, 27, reporting exception for certain exempt organizations with non-deductible lobbying expenditures. '28, the notice of large gifts received from foreign persons. 29, persons against which a federal tax lien is not valid. 30, property exempt from levy. 31, interest on a certain portion of the estate tax payable in installments. 32, the attorney fee awards. And 33, the periodic payments received under qualified long-term care insurance contracts or under certain life insurance contracts. Revenue Procedure 1-59 provided the following inflation adjustment terms for tax years beginning in 2002. 1. The tax rate tables for individuals and for estates and trusts. The amounts allowed against unearned income and minimum tax amounts allowed against unearned income and exemptions in computing the kiddie tax, which takes a minor child's net unearned income at the marginal rate and applies to the income of the child's parent. 3. The child tax credit. 4. The hope and lifetime learning credits. 5. Earned income credit. 6. The alternative minimum tax exemption for a child subject to the kiddie tax, and the basic standard deduction amounts for different filing statuses. 8. The overall limitation on itemized deductions, the qualified transportation fringe benefit exclusion. 10. Limitations on the exclusion of income from the redemption of United States saving bonds for taxpayers who pay qualified higher education expenses. 11. Personal exemption. 12. The eligible long-term care premiums. 13. Medical savings accounts. 14. The treatment of dues paid to agricultural and horticultural organizations. 15. The insubstantial benefit limitations for contributions associated with charitable fundraising campaigns. 16. Funeral trust. 17. Expatriation to avoid tax. 18. Valuation of qualified real property in decedent's gross estate. 19. Annual exclusion for gifts. 20. Generation skipping transfer tax exemption. 21. The luxury automobile excise tax. 23. Reporting exceptions for certain exempt organizations.
How many pages in are we?
93.
All right, you're an hour of the way through. Good job.
Can't wait to do more. Further. Generation skipping transfer tax exemption. 21. Luxury automobile excise tax threshold amount. 22. Passenger air transportation excise tax. 23. Reporting exception for certain exempt organizations with non-deductible lobbying expenditures. 24. The notice of large gifts received from foreign persons. 25. Persons against which a federal tax lien is not valid. 26. Property exempt from levy. 27. Interest on a certain portion of the estate tax payable in installments. 28. The attorney fee awards. And 29. The periodic payments received under qualified long-term care insurance contracts or under certain life insurance contracts. Revenue Procedure 1-13 provided the following inflation-adjusted items for tax years beginning in 2001. 1. The tax rate amounts allowed against unmarked unearned income and minimum tax exemption in computing the kiddie tax, which taxes a minor child's net unearned income at the marginal rate that applies to the income of the child's parent. 3. Earned income tax credit. 4. Alternative minimum tax exemption for a child subject to the kiddie tax. 5. The basic standard deduction amounts for filing different filing statuses. 6. The overall limitation amounts for different filing statuses. 7. The qualified transportation fringe benefit exclusion. 8. The limitations on the exclusion of income from the redemption of United States savings bonds. 9. The personal exemption. 10. Eligible long-term care premiums. 11. Medical savings accounts. 12. The treatment of dues paid to agricultural or horticultural organizations. 13. The insubstantial benefit limitations for contributions associated with charitable fundraising campaigns. 14. Funeral trust. 15. Expatriation to avoid tax. 16. Valuation of qualified real property in decedent's gross estate. 17. Annual exclusion for gifts. 18. The generation skipping transfer tax exemption. The luxury automobile excise tax threshold amount. 2. Passenger air transportation excise tax. 21. Reporting exception for certain exempt organization with non-deductible lobbying expenditures. 22. The notice of large gifts received from foreign persons. 23. Persons against which the federal tax lien is not valid. 24. Exempt from levy. 25. Interest on a certain portion of the estate tax payable in installments. 26. The attorney fee awards. And 27. The periodic payment received under qualified long-term care insurance contracts or under certain life insurance contracts. Revenue Procedure 99-42 provided in the following inflation-adjusted terms for the tax years beginning 2000. 1. The tax rate tables for individuals and for estates and trusts. 2. The amounts allowed against unearned income and minimum tax amounts allowed against unearned income. Exemption in computing the kiddie tax which taxes a minor child's net unearned income at the marginal rate that applies to credit. 4. The alternative minimum tax exemption for a child subject to the kiddie tax. 5. The basic standard deduction amounts for different filing statuses. 6. The overall limitation on itemized deductions. 7. The qualified transportation fringe benefit exclusion. 8. The limitations on the exclusion of income from the redemption of United States saving bonds for taxpayers who pay qualified higher education expenses. 9. The personal exemption. 10. The eligible long-term care premiums. 11. Medical savings accounts. 12. The treatment of dues paid to agricultural or horticultural organizations. 13. The insubstantial benefit limitations for contributions associated with charitable fundraising campaigns. 14. Funeral trusts. 15. The expatriation to avoid tax. 16. Valuation of qualified real property in decedent's gross estate. 17. Annual exclusion for gifts. 18. Generation skipping transfer tax exemption. 19. Luxury automobile excise tax threshold amount. 20. Passenger air transportation excise tax. 21. Reporting exception for certain exempt organizations with non-deductible lobbying expenditures. 22. The notice of large gifts received from foreign persons. 23. Persons against which a federal tax lien is not valid. 24. Property exempt from levy. 25. Interest on a certain portion of the state tax payable in installments, and 26. The attorney fee awards, and 27. The periodic payments received under qualified long-term care periodic payments received under qualified long-term care insurance contracts or under certain life insurance contracts. Revenue Procedure 98-61 provided the following inflation-adjusted items for tax years beginning in 1999. 1. The tax rate table for individuals and for estates and trusts. 2. The amounts allowed against unearned income and minimum tax exemption in computing kiddie tax, which taxes a minor child's net unearned income at the marginal rate that applies to the income of the child's parent. The earned income tax credit. The basic standard deduction amounts for different filing statuses. 5. The overall limitation of itemized deductions. 6. The limitations on the inclusion of income from the redemption of the United States saving bonds for taxpayers who pay qualified higher education expenses. 7. The personal exemption. 8. The eligible long-term care premiums. 9. Medical savings accounts. 10. The treatment of dues paid to agricultural and horticultural organizations. 11. The insubstantial benefit limitations for contributions associated with charitable giving or campaigns. 12. Funeral trusts. 13. The expatriation to avoid tax. 14. Valuation of qualified real property in decedent's gross estate. 15. Annual exclusion for gifts. 16. Generation skipping transfer tax exemption. 17. The luxury automobile excise tax threshold amount. 18. Passenger air transportation excise tax. 19. Reporting exception for certain exempt organizations with non-deductible lobbying expenditures. 20. The notice of large gifts received from foreign persons. 21.
Persons against which a federal tax lien is not valid. 22. Interest on a certain portion of the state of tax payable in the installments. 23. The attorney fee awards. And 24. The periodic payments under certain life insurance contracts. Revenue Procedure 97-57 provided the following inflation adjustment item for tax years beginning in 1998. 1. The tax rate tables for individuals and for estates and trusts. The amount allowed was unearned income including the kiddie tax, which allows a minor child's net unearned income at the marginal rate that applies to the income of the child's parent. The earned income tax, the basic standard deduction amounts for different filing statuses. 5. The overall limitation on itemized deductions. 6. The qualified transportation employee fringe benefit exclusion. 7. The limitations on the exclusion of income from the redemption of United States savings bonds for taxpayers who pay qualified higher education expenses. 8. The personal exemption. 9. Eligible long-term care premiums. 10. The treatment of dues paid to agricultural or horticultural organizations. 11. The insubstantial benefit limitations for contributions associated with charitable fundraising campaigns. 12. The expatriation to avoid tax. 13. Luxury automobile excise tax threshold amount. 14. Reporting exception for certain exempt organizations with non-deductible lobbying expenditures. The notice of large gifts received from foreign persons. The property exempt from levy. 17. The attorney fee awards. 18. Periodic payments received under qualified long-term care insurance contracts or under certain life insurance contracts. Revenue Procedure 9659 provided the following inflation-adjusted items for tax years beginning in 1997. The tax rate tables for individuals and for estates and trusts. The amounts allowed against unearned income in computing the kiddie tax with taxes of minor child's net unearned income. At a marginal rate that applies to the income of the child's parent. 3. The earned income tax credit. The alternative minimum tax exemption for kiddie tax reported on parent's return. The 5. The basic standard deduction amounts for different filing statuses. The overall limitation on itemized deductions. 7. The qualified transportation employee fringe benefit exclusion. 8. The limitations on the exclusion of income from the redemption of United States saving bonds for taxpayers who pay qualified higher education expenses. 9. The personal exemption. 10. The treatment of dues paid to an organizational or horticultural organization. The insubstantial benefit limitations for contributions associated with charitable fundraising campaigns. 12. The expatriation to avoid tax. 13. The raising campaigns. The luxury automobile excise tax threshold amount. 14. Reporting exception for certain exempt organizations with non-deductible lobbying expenditures. 15. Notice of large gifts received from foreign persons. And 11. The attorney fee awards. Revenue Procedure 9553 provided the following inflation adjusted items for the tax years beginning 1996. 1. The tax rate tables for individuals and or estates and trusts. 2. The amount allowed which unearned income in computing the kiddie tax, which rates a minor child's net unearned income at the marginal rate that applies to the income of the child's parent. 3. The earned income tax. 4. The basic standard deduction amounts for different filing statuses. 5. The overall limitation on itemized deductions. 6. The qualified transportation employee fringe benefit exclusion. 7. The limitations on the exclusion of income from the redemption of United States saving bonds for taxpayers who pay qualified higher education expenses. 8. The personal exemption. 9. The insubstantial benefit limitations for contributions associated with charitable fundraising campaigns. 10. The luxury automobile excise tax threshold amount. And 11. Reporting exception for certain exempt organizations with non-deductible lobbying expenditures. Revenue. Procedure 94 through 72. Providing the following inflation-adjusted items for tax years beginning in 1995. 1. The tax rate tables for individuals and for estates and trusts. 2. The amounts allowed against the unearned income in computing the kiddie tax, which taxes a minor child's net unearned income at the marginal rate that applies to the income of the child's parent. 3. The earned income tax credit. 4. The basic standard deduction amounts for different filing statuses. 5. The overall limitation of itemized deductions. 6. The qualified transportation employee fringe benefit exclusion. 7. The limitations on the exclusion of income from the redemption of United States saving bonds for taxpayers who pay qualified higher education expenses. 8. The personal exemption. 9. The insubstantial benefit limitations for contributions associated with charitable fundraising campaigns. And 10. The luxury automobile and excise tax threshold amount. Revenue procedure 93-49. Provided the following inflation-adjusted items for tax years beginning in 1994. 1. The tax rate tables for individuals and for estates and trusts. 2. The amounts allowed against unearned income in computing the kiddie tax, which taxes a minor child's net unearned income at the marginal rate that applies to the income of a child's parent. 3. The basic standard deduction amounts for different filing statuses. Overall limitation on itemized deductions. 5. The qualified transportation employee fringe benefit exclusion. 6. The limitations on the exclusion of income from the redemption of the United States saving bonds for taxpayers who pay qualified higher education expenses. The personal exemption. The insubstantial benefit limitations for contributions associated with charitable fundraising campaigns. And 9. The luxury automobile excise tax threshold amount.
Their organization is called Tax Revenue.
Revenue procedure 92-102 provided the following inflation-adjusted items for the tax years beginning in 1993. 1. The tax rate tables for individuals and for estates and trusts. 2. The basic standard deduction amounts for different filing statuses. The limitation on the standard deduction in the case of certain dependents, and the additional standard deduction amounts for the aged and for the blind. 3. The personal exemption and the phase out of tax benefit of personal exemptions. 4. The phase out of the tax benefit and personal exemptions, the earned income credit, the amounts allowed against unearned income in computing the kiddie tax, which taxes a minor child's net unearned income at the marginal rate that applies to the income of the child's parent. 6. The limitations on the exclusion of income from the redemption of United States saving bonds for taxpayers who pay qualified higher education expenses. 7. The overall limitation on itemized deductions. And 8. The insubstantial benefit limitations for contributions associated with charitable fundraising campaigns. Revenue procedure 91-65 provided the following inflation-adjusted items for taxable years beginning in 1992. 1. The tax rate tables for individuals and for estates and trusts. 2. The basic standard deduction amounts for different filing statuses. The limitation of the standard deduction in the case of certain dependents, and the additional standard deductions for the aged and blind. 3. Personal exemption. 4. The earned income credit. 5. Amounts allowed against unearned income in computing the kiddie tax, which taxes a minor child's net unearned income at the marginal rate that applies to the income of the child's parent. And 6. The limitations on the exclusion of income from the redemption of United States saving bonds or taxpayers who pay qualified higher education expenses. Revenue Procedure 90-64 provided the following inflation adjusted items for taxable years beginning 1991. 1. The tax rate tables for individuals and for estates and trusts. 2. The basic standard deduction amounts for different filing statuses, the limitation on the standard deduction in the case of certain dependents, and the additional standard deductions for the aged and blind, the personal exemption. 4. The earned income credit. 5. The amounts allowed against the unearned income in computing the kiddie tax, which takes a minor child's net unearned income at the marginal rate that applies to the income of the child's parent. And 6, the limitations on the exclusion of income from the redemption of United States saving bonds for taxpayers who pay qualified higher education expenses. Thanks. Ready? Great. Revenue Procedure 90-7 provided as an income tax inflation adjustment indexing factors as determined pursuant to the various provisions of this title for taxable years beginning in 1990 and set forth the application of the factors to the following. The tax rate tables for individuals and for estates and trusts, the basic standard deduction amounts for different filing statuses, the limitation on the standard deduction in the case of certain dependents, the additional standard deduction for the aged and blind, the earned income credit, and the personal exemption. Revenue Procedure 88-56 provided the income tax inflation adjustment indexing factors as determined pursuant to the various provisions for this title for taxable years beginning in 1989 and set forth in the application of the factors of the following. The tax rate tables for individuals and for estates and trusts, the basic standard deduction amounts for different filing statuses, the additional standard deductions for the aged and blind, the limitation on the standard deduction under certain circumstances, and the earned income credit. Revenue Procedure 8479 and Revenue Procedure 85-55 with respect to taxable years beginning in 1985 and 1986, respectively, prescribed adjusted tax tables in lieu of the tables contained in the paragraph 3 of former subsections A, B, C, D, and E of this section to provide an income tax cost of living adjustment indexing factor as determined pursuant to former subsection F3 of this section.
You ready to be relieved? I can come in here for you.
All right.
That bike?
You guys sure have been fun.
Yep.
You're at page 100.
Yep. Alright, this should sound pretty good then. You want to double check the sound? I think I'm good. Where did you end at, good sir? section of this page?
I just moved to A. Right there.
All right. Phase out of marriage penalty in 15% bracket. A. In general, with respect to taxable years beginning after December 31st, 2002, in prescribing the tables under paragraph 1. I. The maximum taxable income in the 15% rate bracket in the table contained in subsection A, and the minimum taxable income in the next higher taxable income bracket in such table shall be the applicable percentage of the maximum taxable income in the 15% rate bracket in the table contained in subsection C after any other adjustment under this subsection. And the comparable taxable income amounts in the table contained in subsection D shall be 1/2 of the amounts determined under clause I. B. Applicable percentage. For purposes of subparagraph A, the applicable percentage shall be determined in accordance with the following table. For taxable years beginning in calendar year 2003 and 2004, the applicable percentage is 200. For 2005, 180. For 2006, 187. For 2007, 193. 2008 and hereafter, 200. C. Rounding. If any amount determined under subparagraph A1 is not a multiple of 50, such amount shall be rounded to the next lowest multiple of 50. Subsection G7, B2, 2. Public Law 108-311, Section 408A1. Quote, struck out 10% and insert, quote, 10%, requiring no change in text. See 2001 Amendment Notes. Subsection H1DI, Public Law 108-311, Section 402A1, inserted, determined without regard to paragraph 11 following net capital gain. I believe these are statutory notes. Let's see if we can skip to a section of the actual code. There we go. Inflation adjustment. In prescribing the tables under subsection F, which apply with respect to taxable years beginning in calendar years after 2000, I. Except as provided in clause 2, the Secretary shall make no adjustment to the initial bracket amounts for any taxable year beginning before January 1st, 2009. 2. There shall be an adjustment under subsection F of such amounts which shall apply only to taxable years beginning in 2004. And such adjustments shall be determined under subsection F3 by substituting 2002 for 1992 in subparagraph B thereof. 3. The cost of living adjustments used in making adjustments to the initial bracket amounts for any taxable year beginning after December 31st, 2008 shall be determined under subsection F3 by substituting 2007 for 1992 in subparagraph B thereof. And IV. The adjustments under clauses 2 and 3 shall not apply to the amount referred in subparagraph B3. If any amount under adjustment under the preceding sentence is not a multiple of 50, such amount shall be rounded to the next lowest multiple of 50. 2. Reduce capital gains rates for qualified 5-year gain. A. Reduction in 10% rate. In the case of any taxable year beginning after December 31st, 2000, the rate under paragraph 1B shall be 8% with respect to so much of the amount which the 10% rate would otherwise apply, as does not exceed qualified 5-year gain, and 10% with respect to the remainder of such amount. Reduction in 20% rate. The rate under paragraph 1C shall be 18% with respect to so much of the amount to which the 20% rate would otherwise apply, as does not exceed the lesser of 1. The excess of qualified 5-year gain over the amount of such gain taken into account under subparagraph A of this paragraph, or 2. The amount of qualified 5-year gain, determined by taking into account only property the holding period for which begins after December 31st, 2000, and 20% with respect to the remainder of such amount. For the purposes of determining under the preceding sentence whether that holding period of property begins after December 31st, 2000, the holding period of property acquired pursuant to the exercise of an option, or any other right or obligation to acquire property, shall include the period such option or other right or obligation was held. Subsection H3, Public Law 108-27, Section 301B1B, temporarily redesignated former paragraph 4 as 3. Former paragraph 3 was temporarily redesignated number 2. See sunset provisions note set out under this section. 3. Adjusted net capital gain. For purposes of this subsection, the term adjusted net capital gain means net capital gain reduced, not by 0, but by the sum of A. Unrecaptured Section 1250 gain and 28% rate gain. Qualified 5-year gain. For the purposes of this subsection, the term qualified 5-year gain means the aggregate long-term capital gain from property held for more than 5 years. The determination under the preceding sentence shall be made without regard to collectibles gain, gain described in paragraph 7AI, and section 1202 gain. Inflation adjustment, C. In prescribing the tables under subsection F, which apply with respect to the taxable years beginning in calendar years after 2000, I. The Secretary shall make no adjustment to the initial bracket amount for any taxable year. I'm going to take a Marco Rubio break here.
We're taking a break now. Yeah. It's a whole lot of water. Yeah. Okay. Oh, I gotta cut it off. Okay, you want up that? Want up this way?
We look distinguished. Look at us.
Yes, yeah. Good idea. All right. Good luck. Good luck. All right, guys.
Now is a question of finding. There we go. Adjusted net capital gain, collectibles gain. This is fun. I literally lost.
So Dan, how'd you like that section on capital gains?
I think collectibles gain was incredibly interesting, and I also think this code is an abomination on the English language.
Fair enough.
Reduce capital gains rate for. Okay, here we go. Finding this. There it is. Determination of unrecaptured Section 1250 gain, not to include pre-May 7, 1997 gain. The amount determined under paragraph 7A1 shall not include gain properly taken into account for the portion of the taxable year before May 7, 1997. II. Other transitional rules for 18-month holding period. Paragraph 6A and 7AI II shall be applied by substituting 1 year for 18 months with respect to gain properly taken into account for the portion of the taxable year after May 6, 1997 and before July 29, 1997. H. Maximum capital gains rate. If a taxpayer has a net capital gain for any taxable year, then the tax imposed by this section shall not exceed the sum of 1. A tax computed at the rates and in the same manner as if this subsection had not been enacted on the greater of A. Taxable income, reduced by the amount of net capital gain, or B. The amount of taxable income taxed at a rate below 28% plus 2. A tax of 28% in the amount of taxable income in excess of the amount determined under paragraph 1. For purposes of the preceding sentence, the net capital gain for any taxable year shall be reduced, but not below 0, by the amount which the taxpayer elects to take into account as investment income for the taxable year under section 163D4B3. Effective and applicability provisions. 2010 Acts. Public Law 111-148, Title X, Section 10909D, March 23, 2010, 124 Stat 1024, provided that the amendments made by this section, amending 26 USCA Section 23, 24, 25, 25A, 25B, 26, 30, 30B, 30D, 36C, 137, 904, 1016, 1400C, and 6211, and 31 USCA 1324, and redesignating 26 USCA 23 to 26 USCA 36C. Shall apply to taxable years beginning after December 31st, 2009. In general, except as provided by paragraph 2, the amendments made by this section, amending this section 26 USCA 170F10A, 171, 312J and M, 443, 465, 508, 542, 543, 562, 563, 751, 864, D2, A2C, 898, 904, D2, A2, H1, A1, 232, 951, 954, C1I, 989, 1014, 1016, A 13, 12, 12, 12, 23, 12, 48, 12, 60, 12, 91, 12, 94, 4947, 4948, 6103, E1, DIV, to VI 6501 and 6679, repealing 26 USCA Section 551 to 558, 1246, 1247, and 6035, and enacting provisions set out as a note under 26 USCA 1212 shall apply to taxable years of foreign corporations beginning after December 31st, 2004, and to taxable years of the United States shareholders with or within such taxable years of foreign corporations end.
Seems reasonable.
2. Subsection C27. The amendments made by subsection C27 amending 26 USCA 6103E 1D IV to VI shall apply to disclosures of return or return information with respect to taxable years beginning after December 31st, 2004. In general, or 1. In general, the amendments made by this section shall apply to taxable years beginning after December 31st, 2002. Let's see. I'm trying to not necessarily read the statutory notes, but I'm having a hard time telling which one is which. 2. Tables for 2003. The Secretary of the Treasury shall modify each table which has been described under Section 1F of the Internal Revenue Code of 1986, subsection F of this section, for taxable years beginning in 2003, and which relates to the amendment made by subsection A, amending subsection IIBI of this section to reflect such amendment. In general, except as otherwise provided by the subsection, the amendments made by this section, of this section, and 26 USCA Section 55, 57, 1445, and 7518, and 46 APP USCA Section 1177, and enacting provisions set out as a note under this section, shall apply to taxable years ending on or after May 6, 2003. 2. Withholding. The amendment made by subsection A2C, amending 26 USCA 1445, shall apply to amounts paid after the date of the enactment of this Act, May 28, 2003. 3. Small business stock. The amendments made by subsection B3 shall apply to dispositions on or after May 6, 2003. Public Law 10827, Title 3, 302F, May 28, 2003. 117 Statute 764, as amended, Public Law 108-311, Title IV, Section 402A6, October 4th, 2004. 118 Statute 1185, provided that 1. In general, except as provided in paragraph 2, the amendments made by this section, amending this section and 26 USCA Section 163, 301, 306, 338, 467, 531, 541, 582, 702, 854, 857, 1255, and 1257, and repealing 26 USCA 341, shall apply to taxable years beginning after December 31st, 2002. 2. Pass-through entities. In the case of a pass-through entity described in subparagraph A, B, C, D, E, or F of the Section 1H10 of the Internal Revenue Code of 1986, as amended by this Act, subsection H10 of this section, the amendments made by this section shall apply to taxable years ending after December 31st, 2002, except that dividends received by such an entity on or before such date shall not be treated as qualified dividend income as defined in Section 1H11B of such code, as added by this Act, subsection H11B of this section. Amendment by Public Law 108-311, Section 402A to this note shall take effect as if included in Section 302 of the Jobs and Growth Tax Relief Reconciliation Act of 2003, Public Law 108-27, Title 3, Section 302, May 28, 2003, 117 Statute 760, C, Public Law 108-311, Section 402B, set out as a note under 26 USCA Section 1. 2001 Acts. Number 1, in general, except as provided in paragraph 2, the amendments made by this section enacting Section 6428 of this title, and amending this section and Sections 15, 531, 541, 3402, and 3406 of this title, shall apply to taxable years beginning after December 31st, 2000. 2. Amendments to withholding provisions. The amendments made by paragraph 6, 7, 8, 9, 10, and 11 of subsection C, amending sections 3402 and 3406 of this title, shall apply to amounts paid after the 60th day after the date of the enactment of this Act, June 7th, 2001. References to income brackets and rates of tax in such paragraphs shall be applied without regard to Section 1I, 1D of the Internal Revenue Code of 1986, subsection 1I, 1D of this section. See also sunset provisions notes set out under this section. Public Law 107-16, Title 3, Section 301D, June 7, 2001, 115 Stat 54, as amended by Public Law 108-27, Title 1, Section 103B, May 28, 2003, 117 Statute 754, provided that, quote, the amendments made by this section, amending this section and Section 63 of this title, shall apply to taxable years beginning after December 31st, 2002. See also sunset provisions set out under this section. Amendment to this note by Public Law 108-27, applicable to taxable years beginning after December 31st, 2002. See Public Law 108-27 and 103C, set out as 2003 effective and applicability provision under 26 USCA Section 63. Public Law 107-16, Title 3, Section 302C, June 7th, 2001. 115 Statute 54, as amended by Public Law 108-27, Title 1, Section 102B2, May 28, 2003. 117 Statute 754 provided that the amendments made by this section amending subsection F of this section shall apply to taxable years beginning after December 31st, 2002. See also sunset provisions set under this section. Amendment to this note by Public Law 108-27, applicable to tax years beginning after December 31st, 2002. See Public Law 108-27 and 102C, set out as a 2003 effective and applicability provision under this section. 2000 Acts. Public Law 106-554, Section 1A7, Title 1, Section 117C, December 21st, 2000. 114 Statute 2763, 2763A-605. Provided that the amendments made by this section amending subsection H8 of this section and section 1202 of this title shall apply to stock after the date of the enactment of this Act. That would be December 21st, 2000. (1998) Acts, Section 4002K of Public Law 105-277 provided that the amendments made by this section amending this section and sections 408A, 6015, 6103, 6159, 7421, 7443A, and 7491 of this title, and amending a provision set out as note under Section 6601 of this title shall take effect as if included in the provisions of the 1998 Act, Internal Revenue Restructuring and Reform Act, Public Law 105-206, July 22nd, 1998, 112, Statute 685. See tables for complete classification to which they relate. Section 5001B of Public Law 105-206 provided that, in general, except as provided by paragraph 2, the amendments made by this section, amending this section, and sections 1223 and 1235 of this title shall apply to taxable years ending after December 31st, 1997. Is the battery still on? Okay, because this is going to be good. Subsection A5. The amendments made by subsection A5, amending sections 1223 and 1235 of this title, shall take effect on January 1st, 1998. Section 6024 of Public Law 105-206, provided that, except as otherwise provided in this title, Title VI of Public Law 105-206, July 22nd, 1998, 112 Statute 790, the amendments made by this title. I'm going to need a drink of water before this. Amending this section and sections 23, 24, 25, 32, 34, 39, 42, 45A, 49, 50, 55, 57, 59, 72, 108, 121, 135, 142, 162, 168, 170, 196, 219, 221, 264, 280F, 304, 351, 354, 355, 368, 402, 403, 404, 408, 408A, 414, 475, 501, 512, 529, 530, 543, 641, 664, 672, 679, 685, 751, 774, 853, 857, 871, 901, 991, 1017, 1045, 1059, 1223, 1235, 1250, 1259, 1291, 1296, 1297, 1298, 1361, 1397D, 1397E, 1397F, 1400, 1400A, 1400B, 1400C, 2001, 2031, 2504, 2631, 2652, 2654, 3121, 3401, 40, 41, 4052, 4082, 4083, 4091, 4092, 4101, 4221, 4222, 4251, 4973, 4975, 5041, 5043, 5054, 5054, 5056, 5364, 6013, 6038, 6038B, 6039, 6050R, 6050S, 6103, 6104, 6166, 6211, 6213, 6311, 6331, 6401, 6416, 6421, 6427, 6501, 6611, 6724, 7232, 7430, 7431, 7434, 7479, 7702B, 7704, 7872, 9502, and 9811 of this title. Redesignating Section 646 and 2033A of this title as Section 641 and 2057 of this title, respectively. Amending Sections 2057 of this title as so redesignated, amending provisions set out as notes under Section 101, 102, or 121, 167, 172, 351, 401, 403, 453C, 475, 512, 2001, 4091, and 6011 of this title, and enacting provisions set out as notes under this section and sections 196, 402, 6401, 6427, and 7704 of this title shall take effect as if included in the provisions of the Taxpayer Relief Act of 1997. Whew. Okay. In general, except as provided in paragraph 2 of the amendments made by this section, amending subsection H of this section, sections 55, 57, 904, 1445, and 7518 of this title, and section 1177 of Title 46 Appendix, shipping, repealed by Public Law 109-304, Section 19, October 6, 2006. 120, Statute 1710, shall apply to taxable years ending after May 6, 1997. 2. Withholding. The amendment made by subsection C1, amending section 1445 of this title, shall apply only to amounts paid after the date of the enactment of this Act, August 5th, 1997. 1996 Acts. Section 1704M4 of Public Law 104-188, provided that the amendments made by this subsection, amending this section and section 59 of this title, shall apply to taxable years beginning after December 31st, 1995. 1993 Acts. Sections 13201C of Public Law 103-66, provided that the amendments made by this section, amending this section in sections 41, 63, 68, 132, 151, 453A, 513, 531, and 541 of this title, and enacting provisions set out as notes under this section, shall apply to taxable years beginning after December 31st, 1992. Section 13202C of Public Law 103-66, provided that the amendments made by this section, amending this section in sections 531 and 541 of this title, shall apply to taxable years beginning after December 31st, 1992. Section 13206D3 of Public Law 103-66, provided that the amendments made by this section, amending this section and section 163 of this title, shall apply to taxable years beginning after December 31st, 1992. 1990 Acts. Section 11101E of Public Law 101-508, provided that the amendments made by this section, amending this section, sections 32, 41, 59, 63, 135, 151, 513, 691, 904, 6103, and 7518 of this title, and section 1177 of Title 46 Appendix, shall apply to taxable years beginning after December 31st, 1990. Section 11103E of Public Law 101-508, provided that the amendments made by this section, amending this section in section 56 of this title, and enacting section 68 of this title, shall apply to taxable years beginning after December 31st, 1990. Section 11104C of Public Law 101-508, provided that the amendments made by this section, amending this section in section 151 of this title, shall apply to taxable years beginning after December 31st, 1990. 1989 Acts. Section 7817 of Public Law 101-239, provided that, except as otherwise provided in this part, any amendment made by this part, sections 7811 and 7816 of Public Law 101-239, shall take effect as if included in the provision of the 1988 Act, Public Law 100-647, to which such amendment relates. Section 7831G of Public Law 101-239, provided that any amendment made by this section, amending this section in sections 406, 407, and 1250 of this title, shall take effect as if included in the provision of the Tax Reform Act of 1986, to which such amendment relates. 1988 Acts. Section 1019 of Public Law 100-647, provided that A. General Rule. Except as otherwise provided in this title, Public Law 100-647, Title 1, Section 1001, et sec, November 10th, 1988, 102, Statute 3349, for distribution of this title to the Code, see tables. Any amendment made by this title shall take effect as if included in the provision of the Reform Act to which such amendment relates. B. Waiver of estimated tax penalties. No addition to tax shall be made under Section 6654 or 6655 of the 1986 Code, Sections 6654 and 6655 of this title, for any period before April 16, 1989, March 16, 1989, in the case of a taxpayer subject to Section 6655 of the 1986 Code, with respect to any underpayment to the extent such underpayment was created or increased by any provision of this title, or Title II, Public Law 100-647, Title II, Section 2001, et sec, November 10, 1988, 102, Statute 3593. For distribution of Title II to the Code, see tables. Section 6006B of Public Law 100-647 provided that the amendment made by this section, adding subsection I-7 of this section, shall apply to taxable years beginning after December 31st, 1988. 1986 Acts. Section 151 of Public Law 99-514 provided that, except as otherwise provided in this section, the amendments made by this title, enacting Section 67 of this title, amending this section in Sections 3, 5, 15, 21, 32, 62, 63, 86, 108, 129, 151, 152, 164, 170, 172, 183, 213, 274, 280A, 402, 441, 443, 527, 541, 613A, 642, 667, 861, 862, 901, 904, 1398, 2032A, 3402, 3507, 6012, 6013, 6014, 6212, 6504, and 6511 of this title, repealing sections 24, 221, 222, and 1301 to 1305 of this title, and enacting provisions set out as notes under sections 15 and 32 of this title, shall apply to taxable years beginning after December 31st, 1986. B. Unemployment compensation. The amendment made by Section 121, amending Sections 74, 102, 274, 3121, 3231, 3306, 3401, 4941, and 4945 of this title, and Section 409 of Title 42, the Public Health and Welfare, shall apply to prizes and awards granted after December 31st, 1986. D. Scholarships. The amendments made by Section 123, amending Sections 74, 117, 1441, and 7871 of this title, shall apply to taxable years beginning after December 31st, 1986, but only in the case of scholarships and fellowships granted after August 16th, 1986. E. Parsonage and military housing allowances. The amendment made by Section 144, amending Section 265 of this title, shall apply to taxable years beginning before, on, or after December 31st, 1986. Section 302B of Public Law 99-514 provided that the amendment made by this section enacting subsection J of this section shall apply to taxable years beginning after December 31st, 1986. Subsection 1411C of Public Law 99-514 provided that the amendments made by this section, amending this section in Section 6103 of this title, shall apply to taxable years beginning after December 31st, 1986. 1983 Acts. Section 109 of Public Law 97-448 provided that, except as otherwise provided in this title, any amendment made by this title, Title 1 of Public Law 97-448, see tables for classification, shall take effect as if it had been included in the provision of the Economic Recovery Tax Act of 1981, Public Law 97-34, August 13, 1981, 95 Statute 172, to which such amendment relates. 1981 Acts. Section 101 F1 of Public Law 97-34 as amended by Public Law 97-448, Title 1. Section 101A1, January 12, 1983. 96 Statute 2365 provided that the amendments made by subsections A, C, and D, amending sections 131, 21, 55, 541, and 1304 of this title, and repealing section 1348 of this title, shall apply to taxable years beginning after December 31st, 1981, except that the amendment made by paragraph 3 of subsection D, amending subsection 21 of this title, shall apply to taxable years ending after December 31st, 1981. Section 104E of Public Law 97-34 provided that the amendments made by this section, amending sections 1, 63, 151, 6012, 6013 of this title, shall apply to taxable years beginning after December 31st, 1984. 1978 Acts. Section 101F1 of Public Law 95-600 provided that the amendments made by subsection A, B, C, and D, amending sections 163D, 402E1C, 1302B3, and 6012A1 of this title, shall apply to taxable years beginning after December 31st, 1978. 1977X. Section 106A of Public Law 95-30 provided that the amendments made by sections 101, 102, and 104, amending sections 1, 3, 21, 42, 57, 63, 143, 161, 172, 211, 402, 441, 443, 511, 584, 613A, 641, 642, 667, 703, 861, 862, 873, 904, 911, 931, 1034, 1211, 1302, 6012, 6014, 6212, 6504, and 6654 of this title, and repealing sections 36, 141, 142, 144, and 145 of this title, shall apply to taxable years beginning after December 31st, 1976. 1969 Acts. Section 803F of Public Law 91-172 provided that the amendments made by subsections A, amending section 1 of this title, B, amending section 2 of this title, and D, other than paragraphs 1 and 8, amending sections 5B1, 5, 511B1, 632, 641A, 1347, and 6015A1, shall apply to taxable years beginning after December 31st, 1970, except that Section 2C of the Internal Revenue Code of 1954, Section 2C of this title, as amended by subsection B, shall also apply to taxable years beginning after December 31st, 1969. The amendments made by subsection C, amending Section 3 of this title, D1, amending Section 6014A of this title, and D8, amending Section 1304B1 of this title, shall apply to taxable years beginning after December 31st, 1969. 1966 Acts. Section 103N of Public Law 89-809 provided that 1. The amendments made by this section other than the amendments made by subsections H, I, and K, enacting Section 877 of this title, amending sections 1, 116, 154, 871 to 875, 932, 6015, and 7701 of this title, renumbering sections 877 as 878, and repealing section 1493 of this title, shall apply with respect to taxable years beginning after December 31st, 1966. Number 2. The amendments made by subsection H, amending section 1441 of this title, shall apply with respects to payments made in taxable years of recipients beginning after December 31st, 1966. The amendments made by subsection 1, amending section 1461 of this title, shall apply with respect to payments occurring after December 31st, 1996. 1964 Acts. Section 131 of Public Law 88-272 provided that, except for purposes of Section 21 of the Internal Revenue Code of 1954, relating to effect of changes in rates during a taxable year, changes in rates, the amendments made by Parts 1 and 2 of this title, amending sections 1, 2, 11, 37, 141, 144, 242, 821, 871, 963, 6016, 6074, 6154, 6212, 6504, and 6655 of this title shall apply with respect to taxable years beginning after December 31st, 1963. And these are all statutory notes after this. Purposes and principles. Public Law 111-5, Section 3, February 17, 2009, 123 Statute 115 provided that A. Statement of purposes. The purposes of this Act, American Recovery and Reinvestment Act 2009, Public Law 111-5, February 17, 2009, 123 Statute 115, see tables for complete classification, include the following. 1. To preserve and create jobs and promote economic recovery. To assist those most impacted by the recession. 3. To provide investments needed and to increase economic efficiency by spurring technological advances in science and health. 4. To invest in transportation, environmental protection, and other infrastructure that will provide long-term economic benefits. 5. To stabilize state and local government budgets in order to minimize and avoid reductions in essential services and counterproductive state and local tax increases. B. General principles concerning the use of funds. The President and the heads of federal departments and agencies shall manage and expend the funds made available in this Act, American Recovery and Reinvestment Act 2009, Public Law 111-5, February 17, 2009, 123 Statute 115, see tables for complete classification, so as to achieve the purposes specified in subsection A, including commencing expenditures and activities as quickly as possible, consistent with prudent management. Transitional rules for taxable years, which include May 6, 2003. Public Law 108-27, Title 3, Section 301C, May 28, 2003, 117 Statute 759. Provided that, for purposes of applying Section 1H of the Internal Revenue Code of 1986, subsection H of this section, in the case of a taxable year which includes May 6, 2003, 1. The amount of tax determined under paragraph B of subsection 1H1 of such code, subsection H1B of this section, shall be the sum of A. 5% of the lesser of I. The net capital gain, determined by taking into account only gain or loss properly taken into account for the portion of the taxable year on or after May 6, 2003. Determined without regard to collectibles. Gain or loss. Gain described in section 1H6A1 of such code, subsection H6A1 of this section, and section 1202 gain. Or 2. The amount on which a tax is determined under such subparagraph without regard to this subsection, this note. B. 8% of the lesser of I, the qualified 5-year gain as defined in section 1H9 of the Internal Revenue Code of 1986, subsection 8-9 of this section, H9 of this section, as in effect on the day before the date of the enactment of this Act, May 28, 2003, properly taken into account for the portion of the taxable year before May 6, 2003, or 2, the excess of any of I, the amount on which a tax is determined under such subparagraph without regard to the subsection, this note, over 2, the amount on which a tax is determined under subparagraph A plus C, 10% of the excess, if any, of I, the amount on which a tax is determined under such subparagraph without regard to this subsection, this note, over 2, the sum of the amounts under which a tax is proposed or determined under subparagraphs A and B. 2. The amount of tax determined under subparagraph C of section 1H1 of such code, subsection H1C of this section, shall be the sum of A, 15% of the lesser of I, the excess, if any, of the amount of net capital gain determined under subparagraph A.I. of paragraph 1 of this subsection, this note, over the amount on which a tax is determined under paragraph A of paragraph 1 of this subsection, this note. Or 2. The amount on which a tax is determined under such subparagraph C without regard to this subsection, this note. Plus B. 20% of the excess, if any, of I. The amount on which a tax is determined under such subparagraph C without regard to this subsection over 2. The amount on which a tax is determined under subparagraph A of this paragraph. 3. For purposes of applying section 55B3 of such code, 26 USCA section 55B3, rules similar to the rules of paragraphs 1 and 2 of this subsection shall apply. 4. In applying this subsection, this note, with respect to any pass-through entity, the determination of when gains and losses are properly taken into account shall be made at the entity level. 5. For purposes of applying section 1H11 of such code, subsection H11 of this section, as added by section 302 of this act to this subsection, this note, dividends which are qualified dividend income shall be treated as gain properly taken into account for the portion of the taxable year on or after May 6, 2003. 6. Terms used in this subsection, this note, are also used in section 1H of such code, subsection H of this section, and shall have the respective meanings that such terms have in such section in this section. Adjustments for Consumer Price Index Error. Public Law 106-554, Section 1A7, Title 3, Section 308. December 21st, 2000. 114 Statute 2763-2763A-636 provided that A. Determinations by OMB. As soon as practicable, after the date of the enactment of this Act, the Director of the Office of Management and Budget shall determine with respect to each applicable federal benefit program whether the CPI computation error for 1999 has or will result in a shortfall in payments to beneficiaries under such program, as compared to payments that would have been made if the error had not occurred. As soon as practicable after the date of the enactment of this Act, December 21st, 2000, but not later than 60 days after such date, the Director shall direct the head of the federal agency which administers such programs to make a payment or payments that, insofar as the Director finds practicable and feasible, 1. Are targeted toward the amount of the shortfall experienced by individual beneficiaries, and 2. Compensate for the shortfall. B. Coordination with federal agencies. As soon as practicable after the date of the enactment of this Act, each federal agency that administers an applicable federal benefit program shall, in accordance with such guidelines as are issued by the Director pursuant to this section, make an initial determination of whether, and the extent to which, the CPI computation error for 1999 has, or will, result in a shortfall in payments to beneficiaries of an applicable federal benefit program administered by such agency. No later than 30 days after such date, the head of such agency shall submit a report to the Director and to each House of Congress of such determination, together with a complete description of the nature of the shortfall. C. Implementation pursuant to agency reports. Upon receipt of the report submitted by a federal agency, pursuant to subsection B, the Director shall review the initial determination of the agency's description of the nature of the shortfall, and the compensation payments proposed by the agency. Prior to directing payment of such payments pursuant to subsection A, the Director shall make appropriate adjustments, if any, in the compensation payments proposed by the agency that the Director determines are necessary to comply with, and the requirements of subsection A, and transmit to the agency a summary report of the review, indicating any adjustments made by the Director. The agency shall make the compensation payments as directed by the Director pursuant to subsection A in accordance with the Director's summary report. D. Income disregard under federal means-tested benefit programs. A payment made under this section to compensate for a shortfall in benefits shall, in accordance with guidelines issued by the Director pursuant to this section, be disregarded in determining income under Title VIII of the Social Security Act, 42 U.S.C. 1001 et sec, or any applicable federal benefit program that is means tested. E. Funding. Funds otherwise available under each applicable federal benefit program for making benefit payments under such program are hereby made available for making compensation payments under this section in connection with such program. F. No judicial review. No action taken pursuant to this section shall be subject to judicial review. G. Director's report. Not later than April 1st, 2001, the Director shall submit to each House of Congress a report on the activities performed by the Director pursuant to this section. H. Definitions. For purposes of this section, B. or 1. Applicable federal benefit program. The term applicable federal benefit program means any program of the government of the United States providing for regular or periodic payments or cash assistance paid directly to individual beneficiaries as determined by the Director of Office of Management and Budget. 2. Federal agency. The term federal agency means the department, agency, or instrumentality of the government of the United States. 3. CPI computation error for 1999. The term CPI computation error for 1999 means the error in the computation of the Consumer Price Index announced by the Bureau of Labor Statistics on September 28, 2000. 1. Tax provisions. In the case of taxable years and other periods beginning after December 31st, 2000, if any Consumer Price Index as defined in Section 1F5 of the Internal Revenue Code of 1986, 26 U.S.C. Section 1F5 reflects the CPI computation error for 1999. 1. The correct amount of such index shall, in such manner and to such extent as the Secretary of Treasury determines to be appropriate, be taken into account for purposes of such code. And 2. Tables prescribed under Section 1F of such code, 26 U.S.C. A1, to reflect such correct amount shall apply in lieu of any tables that are prescribed based on the erroneous amount. Wow. Definitions. Coordination of Title IV with other titles of Division J of Public Law 105-277. Public Law 105-277, Division J, Title IV, Section 4001, October 21st, 1998, 112 Stat 2681-906, provided that A. Definitions. For purposes of this title, Title 4, Section 4001 to 4006 of Division J of Public Law 105-277, October 21st, 1998, 112 Statute 2681-906, see tables for classification. 1986 Code. The term 1986 Code means the Internal Revenue Act Code of 1986, 26 U.S.C. A, Section 1, et sec. 2. 1998 Act. The term 1998 Act means the Internal Revenue Service Restructuring and Reform Act of 1998, Public Law 105-206, Public Law 105-206, July 22nd, 1998, 112 Stat 60685, see tables for classification. 3. 1997 Act. The term 1997 Act means the Taxpayer Relief Act of 1997. Public Law 105-34. Public Law 105-34, August 5th, 1997. 111 Statute 788, see tables for classification. B. Coordination with other titles. For purposes of applying the amendments made by any title of this division, Division J of Public Law 105-277, October 21st, 1998, 112 Statute 2681-886, see tables for classification. The provisions of this title shall be treated as having been enacted immediately before the provisions of other such titles. Application of subsections H, 13, A, 1 2, A2, 2, and B2 to certain distributions after December 31st, 1997 by a regulated investment company or a real estate public investment trust. Public Law 105-277. Division J, Title 4, Section 4002, 1, 2, October 21st, 1998, 112, Stat 2681-907, provided that A, subparagraphs A12, A22, and B2 of Section 1H13 of the 1986 Code, subsection H13 of this section shall not apply to any distribution after December 31st, 1997 by a regulated investment company or a real estate investment trust with respect to 1. Gains and losses recognized directly by such company or trust, and 2. Amounts properly taken into account by such company or trust by reason of holding, directly or indirectly, an interest in another such company or trust to the extent that such subparagraphs did not apply to such other company or trust with respect to such amounts. B. Subparagraph. That works out. You have a card on you?
Yeah. There's a lot of noise in me.
All right, the stream is temporarily off. Just post a message on the YouTube live chat saying as much. We gotta switch batteries, essentially.
Yeah.
All right. Yes. What happens with this is you take this and you plug it into yours. Okay, cool. So. On the phone, it should say there. Okay. That's exactly.
Where's the six?
It's back on. All right, awesome. We're back on.
It's streaming now?
Yeah. Double check on the phone, but I'm pretty sure it is.
Silver Surfer says now we're up.
We're up. All right.
I want to visually confirm myself. Why don't you sit down?
Thrilling. Okay, right there. Beautiful. All right. What time is it? Okay, cool.
Yeah, all right. Yeah.
Shall we dust this off and? All right. C. 2. Such companies' distributive share of such gains and losses, as so determined, shall be treated as recognized directly by such company. The preceding sentence shall apply only if the qualified partnership provides the company with written documentation of such distributive share, as so determined. 2. For purposes of Clause 1. The term qualified partnership means, with respect to a regulated investment company, any partnership if 1. The partnership is an investment company registered under the Investment Company Act of 1940. Act, August 22nd, 1940, C. 686, Title 1, 54, Statute 789, which is principally classified to Subchapter 1 of Chapter 2D of Title 15, 15 USCA 30A 1 et sec. See tables for classification. 2. The regulated investment company is permitted to invest in such partnership by reason of Section 12D1E, 15 USCA 80. Or an exemptive order of the Securities and Exchange Commission under such section. And 3. The regulated investment company and the partnership have the same taxable year. 3.3. A regulated investment company meets the holding requirement of this clause with respect to a qualified partnership if, as of January 1st, 1998, 3.3.1. The value of the interests of the regulated investment company in such partnership is 35% or more of the value of such company's total assets, or 2. The value of the interest of the regulated investment company in such partnerships and all other qualified partnerships is 90% or more of the value of such company's total assets. Provision related to Section 311 of the Taxpayer Relief Act, Public Law 105-34. Public Law 105-277, Division J, Title 4, Section 4003B, October 21st, 1998. 112, Statute 2681-909. As amended, Public Law 106-554, Section 1A7, Title 3 and 312, and Section 312B, December 21st, 2000. 114, Statute 2763-2763A-640, provided that in the case of any capital gain distribution made after 1997 by a trust to which Section 664 of the 1986 Code, 26 U.S.C.A. 664, applies with respect to amounts properly taken into account by such trust during 1997, paragraphs 5A, 1, 1, 5A, 2, 1, 7A, 1, 2, and 13A of Section 1H of the 1986 Code, and subsection H of this section, as in effect for taxable years ending on December 31st, 1997, shall not apply. Amendments by Section 4003 of Public Law 105-277, effective as if included in the provisions of Public Law 105-34, to which they relate, see Section 4003L, set out as a note under Section 86 of this title. Amendments by Public Law 106-554, Section 1A7, Title 3, Section 312B, effective as if included in the provisions of Public Law 105-277, to which they relate. See Public Law 106-554, set out as a note under Section 6104 of this title. Coordination of Title 4 of Public Law 105-206 with other titles of Public Law 105-206. Public Law 105-206, Title 4, Section 6001B, July 22nd, 1998. 112, Statute 790, provided that, for purposes of applying the amendments made by any title of this Act, other than this title, Title 4, Title 6, Section 6001 to 6024 of Public Law 105-206, the provisions of this title, Title 6, shall be treated as having been enacted immediately before the provisions of such other titles. Election to recognize gain on assets held on January 1st, 2001. Section 311E of Public Law 105-34, as amended Public Law 106-554, Section 1A7, Title 3, Section 314C, December 21st, 2000. 114, Statute 2763-2763A-643, Public Law 107-147, Title 4, Section 414A, March 9, 2002, 116, Statute 54, provided that, for purposes of the Internal Revenue Code of 1986, 1. In general, a taxpayer other than a corporation may elect to treat A. Any readily tradable stock, which is a capital asset, held by such taxpayer on January 1st, 2001, and not sold before the next business day after such date, as having been sold on such next business day for an amount equal to its closing market price on such next business day, and as having been required on such next business day for an amount equal to such closing market price, and B, any other capital asset or property used in the trade or business as defined in Section 1231B of the Internal Revenue Code of 1986, Section 1231B of this title, held by the taxpayer on January 1st, 2001, as having been sold on such date for an amount equal to its fair market value on such date, and as having been reacquired on such date for an amount equal to such fair market value. I'm channeling the spirit of Rubio now, seriously. 2. Okay, let me finish this page. 2. treatment of, we roll hard here. True. 2, treatment of gain or loss. A, any gain resulting from an election under paragraph 1 shall be treated as received or accrued on the date the asset is treated as sold under paragraph 1 and shall be included in the gross income notwithstanding any provision of the Internal Revenue Code of 1986. This title. B, any loss resulting from an election under paragraph 1 shall not be allowed for any taxable year. 3, election. An election under paragraph 1 shall be made in such manner as the Secretary of the Treasury or his delegate may prescribe and shall specify the assets for which such election is made. Such an election, once made, with respect to any asset, shall be irrevocable. Such an election shall not apply to any asset which is disposed of in a transaction which gain or loss is recognized in whole or in part before the close of the 1-year period beginning on the date that the asset would have been treated as sold under such election. 4. Readily tradable stock. For purposes of this subsection, the term readily tradable stock means any stock which, as of January 1st, 2001, is readily tradable on an established securities market or otherwise. 5. Disposition of interest in a passive activity. Section 469G1A of the Internal Revenue Code of 1986, 26 U.S.C. A, Section 469G1A, shall not apply by reason of an election made under paragraph 1. Public Law 107-147, Title 4, Section 414B, March 9, 2002, 116 Stat 54, provided that the amendments made by this section amending this note shall take effect as if included in Section 311 of the Taxpayer Relief Act of 1997, Public Law 105-34, August 5th, 1997, 111 Stat 835, amendments by Public Law 106-554, Section 1A7, Title 3, Section 314C, effective as if included in the provisions of Public Law 105-34 to which they relate. See Public Law 106-554, Section 1A7, Title 3, Section 314G. And we're going to switch out, ladies and gentlemen.
So how did you like the section you just went through?
I think the tables are pretty important.
The tables? Yeah, I felt like there's a real twist I didn't see coming with the 80s reform. How did you feel about that part?
We've had tax reform? You sure about that?
It kept coming up in there. I kept hearing like something about, according to the 82, 86, 82.
I don't know. I'm kind of... I may need a mental checkup when we're done here.
Did you have a favorite part?
The part where I got to rap, probably.
All the numbers. Yeah, I thought you were having a glitch out here, right? I thought that was like a little glitch in the Matrix, but all right, we're gonna give Jeff Lewis a chance.
Yes.
Did you lose your spot?
No, it's upside down. Very first page. Yes. Or the page you open to. This is all yours. Ugh. Okay. Well.
So I did mental math. I think it'll take about a year. So I mean, they'll be lucky if they get 100%.
Yeah, that was on the ground.
Yep. It's very, very fragile.
Company colors, right? The point is to be totally nonpartisan. No red. I'm not thinking science. Oh, I'm just a artist. I think it can be very chaotic.
Yeah, I was hoping I could check with you briefly. Just explain to my camera what you did. Yeah.
It's complicated. I got to be able to see.
Need lots of water out here. Yeah, it's not raining.
Mr. Johnson.
Where were we? I'm assuming he got to the bottom of the page. Adjustments for consumer price index error. Public Law 106-554, Section 1A7 of Title III, Section 308, December 21st, 2000, 114 Stat 2763, 2763A through 636, provided that A, determinations by OMB, Office of Management and Budget, as soon as practical after the date of the enactment of this Act, December 21st, 2000, the Director of the Office of Management and Budget shall determine with respect to each applicable federal benefit program whether the Consumer Price Index computation error for 1999 has or will result in a shortfall in payments to beneficiaries under such program, parenthetical, as compared to payments that would have been made if the error had not occurred, as soon as practicable after the date of the enactment of this Act, December 21st, 2000, but not later than 60 days after such a date, the Director shall direct the head of the federal agency which administers such program to make a payment or payments that, insofar as the Director finds practicable and feasible, 1, are targeted to the amount of the shortfall experienced by individual beneficiaries, and 2, compensate for the shortfall. Adjustments for consumer price index error. B, coordination with federal agencies. As soon as practicable after the date of the enactment of this Act, December 21st, 2000, each federal agency that administers an applicable federal benefit program shall, in accordance with such guidelines as are issued by the Director pursuant to this section, make an initial determination of whether and the extent to which the Consumer Price Index computation error for 1999 has or will result in a shortfall in payments to beneficiaries of an applicable federal benefit program administered by such agency. Not later than 30 days after such date, the head of such agency shall submit a report to the Director and to each House of the Congress of such determination, together with a complete description of the nature of the shortfall. Adjustments for consumer price index error. C, implementation pursuant to agency reports. Upon receipt of the report submitted by the federal agency pursuant to subsection B, the Director shall review the initial determination of the agency's description of the nature of the shortfall, and the compensation payments proposed by the agency. Prior to directing payment of such payments, pursuant to subsection A, the Director shall make appropriate adjustments, parenthetical, if any, in the compensation payments proposed by the agency that the Director determines are necessary to comply with the requirements of subsection A, and transmit to the agency a summary report of the review indicating any adjustments made by the Director. The agency shall make the compensation payments as directed by the Director pursuant to subsection A in accordance with the Director's summary report. Adjustments for consumer price index error. D, income disregard under federal means-tested benefit programs. A payment made under this section to compensate for a shortfall in benefits shall, in accordance with guidelines issued by the Director pursuant to this section, be disregarded in determining income under Title VIII of the Social Security Act, 42 U.S.C.A. Section 1001, etc., or any applicable federal benefit program that is means tested. Adjustments for consumer price index error. E, funding. Funds otherwise available under each applicable federal benefit program for making benefit payments under such program are hereby made available for making compensation payments under this section in connection with such program. Adjustments for consumer price index error. F, no judicial review. No action taken pursuant to this section shall be subject to judicial review. Adjustments for Consumer Price Index error. G. Director's report. Not later than April 1st, 2001, the Director shall submit to each House of the Congress a report on the activities performed by the Director pursuant to this section. Adjustments for Consumer Price Index error. H. Definitions. For the purposes of this section, 1. Applicable Federal Benefit Program. The term applicable federal benefit program means any program of the government of the United States providing for regular or periodic payments or cash assistance paid directly to individual beneficiaries as determined by the Director of the Office of Management and Budget. 2. Federal agency. The term federal agency means a department, agency, or instrumentality of the government of the United States. 3. CPI computation error for 1999. The term CPI computation error for 1999 means the error in the computation of the Consumer Price Index announced by the Bureau of Labor Statistics on September 28, 2000. Adjustments for Consumer Price Index error. I. Tax provisions. In the case of taxable years and other periods, beginning after December 31st, 2000, if any consumer price index, as defined in Section 1, parenthetical F, parenthetical 5 of the Internal Revenue Code of 1986, 26 U.S.C. A, Section 1, F5, reflects the CPI computation error for 1999, 1. The correct amount of such index shall, parenthetical, in such manner and to such extent as the Secretary of the Treasury determines to be appropriate, be taken into account for purposes of such code. And 2. Tables prescribed under Section 1, parenthetical F of such code, 26 U.S.C. A, Section 1F, to reflect such correct amount shall apply in lieu of any tables that were previously or that were prescribed based on the erroneous amount. Definitions. Coordination of Title IV with other titles of Division J of Public Law 105-277. Public Law 105-277, Division J, Title IV, Section 4001, October 21, 1998, 112 Stat 2681-906, provided that A. Definitions for purpose of this title, Title IV, Sections 4001 to 4006 of Division J of Public Law 105-277, October 21st, 1998, 112 Stat 2681-906, see tables for classification. A1, 1986 Code. The term 1986 Code means the Internal Revenue Code of 1986, 26 U.S.C. A, Section 1, etc. 2. 1998 Act. The term 1998 Act means the Internal Revenue Service Restructuring and Reform Act of 1998, Public Law 105-206, Public Law 105-206, July 22nd, 1998, 112 Stat 685, see tables for classification. Definitions coordinated of Title IV with other titles of Division J for Public Law 105-277. 3. 1997 Act. The term 1997 Act means the Taxpayer Relief Act of 1997. Public Law 105-34. Bracketed Public Law 105-34, August 5, 1997. 111 Stat 788. See tables for classification. Definitions, coordination of Title IV with other titles of Division J of Public Law 105-277B. This will be 3B. Coordination with other titles. For purposes of applying the amendments made by any title of this division, bracketed Division J of Public Law 105-277, October 21, 1998, 112 Stat 2681-886. See tables for classification. Other than this title, which is Title 4 of Division J of Public Law 105-277, October 21st, 1998, 112 Stat 2681-906. See tables for classification in bracket. The provisions of this title shall be treated as having been enacted immediately before the provisions of such other titles. Application of subsections H, 13A, I2, A2, 2, and B2 to certain distributions after December 31st, 1997 by a regulated investment company or a real estate investment trust. Public Law 105-277, Division J, Title 4, Section 4002, I2, October 21st, 1998, 112 Stat 2681-907, provided that, A, subparagraphs A, little I, 2, A, 2 little i's, Roman numeral 2, and B, 2 little i's, of Section 1H13 of the 1986 Code, subsection 813 of this section, shall not apply to any distribution after December 31st, 1997 by a regulated investment company or a real estate investment trust with respect to little I, gains and losses recognized directly by such company or trust, and little 2 i's, amounts properly taken into account by such company or trust by reason of holding, parenthetical directly or indirectly, an interest in another such company or trust to the extent that such subparagraphs did not apply to such other company or trust with respect to such amounts. Catch all that. B. Subparagraph A shall not apply to any distribution which is treated under sections 852B7 or 857B8 of 26 USCA sections 852B7 or 857B8 of the 1986 Code as received on December 31st, 1997. Application of subsections H13AI2, A 2 little i's, Roman numeral 2, and B 2 little i's to certain distributions after December 31st, 1997 by a regulated investment company or a real estate investment trust. B. Subparagraph A shall not apply to any distribution which is treated under Section 852B7 or 852B8, 26 USCA, Sections 852B7 or 857B8 of the 86 Code as received on December 31st, 1997. C. For purposes of subparagraph A, any amount which is includable in gross income of its shareholders under Section 852B3D or 857B3D of the 1986 Code after December 31st, 1997 shall be treated as distributed after such date. D. DI. For purposes of subparagraph A, in the case of a qualified partnership with respect to which a regulated investment company meets the holding requirement of clause parenthetical 3 little i's, I, the subparagraphs referred to in subparagraph A shall not apply to gains and losses recognized directly by such partnership for purposes of determining such company's distributive share of such gains and losses, and Roman numeral 2, such company's distributed share of such gains and losses, parenthetical as so determined, shall be treated as recognized directly by such company. The preceding sentence shall apply only if the qualified partnership provides the company with written documentation of such distributed share as so determined. Parenthetical 2 little i's. For purposes of clause parenthetical little I, the term quote-unquote qualified partnership means, with respect to a regulated investment company, any partnership if 1. The partnership is an investment company registered under the Investment Company Act of 1940, Act August 22nd, 1940, Chapter 686, Title 1, 54 Stat 789, which is principally classified to Subchapter 1 of Chapter 2D of Title 15, parenthetical 15 USCA Section 30A-1, etc. See tables for classification. Roman numeral 2. For purposes of Clause 1, the term qualified partnership means, with respect to a regulated investment company, any partnership, if the regulated investment company is permitted to invest in such partnership by reason of Section 12D1E, bracketed 15 USCA, Section 80A-12, in bracket, of such act, or an exemptive order of the Securities and Exchange Commission under such section, and, Roman numeral 3, the regulated investment company and the partnership have the same taxable year. Small Roman numeral, three little i's, parenthetical. A regulated investment company meets the holding requirement of this clause with respect to a qualified partnership if, parenthetical, as of January 1, 1998, Roman numeral 1, the value of the interest of the regulated investment company in such partnership is 35% or more of the value of such company's total assets, or, Roman numeral 2, the value of the interest of the regulated investment company in such partnership and all other qualified partnerships is 90% or more of the value of such company's total assets. Provisions related to Section 311 of the Taxpayer Relief Act, parenthetical Public Law 105-34, Public Law 105-277, Division J, Title 4, Section 4003B, October 21, 1998, 112 Stat 2681-909, as amended, Public Law 106-554, Section 1A7, bracketed Title 3, Section 312, parenthetical B, in bracket, December 21, 2000, 114 Stat 2763, 2763A-40, provided that, quote, in the case of any capital gain distribution made after 1997 by a trust to which Section 664 of the 1986 Code, bracketed 26 USCA, Section 664, in bracket, applies with respect to amounts properly taken into account by such trust during 1997, paragraphs 5A, little I, Roman numeral I, 5A, two little i's, Roman numeral I, 7A, little I, Roman numeral 2, and 13A of Section 1H of the 1986 Code, bracketed subsection H of this section, parenthetical, as in effect for taxable years ending on December 31st, 1997, in bracket, shall not apply, end quote. Bracketed. Amendments by Section 4003 of Public Law 105-277, effective as if included in the provisions of Public Law 105-34, to which they relate. See Section 4003L. Set out as a note under Section 86 of this title. Bracketed. Amendments by Public Law 106-54, Section 1A7, bracketed Title 3, Section 312B, effective as if included in the provisions of Public Law 105-277, to which they relate. See Public Law 106-554, Section 1A7, bracketed Title 3, Section 312C, in bracket, set out as a note under Section 6104 of this title, in bracket. Coordination of Title 6 of Public Law 105-206 with other titles of Public Law 105-206. Public Law 105-206, Title 6, Section 6001B, July 22nd, 1998. 112 Stat 790, provided that, quote, for purposes of applying the amendments made by any title of this act, bracketed Public Law 105-206, other than this title, bracketed Title 6, parenthetical sections 6001 to 6024, in parent, of Public Law 105-206 in bracket, the provisions of this title, bracketed Title 6, shall be treated as having been enacted immediately before the provisions of such other titles. Election to recognize gain on assets held on January 1, 2001. Section 311E of Public Law 105-34, as amended Public Law 106-554, Section 1A7, bracketed Title 3, Section 314, parenthetical C in bracket, December 21, 2000, 114 Stat 2763, 2763A through 643, semicolon, Public Law 107-147, Title 4, Section 414A, March 9, 2002, 116 Stat 54, provided that, quote, for purposes of the Internal Revenue Code of 1986, bracketed this title, 1, quote, in general, a taxpayer other than a corporation may elect to treat A, any rateably tradable stock, parenthetical, which is a capital asset, held by such taxpayer on January 1, 2001, and not sold before the next business day after such date, as having been sold on such next business day for an amount equal to its closing market price on such next business day, parenthetical, and as having been required on such next business day for an amount equal to such closing market price, in parent, and B, any other capital asset or property used in the trade or business, parenthetical, as defined in Section 1231B of the Internal Revenue Code of 1986, bracketed Section 1231B of this title in bracket and parent, held by the taxpayer on January 1, 2001, as having been sold on such date for an amount equal to its fair market value on such date, parenthetical, and as having been reacquired on such date for an amount equal to such fair market value in parent. 2. Treatment of gain or loss. Any gain resulting from an election under paragraph 1 shall be treated as received or accrued on the date the asset is treated as sold under paragraph 1 and shall be included in gross income notwithstanding any provision of the Internal Revenue Code of 1986, bracketed this title. B. Any loss resulting from an election under paragraph 1 shall not be allowed for any taxable year. 3. Election. An election under paragraph 1 shall be made in such manner as the Secretary of the Treasury or his delegate may prescribe and shall specify the assets for which such election is made. Such an election, once made, with respect to any asset, shall be irrevocable. Such an election shall not apply to any asset which is disposed of, parenthetical, in a transaction in which gain or loss is recognized in whole or in part, in parent, before the close of the 1-year period beginning on the date that the asset would have been. Section 13201 D of Public Law 103-66 provided that, quote, 1, parenthetical 1, in general, at the election of the taxpayer, the additional 1993 taxes may be paid in 3 equal installments. Parenthetical 2, dates for paying installments. In the case of any tax payable in installments by reason of paragraph, parenthetical 1, quote, parenthetical capital A, the first installment shall be paid on or before the due date for the taxpayer's taxable year beginning in calendar year 1993. Parenthetical capital B, quote, the second installment shall be paid on or before the date 1 year after the date determined under subparagraph A, and parenthetical C, quote, the third installment shall be paid on or before the date 2 years after the date determined under said paragraph A. For purposes of the preceding sentence, the term due date means the date prescribed for filing the taxpayer's return determined without regard to extensions. Election to pay additional 1993 taxes in installments. Parenthetical 3. Quote, extension without interest. For purposes of Section 6601 of the Internal Revenue Code of 1986, bracketed Section 6601 of this title, in bracket, the date prescribed for the payment of any tax payable in installments under parenthetical 1 shall be determined with regard to the extension under parenthetical 1. Parenthetical 4 of election to pay additional 1993 taxes in installments. 4 additional 1993 taxes. A, in general, for the purposes of this subsection, bracketed this note, the term additional 1993 taxes means the excess of, parenthetical little I, the taxpayer's net Chapter 1 liability as shown on the taxpayer's return for the taxpayer's taxable year beginning in calendar year 1993 over, quote, parenthetical 2 little i's, the amount which would have been the taxpayer's net Chapter 1 liability for such taxable year if such liability had been determined using the rates which would have been in effect under Section 1 of the Internal Revenue Code of 1996, bracketed this section, for taxable years beginning in calendar year 1993, but for the amendments made by this section, bracketed amending this section, sections 41, 63, 68, 132, 151, 453, 513, 531, 541 of this title, and enacting this note in bracket, and section 13202, bracketed amending this section and sections 531 and 541 of this title in bracket, and such liability had otherwise been determined on the basis of the amounts shown on the taxpayer's return. Additional 1993 taxes, parenthetical capital B, quote, net Chapter 1 liability. For purposes of subparagraph A, the term net Chapter 1 liability means the liability for tax under Chapter 1 of the Internal Revenue Code of 1986, bracketed this chapter, determined, quote, parenthetical little I, after the application of any credit against such tax other than the credits under sections 31 and 34, bracketed sections 31 and 34 of this title, in bracket, and little 2 i's, parenthetical, quote, before crediting any payment of estimated tax for the taxable year. 5, and this is still under coordination of Subtitle G of Title 1 of Public Law 104-188 of other subtitles Title 1 of Public Law 104-188, and the election to pay additional 1993 taxes in installments. So additional 1993 taxes, parenthetical 5, quote, acceleration of payments. If the taxpayer does not pay any installment under this section, bracket, probably means the subsection, this subsection, which enacted this note in bracket, on or before the date prescribed for its payment, or if the Secretary of the Treasury or his delegate believes that the collection of any amount payable in installments under this section, bracketed, probably means this subsection, when enacted this note, which enacted this note. So we'll read that again. Probably means this subsection, which enacted this note, is in jeopardy. The Secretary shall immediately terminate the extension under paragraph 1, and the whole of the unpaid tax shall be paid on notice and demand from the Secretary. 6. Election on return. An election under paragraph 1 shall be made on the taxpayer's return for the taxpayer's taxable year beginning in calendar year 1993. 7. Quote, exception for estates and trust. This subsection, bracket, this note, shall not apply in the case of an estate or trust. Coordination of Subtitle H of Title 7 of Public Law 101-239 with other subtitles of Title 7 of Public Law 101-239. Section 7801, parenthetical B of Public Law 101-239, Title 7, December 19, 1989, 103 Stat 2406, provided that, quote, for purposes of applying the amendments made by any subtitle of this title, other than this subtitle, bracketed sections 7701 to 7743 of Public Law 101-239, in bracket, the provisions of this subtitle, sections 7801 to 7894 Public Law 101-239, in bracket, shall be treated as having been enacted immediately before the provisions of such other subtitles. Transitional rule for maximum capital gains rate. Section 302 Charlie, Public Law 99-514, which related to long-term capital gain on rights to royalties paid under leases and assignments, was repealed by Public Law 100-647, Title 1, Section 1003B1, November 10, 1988, 102 Stat 3382. Coordination of Title 18 of Public Law 99-514 with other titles of Public Law 99.
How are you enjoying page 143 of the tax code?
I got to tell you, I got really excited up here when I ran across this part here that said that this section and this application on acceleration of payments probably means this subsection.
Oh, that's a real curveball there.
Yeah.
Right.
So if the people that wrote the law don't even know if it means this section, then it probably makes a little extra burden.
Do you think it's maybe like a clever narrative twist? Right, it's like an unreliable narrator.
Yeah, it's worse than me reading this.
All right.
Absolutely. Perhaps we need more tax attorneys, more tax accountants.
Right, more accountants.
Yes. Where was I? Coordination of Subtitle H of Title 7, Public Law 101-239 with other subtitles of Title 7 of Public Law 101-239. We read that. Transitional rule for maximum capital gains rate. Coordination with other divisions. Public Law 99-509, Title 7, Section 8081, October 21, 1986, 100 Stat 1965, provided that, quote, nothing in any provision of this Act, bracketed Public Law 99-509, October 21, 1986, 100 Stat 1874, see tables for classification, in bracket, parenthetical, other than this title, bracketed Title 7 of Public Law 99-509, in bracket, shall be construed as 1, quote, imposing any act, parenthetical, or exempting any person or property from any tax. 2, quote, establishing any trust fund, or, quote, 3, authorizing amounts to be expended from any trust fund, end quote. Bracket, Senate concurring resolution 174, agreed to on October 18, 1986, provided, quote, that in the enrollment of the bill, H.R. 5300, to provide for reconciliation pursuant to Section 2 of the concurrent resolution on the budget for fiscal year 1987, the Clerk of the House of Representatives shall insert at the end of the section 8081 of the bill the following. Paragraph 3 shall not apply to any authorization made under Title IX of this Act, end quote. As a result of clerical error, the sentence which was inserted at the end of Section 8101 of the bill and appears at the end of Section 8101 of Public Law 99-509, 100 Stat 1967. Applicability of provisions of Superfund amendments and Reauthorization Act of 1986. Public Law 99-499, Title 5, Section 531, October 17, 1986, 100 Stat 1782, provided that, quote, notwithstanding any provision of this Act, bracket, Public Law 99-499, in bracket, not contained in this title, bracketed Title 5, Sections 501 to 531 of Public Law 99-499, in bracket, any provision of this Act, parenthetical, not contained in this title, which, 1, quote, imposes any tax, premium, or fee, 2, establishes any trust fund, or 3, authorizes amounts to be expended from any trust fund, shall have no force or effect. Elimination of 50-cent rounding errors. Section 101A of Public Law 97-448 provided that, quote, if any figure in any table, A, which is set forth in Section 1 of the Internal Revenue Code of 1954, parenthetical, as amended by Section 101 of the Economic Recovery Tax Act of 1981, bracketed Public Law 97-34, Title 1, Section 101, August 13, 1981, 95 Stat 176, in bracket and parent, and B, which applies to married individuals filing separately or to estates and trust, differs by not more than 50 cents from the correct amount under the formula used in construing such table. Such figure is hereby corrected to the correct amount, end quote. Bracketed, see 1983 amendments note under this section, in bracket. Policy with respect to additional tax reductions. Section 3, Public Law 95-600, provided that, quote, as a matter of national policy, the rate of growth in federal outlays, adjusted for inflation, should not exceed 1% per year between fiscal year 1979 and fiscal year 1983, semicolon. Federal outlays as a percentage of gross national product should decline to below 21% in fiscal year 1981, 20% in fiscal year 1982, and 19.5% in fiscal year 1983. And the federal budget should be balanced in fiscal years 1982 and 1983. If these conditions are met, there's a dark cloud over me now. If these conditions are met under the dark cloud, it is the intention that the tax writing committees of Congress, which will report legislation providing significant tax reductions for individuals to the extent that these tax reductions are justified in the light of prevailing and expected economic conditions, end quote. Effective date of certain definitions and designations. Public Law 94-455, Title 9, Section 1908, October 4, 1976, 90 Stat 1836, provided that, quote, for purposes of any amendment made by any provision of this Act, bracketed, see tables for classification, parenthetical, other than this title.
Florida Fair Tax Educational Association on our live chat would like to know how many pages so far?
144.
Thank you.
And the effective date of certain definitions and designations. Oh, and for those just joining or recently joining, we are in Title 26, Section 1 of the Internal Revenue Code, of which there are over 70,000 pages, and I don't know how many volumes there are, but this is exciting stuff. So I'm going to pick up where I left off. Unfortunately, there's no pictures. So. Effective date of certain definitions and designations. Public Law 94-455, Title 9, Section 1908, October 4, 1976, 90 Stat 1836, provided that, quote, for purposes of any amendment made by any provision of this Act, bracket, see tables for classification, parenthetical, other than this title, parenthetical 1, quote, which contains a term, the meaning of which is defined in or modified by any provision of this title, and parenthetical 2, quote, which has an effective date earlier than the effective date of the provision of this title defining or modifying such term, that definition or modification shall be considered to take effect as of such earlier effective date. Congressional Declaration relating to 1975 amendments. Public Law 94-164, Section 1A, December 23, 1975, 89 Stat 970, provided that, quote, parenthetical A, Congress is determined to continue the tax reduction for the first 6 months of 1976 in order to assure continued economic recovery. Parenthetical B, quote, Congress is also determined to continue to control spending levels in order to reduce the national deficit. Quote, parenthetical C, Congress reaffirms its commitments to the procedures established by the Congressional Budget and Impoundment Control Act of 1974, bracketed, see tables for classification of Public Law 93-344, July 12, 1974, 88 Stat 297 in bracket, under which it has already established a binding spending ceiling for the fiscal year 1976. Parenthetical D, quote, if the Congress adopts a continuation of the tax reduction provided by this Act, bracketed, see short title of 1975 amendments, note under this section in bracket, beyond June 30th, 1976, and if economic conditions warrant doing so, Congress shall provide, through the procedures in the Budget Act, bracketed Public Law 93-344 in bracket, for reductions in the level of spending in the fiscal year 1977 below what would otherwise occur, equal to any additional reduction in taxes, parenthetical, from the 1974 tax rate levels, provided for the fiscal year 1977, colon, provided, however, that nothing shall preclude the right of the Congress to pass a budget resolution containing a higher or lower expenditure figure if the Congress concludes that this is warranted by economic conditions or unforeseen circumstances, end quote. Congressional Declaration relating to 1964 amendments. Public Law 88-272, Section 1, February 26, 1964, 78 Stat 19, provided that, quote, it is the sense of Congress that the tax reduction provided by this Act, bracketed, see short title of 1964 amendments, note under this section in bracket, through stimulation of the economy, will, after a brief transitional period, raise, parenthetical rather than lower, revenues, and that such revenue increases should first be used to eliminate the deficits in the administrative budgets and then to reduce the public debt. To further the objective of obtaining balanced budgets in the near future, excuse me, Congress, by this action, recognizes the importance of taking all reasonable means to restrain government spending and urges the President to declare his accord with this objective, end quote. Cross-references are too many to mention. There's one for business income of certain exempt organizations, tax on certain distributions of low-cost articles, tax on unrelated business income of charitable trust, consumer price index defined as, in this section for purposes of, child welfare services, family preservation and support services, inflation percentage, C42 USCA section 629. Credits, business-related credits, refundable credits, both of those under 26 USCA section 38 et sec and 31 et sec, respectively. Deductions for individuals, additional itemized allowable, C26 USCA section 211 et sec, determination of marital status, itemized deductions, personal exemptions, standard deduction adjusted for inflation. See Title 26 USCA sections 211, 770.03, 161, 151, and 63 respectively. Definition of dependent. See section 26 USCA section 152. High taxed income to determine limitation on credit. See section USCA section 904. Surviving spouse. See section 26 USC section 2. Disclosure of returns and return information to persons having material interest. See section 26 USCA section 6103. Doubling of rates of tax on citizens and corporations of certain foreign countries. See 26 USC section 891. Effective change of rate of tax. See section USCA section 15. Election by individual to be subject to tax at corporate rates. See section USCA section 962. And these are all cross-references to this section. Election by taxpayer not to compute tax on return. See 26 USCA section 6014. Estates and trust. Deduction allowable for estate tax. See 26 USC section 691. Imposition of tax. See 26 USC section 641. Imposition of net income taxes by state on income derived from interstate commerce. See 15 USCA section 381 et sec. Treaty provisions. See 26 USCA section 894. Income tax collected at source. See 26 USCA section 3402. Interest on deferred tax amount of excess distribution from passive foreign investment company. See 26 USCA section 1291. Non-resident aliens. See 26 USC sections 2 and 871 et sec. Optional tax if adjusted gross income is less than $10,000. See 26 USCA section 3. Partners subject to income tax in individual capacities. See 26 USCA section 701. The rate of tax under Federal Insurance Contributions Act. See 26 USCA section 3101. Tax rates for Title II cases. See 26 USCA section 1398. Tax treatment of non-qualified withdrawals from capital construction funds. See 26 USCA section 7518. Taxation of designated settlement fund. See 26 USCA section 468B. I'm going to skip the law review and journal commentaries, of which there is about a page and a half. There are library references, about a half a page. And then there's some research references, such as, for example, 46 ALR, Federal 2nd Series 301, application of 16th Amendment to U.S. Constitution, taxation of specific types of income. And there are 1, 2, 3, 4, 5, 6 pages of references, for law review and journal commentaries. and then some notes. Notes of decisions. Citizens 2, Constitutionality 1, Corporate Rate 9, Heads of Household 7, Indians 3, Joint Returns Married Individuals 6, Married Individuals 4 to 6, Generally 4, Joint Returns 6, Same-Sex Marriage 5, Progressive Tax Rates 8, Same-Sex Marriage Married Individuals Unreported Income 10. 1. Constitutionality. No unconstitutional discrimination resulted from progressive rate feature of income tax imposed by Act October 3, 1913, parenthetical repealed, Stanton v. Baltic Mining Company, U.S. Mass 1916, 36, SCT 278, 240 U.S. 103, 60 LED 546. Progressive rate feature of Income Tax Act did not cause the tax to be a mere arbitrary abuse of power, wanting in due process of law. Burshaber v. Union Pacific, R Company, U.S. New York, 1916, 36 SCT 236, 240 U.S. 160, LED 493. See also TYE Realty Company v. Anderson, New York, 1916, 36 SCT 281, 240 U.S. 115, 60 LED 554. Tax Equity and Fiscal Responsibility Act of 1992, TEFRA, does not violate Originations Clause, Walthall v. USCA 9, parenthetical Alaska, 1997, 131 F.3D 1289 statutes, key 6. Subsections C and D of this section, which had the effect of requiring taxpayers to pay a higher income tax as a married couple than two single individuals with the same income, did not deprive taxpayers of any constitutional right. Drucker v. CIR CA2 1982 697 F.2D46, certiorari denied, 103 SCT 2429, 461 U.S. 957, 77 LED 2D 1316 Internal Revenue Key 3546. Although there exists a disparity in tax burden between married and unmarried individuals, by preventing married couples from taking advantage of lower combined rates applicable to unmarried taxpayers, overall legislation is rational and constitutionally acceptable. Mapes v. U.S., CTCL 1978, 576 F2D 896, 217 CTCL 115, certiorari denied, 99 Supreme Court 722, 439 U.S. 1046, 58 LED 2D 705 Internal Revenue Key 3546. Inequities asserted to adhere in, quote, marriage penalty provisions of this title, whereby higher tax rates are imposed on taxable income of married person whose spouse has significant income than on same taxable income of unmarried person, do not rise to level of constitutional violations of married taxpayers' rights. Barter v. U.S., CA7, parenthetical Indiana 1970, or IAD 1977, 550 F2D 1239, certiorari denied, 98 Supreme Court 725, 434 U.S. 1012, 54 LED 2D 755 Internal Revenue Key 3546. Taxing unearned income of a child at top marginal rate of parents do not violate child's substantive due process rights, even though none of assets used to create income had been transferred from child's parents, since only child's tax rate, not amount of tax, was determined by reference to parents' income. Butler v. U.S. ED MO 1992, 798 F Supplement 574, Constitutional Law Key 4149, Internal Revenue Key 3546. Requirement that earned income of child under age 14 who is at least one parent alive be taxed at top of marginal rate of his parents, regardless of source of assets generating income, does not violate equal protection, even though application of requirement to a minor taxpayer whose income did not result from any property transferred from his parents fell outside area of legislative concern. Application of the requirement to the taxpayer who received income from investments of funds received as a result of personal injuries did not rise to the level of a constitutional violation. Carlton, by and through Carlton, v. U.S. through IRS, ND Miss 1991, 789 F Sup 746, Constitutional Law Key 3105, Internal Revenue Key 3546. Income tax is applied by Internal Revenue Service, is legal and constitutional. U.S. v. Bartrug, Ed VA 1991, 777 U.S. v. Bartrug, EDVA 1991, 77 F Sup 1290, affirm 976 F.2D 727, certiorari denied, 113 Supreme Court 1659, 507 U.S. 1010, 123 LED 2D 278, Internal Revenue Key 3020. The income tax laws are not constitutionally defective because of the progressive tax rates, in that the poor are intentionally taxed at a lower rate than those with great incomes. Messina v. U.S., CTCL 1973, 202 CTCL 155, Internal Revenue Key 3546. Where petitioner in 1967 and 1968 concededly did not meet head of household requirements of this section that he maintained as his home household, which constituted principal place of abode of one or more of his children, and at close of 1967 was not unmarried when he had merely interlocutory divorce decree. In light of case law and legislative history, tax court rejected petitioner's contentions that physical occupancy test was unconstitutional as violative of due process clauses of USCA Constitutional Amendment 5, and that unavailability of head of household rates to married but separated persons was constitutionally impermissible legislative classification, and determined that this section was not unconstitutional, considering strong presumption of constitutionality in which revenue statute is clothed in deference that judiciary must generally show to legislative choices. Bayless v. Commissioner of Internal Revenue, U.S. Tax Court, 1973, 61 TC 394. Petitioner was not entitled to a refund of difference between, I gotta get to a stopping point here, was not entitled to a refund of difference between taxes computed under rates for single and married persons on ground that denial of income splitting benefit to single persons was unconstitutional since, one, there was no evidence Congress intended to penalize such persons, and two, geographic equalization of community and non-community state taxpayers and recognition of married persons' greater financial burden provided rational basis for legislative classification. Kellums v. Commissioner of Internal Revenue, U.S. Tax Court 1972, 58 Tax Court 556, affirmed 474 F.2D 1399, certiorari denied 94, Supreme Court 63, 414 U.S. 831, 38 LED 2D 66. Distinctions in tax code between married taxpayers and unmarried economic partners did not violate equal protection, since Congress had rational basis for adopting marital classifications to account for greater financial burdens of married taxpayers and to equalize treatment for those living in non-community property states. Whether policy considerations warranted narrowing gap between tax treatment of married taxpayers and homosexual and other non-married economic partners was for Congress to determine. Mueller v. CIR, U.S. Tax Court 2000, 2000 WL 371545, unreported, affirmed 2001 WL 522388, certiorari denied 122 Supreme Court 199, 534 U.S. 887 151 LED 2D 140, Constitutional Law Key 2525, Constitutional Law Key 3202, Internal Revenue Key 3546. And with that, I'm going to hand it off to Mr. Flores, who will tell you all about citizens, Indians, married couples, and more from Section 21.
That's the new one? Can we, like, set that up? Particularly while you guys are switching out.
I did what you did. We will be right back. We're going to swap out power supplies again.
Live.
Well, all right. Boys and girls, let's pick up on page 160. 2. Citizens. Yay! Federal tax code provision imposing income tax on all citizens of the United States was not limited to citizens who resided in District Columbia or territories of the United States, and thus income earned by a California resident was subject to federal taxation. Jibilian versus U.S. California Federal 2006 174 Fed 576 2006 WL 870 729 unreported internal revenue. 3. Indians. No language in Six Nation and J treaties implied exemption for Indians from federal income taxes. U.S. versus Brown, SD, Ohio, 1993. 824S sub 124 Indians. 4. Married individuals. Generally, discrepancies in tax rate structure based on marriage do not rise to the level of an impermissible interference with the fundamental right of marriage so as to require strict judicial scrutiny of taxing structure. Do not beep. Mapes versus U.S. CTCL 1978 576F 2D 896 217 CTCL 115 territory denied 99 SCT 722 439 US 1046 58 limited edition second version. Husband and wife with gross income were taxpayers obligated to file returns and thus were subject to penalty for failure to file proper returns. Buck versus U.S. SD New York, who was separated from wife under written separation agreement in 1964, but never legally separated under decree of divorce or separate maintenance, was not entitled to compute tax as unmarried individual under this section, since neither 71 and 215 of this title nor New York law with respect to separation agreements qualified taxpayer is unmarried for purpose of filing tax return. Donegan versus Commissioner of Internal Revenue, U.S. Tax Court, 1977. 5. Same-sex marriage, married individuals. Taxpayer was not eligible for married filing joint status with respect to years at issue, even though he was in a long-term committed relationship with his gay partner. And state in which he lived during years at issue did not recognize same-sex marriage. The we children. Taxpayer was not legally married for years at issue, nor did he file returns for those years. Merrill versus CIR, U.S. Tax Court 2009, unreported. Number 6, joint returns. Married individuals, where petitioner H timely filed income tax return for 1984, as well as automatic extensions for 1986 and 87, but never filed returns for 85 through 87. H did not respond to commissioners' informal communications and most formal communications, including court's orders to respond, until 2 days before trial. And at trial, H submitted purported copies of joint returns bearing W's purported signature and copies of altered checks supposedly used to pay taxes due, shown on his 1985 and 86 joint returns. Court determined alleged signature of W on returns was H's handwriting. H's testimony and evidence of filing were incredible. H fraudulently failed to file tax returns for 85 through 87, and H's deficiencies were to be calculated according to the tax table for married individuals filing separate returns. Bagby versus CIR, 1994. Purpose of Congress in allowing married couples to file joint returns was to create geographical equality in taxation so as to not discriminate against married taxpayers living in non-community property states. And that's Johnson versus U.S. 1976. Marital master did not abuse discretion by declining to require former wife to file joint income tax return with former husband. Husband had not made showing that joint return would result in significant savings. Wheaton and Dunberger versus Dunberger, New Hampshire, 1993. Child support. Taxpayer was entitled to calculate his income tax under rates applicable to married individuals filing joint returns, even though at time IRS prepared substitutes for returns and notices of deficiency. Taxpayer had not elected that status by filing joint return. Taxpayer alleged that the IRS used incorrect filing statutes and subsequently submitted joint forms to IRS, which IRS accepted as late returns. Adler versus CIR, U.S. Tax Court 2010. Unreported Internal Revenue. 7, heads of household. Yay! This section provides for reduced surtax rates to the head of a household who provides a principal place of abode for a child. And regulations were not required to be strictly construed against taxpayer because taxpayer's child was an adult. Reardon versus U.S. Internal Revenue. Where before his divorced taxpayer H made payments under oral agreement by W for her and their children's support, and H was divorced before end of taxable year in which W made charitable contributions from such funds, tax court determined H was not entitled to claim benefit of head of household income tax rate specified in subsection B of this section, since the facts taxpayer's household did not constitute principal place of abode for any of his children within meaning of section 2B1A of this title. Herring versus Commissioner of Internal Revenue, U.S. Tax Court, 1967. Taxpayer failed to show that his 2 children lived with him for more than 1.5 of the relevant tax year, and thus children were not qualifying children, and taxpayer was not entitled to head of household filing status on his income tax. Etchinger versus CIR, U.S. Tax, 2010. Unreported Internal Revenue. Taxpayer was entitled to head of household filing status. Taxpayer's child lived with taxpayer for more than 1/2 of tax year at issue. Child met age and self-support restrictions that were not in issue, and taxpayer was unmarried. Okay, Gator versus CIR, U.S. Tax, 2010. Taxpayer, father of a minor child who was divorced and whose ex-wife had legal and physical custody of child during tax year, failed to establish qualifying child or
qualifying relative status, precluding his claiming dependency exemption deduction, child tax credit, or head of household status. Taxpayer's only evidence of child's qualifying status was the taxpayer had paid child support of $1,872. Work with me, guys. Work with me. During the year, and that child had lived with taxpayer on weekends. I'll let you finish. And during summers, Irons versus CIR U.S. Tax Court 2009. Taxpayer who lived with girlfriend and her 2 children who were not related to taxpayer by blood, marriage, or adoption could not file as head of household based on children since taxpayer failed to show that he paid more than half of children's living expenses, and thus they were neither qualifying children nor qualifying relatives according to Internal Revenue Code's definitions. Marshall versus Commissioner of Internal Revenue, U.S. Tax Court 2008. Taxpayer was not entitled to claim head of household filing status, where he stipulated that his child did not live with him during the relevant tax year, and where taxpayer indicated on his Form 1040A that child did not live with him. Jordan versus CIR U.S. Tax 2006. Taxpayer did not qualify for head of household filing status as she failed to show that her home was her daughter's principal place of abode. As member of taxpayer's household for more than 1/2 of tax year, taxpayer paid 7 months of rent for her daughter's Hollywood premises, which, although stipulated to be for office space, also served as place of abode. Daughter testified that she succeeded in obtaining regular paid work as performer in Los Angeles area clubs. She would have stayed there indefinitely in order to pursue her career as a recording artist. And such testimony was inconsistent with taxpayer's position that her home in Irvine was daughter's principal place of abode, and that daughter's trips to Los Angeles and Hollywood premises were, quote, temporary absences due to special circumstances. Bernardo versus CIR U.S. Tax 2004. Taxpayer was entitled to a head of household filing status for a tax year for which she maintained her home as principal place of abode for dependent for more than half of tax year. Dale versus CIR. 8. Progressive tax rates. The federal income tax is based upon the fundamental principle that individuals should be taxed according to their ability to pay. Oh no. Dropped the Twinkie. That's what it is. It's a Twinkie. Now I'm professional again. Nine, corporate rate.
Liking the recent turn of events in the tax code. It had some family drama in there.
Yeah,
didn't it?
there's a lot going on in here. You guys really need to pay attention. There's a lot of, you're right, there's a lot of family stuff going on. Some of it hits close to home. And it might feel that way for a lot of other people. We got to get into it. It's going to get the words get bigger, so it's going to get a lot better.
All right, fair enough.
All right. Number 9, corporate rate. Unrelated business taxable income of an otherwise tax-exempt voluntary employees beneficiary association organized as a trust was required to be taxed at a rate applicable to trust, rather than at the corporate income tax rate. Although corporate tax rate generally applied to tax-exempt organizations, the trust rate specifically applied to such organizations which were set up as trusts. Treasury regulations applicable to trusts supported that determination. An association failed to prove that any other similarly situated trust was taxed at the corporate rate. Sherwin-Williams Company versus U.S. Ohio. Rehearing and bank denied. Federal income tax statutes have always made sharp distinctions between individuals and corporations with respect to the rate and other incidents of the tax. Equitable Trust Company versus Magruder, 1941. 10. Unreported income. Evidence indicated that taxpayer... 10. Unreported income. Listen up, kids. Evidence indicated that taxpayer, a cocaine dealer, did not have cash hoard from credit card advances prior to taxable years. Rather, he used proceeds from drug sales to make cash expenditures and cash bank deposits, which IRS thus promptly used to reconstruct his taxable income. Williams versus CIR, 2003. Section 2. Definitions and special rules. A. Definition of surviving spouse. 1. In general, for purposes of Section 1, the term surviving spouse means a taxpayer whose spouse died during either of his 2 taxable years immediately preceding the taxable year, and B, who maintains as his home a household which constitutes as a taxable year the principal place of abode. As a member of such household of a dependent who, 1, who within the meaning of Section 152 determined without regard to subsections B1, B2, and D1B thereof, is a son, stepson, daughter, or stepdaughter of the taxpayer, and 2, with respect to whom the taxpayer is entitled to a deduction for the taxable year under Section 151. For purposes of this paragraph, an individual shall be considered as maintaining a household only if over half of the cost of maintaining the household during the taxable year is furnished by such individual. 2. Limitations. Notwithstanding paragraph 1, for purposes of Section 1, a taxpayer shall not be considered to be a surviving spouse, A, if the taxpayer has remarried at any time before the close of the taxable year, or B, unless for the taxpayer's taxable year during which the spouse died, a joint return could have been made under the provisions of Section 6013 without regard to subsection A3 thereof. 3. Special rule where a deceased spouse was in missing status. If an individual was in missing status within the meaning of Section 6013F3 as a result of service in a combat zone as determined for purposes of Section 112, and if such individual remains in such status until a date referred to in subparagraph A or B, then for purposes of paragraph 1A, the date on which such individual died shall be treated as the earlier of the date determined under subparagraph A or the date determined under subparagraph B. A. The date on which the determination is made under Section 556 of Title 37 of the United States Code, or under Section 566 of Title 5 of such code, whichever is applicable, that such individual died while in such missing status, or B, except in the case of a combat zone designated for purposes of the Vietnam conflict. The date is which is 2 years after the date designated under Section 112 as the date of termination of combatant activities in that zone. B. Definition of head of household. 1. In general, for purposes of this subtitle, an individual shall be considered a head of a household if, and only if, such individual is not married at the close of the taxable year, is not a surviving spouse as defined in subsection A, and either A, maintains as his home a household which constitutes of more than one half of such taxable year, the principal place of abode as a member of such household of 1. A qualifying child of the individual as defined in Section 152C, determined without regard to Section 152E, but not if such child, 1. is married at the close of the taxpayer's taxable year, and 2. is not a dependent of such individual by reason of Section 152B2, or 152B3, or both, or 2, any other person who is dependent of the taxpayer if the taxpayer is entitled to a deduction for the taxable year for such person under Section 151, or B, maintains a household which constitutes for such taxable year the principal place of abode of the father or mother of the taxpayer if the taxpayer is entitled to a deduction for the taxable year for such father or mother under Section 151. For purposes of this paragraph, an individual shall be considered as maintaining a household only if over half of the cost of maintaining the household during the taxable year is furnished by such individual. 2. Determination of status. For purposes of this subsection, A, an individual who is legally separated from his spouse under the decree of divorce or separate maintenance shall not be considered as married. B, a taxpayer shall be considered not married at the close of his taxable year if at any time during the taxable year his spouse is a non-resident alien. And C, a taxpayer shall be considered as married at the close of his taxable year if his spouse, other than a spouse described in subparagraph B, died during the taxable year. 3. Limitations. Notwithstanding paragraph 1, for purposes of this subtitle, a taxpayer shall not be considered to be head of the household. A, if at any time during the taxable year he is a non-resident alien. Or B, by reason of an individual who would not be dependent for a taxable year but for 1. Subparagraph H of section 152D2 or 2. Paragraph 3 of section 152D. C. Certain married individuals living apart. For purposes of this part, an individual shall be treated as not married at the close of the taxable year if such individual is so treated under the provisions of section 7703B. D. Non-resident aliens. In the case of a non-resident alien individual, the taxes imposed by sections 1 and 55 shall apply only as provided by section 871 or 877. Gotcha. Cross-reference. Let's have some situationals, shall we? Taxpayer who lived with girlfriend, head of household. Taxpayer who lived with girlfriend and her 2 children who were not related to taxpayer by blood, marriage, or adoption could not file as head of household based on children, since taxpayer failed to show that he had paid more than half of children's living expenses, and thus they were neither qualifying children nor qualifying relatives, according to Internal Revenue Code's definitions. Marshall versus Commissioner of Internal Revenue. 2. Home, head of household. There must be physical occupancy by taxpayer to meet requirement of a home within provisions providing reduced tax rates for individual who maintains as his home a household which constitutes a principal place of abode as a member of such household of a dependent child of taxpayer. Bjorklund versus CIR. 1970. Word home means single home household of taxpayer, which is taxpayer's principal place of abode. Dwelling that taxpayer at least considers his most permanent residence. Place where he dwells that is located at his domicile. Family residence, which was occupied under divorce decree solely by W and minor son supported by H, but which was owned by H and maintained as to 1/2 of the cost, was not H's home to qualify him for head of household rates and returns filed for taxable years, applying ordinary meaning of word home as intended by Congress. Grace versus Commissioner of the Internal Revenue. Taxpayer was entitled to head of household filing status for years during which he was not married and maintained as her home a household in which at least one of her children lived for more than half of those years. Briseno versus CIR. 3. Principal place of abode, head of household. Taxpayer's apartment to which taxpayer's adult unmarried son returned 6 or 7 times annually for visits of up to 7 days was not principal place of abode of son, and taxpayer thus could not qualify as head of household based on his claim that apartment was son's principal place of abode. Where taxpayer's son spent greater portion of taxable year living in residence of taxpayer, but spent number of months in that year at college at another residence, taxpayer household was not son's principal place of abode, and taxpayer did not qualify as head of household. Taxpayer who maintained 2 homes, who paid more than 1/2 of the expenses of each home, and who maintained one of the homes for her adopted son who lived in it and used it as his principal place of abode, and as a member of that household was entitled to use head of household income tax rates, though such home was not her principal place of abode. That's Smith versus CIR 1964. Taxpayer was entitled to computation of his income tax as the head of household based on maintenance of principal abode of his mother, of whom he was the sole support, even though during such time she remained in either a hospital or nursing home with little likelihood of sufficient recovery from her illness to permit her to return to taxpayer's home, in which a room was kept intact for her. Bramer versus the U.S. 1961. That taxpayer's adult unmarried daughter had a place of abode in New York City from 1949 until October of 1952, where she spent a major portion of her time and was not determinative of question whether taxpayer's household constituted principal place of abode of daughter, so as to entitle taxpayer to reduce surtax rates as head of household for 1953 and 1954, since one may have two abodes. Reardon versus the U.S. Note 3. Where before his divorced taxpayer H made payments under oral agreement to W for her and their children's support, and H was divorced before the end of the taxable year, in which made H charitable contributions from such funds, tax court determined H was not entitled to claim benefit of head of household income tax rate, since taxpayer's household did not constitute principal place of abode for any of his children. Divorced father, who in 1967 maintained in his apartment room which son occupied not when away at school, was head of household since, irrespective of whether 1968 amendment giving father custody instead of mother was effective nunc pro tunc, father's household in 1967 was the principal place of abode of son who was expected to reside with father and not with mother because of hostility between them. Blair versus Commissioner of the IRS. Taxpayer did not qualify as head of the household in 1962 and 1964 through 65, since 1. The rule that taxpayer need not reside in abode furnished for dependent parents did not apply to dependent son's wife and their 2 children. Taxpayer was not temporarily absent from household maintained for them because he never lived with his son's family. Moreover, his fear of residing with mentally ill son was not type of special circumstances contemplated or treasury regulations as sufficient reason for temporary absence from common abode. And 3, dependents were not temporarily absent from the house taxpayer purchased in 1961 because taxpayer lived in hotel rooms and maintained a household at his home. Okay, with son. Williams versus Commissioner of Internal Revenue. This is getting good. We're halfway through the first book, you guys. Bear with me.
Out of. So you're a quarter of the way through the first out of that entire stack of books.
I described it the way the tax code would have described it. See where we are. Where taxpayer did not have legal custody of son whose actual residence was apart from taxpayers, tax court concluded that at no time during 1965 was taxpayer's household principal abode of son. Son's absence was not temporary absence due to special circumstances in light of termination of taxpayer's custody of son in 1963. Son's subsequent residence with mother in 1963 and part of 1964, and in school and in college in 1965, and 3 days that son spent in taxpayer's household during Christmas holidays constituted visit and did not, absent any other evidence, reestablish taxpayer's household as principal place of abode. So that taxpayer was not entitled to head of household status. Ruff versus Commissioner of the Internal Revenue. More? Okay.
Frequent evening and weekend visits of daughter, who usually lived with mother but occupied university dormitory room in city, in which divorced father maintained household for their occupancy when not traveling, as he did in course of his employment, did not make father's home's daughter's principal place of abode, and so did not qualify him to compute his tax as head of household. Teeling versus CIR. Taxpayer was entitled to benefits of allowing partial income splitting to unmarried individuals qualifying as head of households, notwithstanding that dependent whom he supported was confined in sanatorium with mental illness. That period of such confinement had been long, and that there was only a slight chance of recovery, since no new principal place of abode had been chosen, and taxpayer expected dependent to return to his household whenever she could leave the sanatorium. IRS failed to prove that taxpayer was not entitled to head of household status. Taxpayer was not married at close of taxable year. IRS did not show that taxpayer did not maintain as his home a household that constituted more than one half of taxable year principal place of abode of individual who qualified as taxpayer's dependent. Taxpayer claimed 2 dependents on his tax return. IRS reconstruction of taxpayer's income using source and application of funds method was based upon taxpayer having family of 3, and IRS did not show total cost of maintaining a household, or that payer did not provide over half that cost. Taxpayer was not entitled to head of household filing status or child tax credit at no time during relevant year did taxpayer have same principal place of abode as his sons, and none of his sons was qualifying child, as taxpayer failed to carry his burden of establishing total child support he provided during that year. Daniels versus CIR. Divorced father was not entitled to head of household filing status, as he did not maintain household that constituted his child's principal place of abode for more than one half of a taxable year. Taxpayer did not qualify for head of household filing status, as she failed to show that her home was her daughter's principal place of abode. As member of taxpayer's household for more than one half of tax year, taxpayer paid 7 months of rent for her daughter's Hollywood premises, which, although stipulated to be for office space, also served as a place of abode. Daughter testified that she had succeeded in obtaining regular paid work as a performer in Los Angeles area clubs, where she would have stayed there indefinitely in order to pursue a career as a recording artist, and such testimony was inconsistent with taxpayer's position that her home in Irvine was daughter's principal place of abode, and that daughter's trips to Los Angeles and Hollywood premises were temporary absences due to special circumstances. Taxpayer qualified for head of household filing status as she maintained her home as a principal place of abode for her daughter for more than one half of the taxable year, and furnished all household support during that year. Taxpayer was entitled to head of household filing status for tax year in which she maintained her home as principal place of abode for dependent for more than half of tax year. Number 4, the cost of maintaining household, head of household. In order to qualify for head of household status, it's not enough for the taxpayer to furnish total support for eligible dependents. It is also necessary that the taxpayer maintain as his home a household which constitutes the principal place of abode as a member of such household of the dependents. Roberts versus U.S. Where on face of return, taxpayer provided his mother with $1,020 in support, and mother had at least $1,290 in other support. Taxpayer did not provide his mother with over one half of her support, and was not entitled to count her as dependent, and she could not claim benefits of head of household rates. Where taxpayer provided over half her mother's support if certain third-party Medicaid payments for home nursing care were excluded and claimed her as dependent under Section 152A of this title, tax court determined taxpayer was entitled to head of household tax rates. Forgive me, I dropped the donut again. I'm just gonna keep calling this thing different things. I know you boys and girls at home are enjoying this. And if you're sitting watching and your parents are making you, that'll teach you to say your room's clean when it's not.
Does it say that in the tax code?
No, I'm thinking about my own family. It's horrible. On with the story. The IRS failed to prove that taxpayer was not entitled to head of household status. Taxpayer was not married at close of taxable year. IRS did not show that taxpayer did not maintain as his home a household that constituted more than one half of taxable year principal place of abode additional individual who qualified as taxpayer's dependent. Taxpayer claimed 2 dependents on his tax return. IRS reconstructed taxpayer's income using source and application of funds method was based on taxpayer having a family of 3, and the IRS did not show a total cost maintaining household, or that taxpayer did not provide over half of that cost. Where taxpayer provided over half of her mother's support, if certain third-party Medicaid payments were at home, skipping that one. Taxpayer who paid over half of costs of room or board for her parents in rest home in 1961 and for her father in boarding home in 1962 and 63 was entitled to compute his tax as head of household, giving word household its most favorable reasonable construction in keeping with congressional intent, but could not deduct such costs as medical expense, there being no evidence of any medical attention received by mother or any medical services provided by father, whose only infirmity during years was poor eyesight. Robinson versus the Commissioner. Male taxpayers' failure to substantiate either dollar amount of total support received by female companions to children during year in with taxpayer, companion, and children all lived in companion's father's mobile home, or dollar amount of support that taxpayer provided to children, precluded taxpayers taking dependency exemption deductions, assuming head of household status, and claiming child tax credits based on children. Nobles versus CIR. The taxpayer's proper filing status was married filing separately rather than head of household. Taxpayer was married at close of taxable year, and she could not be treated as unmarried as her children did not qualify as her dependents in that she did not provide over half of their support. Tooney versus CIR. Taxpayer was not entitled to head of household filing status based on theory that 2 separate households were maintained at a residence and taxpayer contributed more than one half of maintaining a household, since taxpayer identified no separate expenditures for support of individual members of household or for maintenance of 2 separate households, and nothing indicated that 2 separate households existed within the residence. Physical occupancy or presence, head of household. The fact that taxpayer owned and maintained home where his former wife and daughters resided during taxable years in question did not serve to qualify him as head of household within Section 1 of this title, providing reduced tax rates for heads of household where there was no evidence that taxpayer lived or otherwise maintained any presence in home during taxable years involved or ever intended to do so while his family lived there. Good stuff. Regulations stating that for taxpayer to qualify as head of household, taxpayer and other person must occupy household for an entire taxable year of taxpayer, go beyond statute if by verb occupy they require physical personal occupancy. That's Smith versus CIR. Under Section 1 of this title, making available reduced surtax rates to head of a household, main purpose was to provide relief for single persons who maintain household for benefit of and necessarily shared their income with certain other individuals. And Congress recognized that individuals sharing taxpayers' incomes and benefiting by taxpayers' maintenance of household will normally live in physical household, and that the situation to which relief was intended to be given might exist though the share of taxpayers' income was not actually present in taxpayers' household, provided absence thereof was not permanent, such as in the case of illness. Separation, head of household. As a matter of law, husband cannot qualify for head of household tax status when he and his wife occupy the same residence during a relevant tax period. Under New York law, taxpayer who is justified in leaving his wife might be regarded as legally separated from spouse, but was not legally separated under decree of divorce or separate maintenance, and he was therefore not a head of household. State court judgment of 1960, which did not order taxpayer to do or refrain from doing anything, and which did not order taxpayer to pay support to wife or to live separately from her, was not a decree of divorce or of separate maintenance, and did not entitle taxpayer to a head of household tax rates for calendar year 1960. Palmquist versus U.S. Taxpayer was not legally separated so as to be entitled to rates for head of household under decree of separate maintenance of Delaware Court of Chancery. Taxpayer was not entitled to head of household filing status absent evidence that he and his wife were legally separated at close of taxable year, or that he provided more than half of the cost of maintaining a household for his daughter. John Dahl versus CIR. Taxpayer was not entitled to filing status as head of household where he did not live separately from his estranged wife, since taxpayer was not considered married. His filing status was married filing separately. Yeah. Yeah. No. You'll see. Well, I'm gonna hand the mic.
That was a request we've already gotten. Start over, they just got here. Starting at $10,000 and working your way up. Right there. And now, we continue reading the United States Tax Code. 6. Separation, head of household. As a matter of law, husband cannot qualify for head of household tax status when he and his wife occupied same residence during relevant tax period. Leiden v. U.S. CA2, Connecticut, 1983, 721 F2D 873, certiorari denied, 104 SCT 2656 467 U.S. 1214, 81 LED 2D 363 rehearing denied, 105 SCT 2468 U.S. 1224, 82 LED 2D 915 Internal Revenue key. I've never seen a key before in text. Anyway, key 3549. Under New York law, a taxpayer who was justified in leaving his wife might be regarded as legally separated from spouse, but was not legally separated under decree of divorce or separate maintenance, and he was therefore not a head of a household. Wesman v. CIR, CA2, 1962-98, F2D, 527, Internal Revenue 3549. State court judgment in 1960, which did not order taxpayer to do or refrain from doing anything, and which did not order taxpayer to pay support to his wife or to live separately from her, was not a decree of divorce or separate maintenance, and did not entitle taxpayer to head of household tax rates for calendar year 1960. Palmquist v. United States. ND CAL 1967-284 F Supplement 577 Internal Revenue Key 3549. Taxpayer was not legally separated, so as to be entitled to rates for head of household under decree of separate maintenance of Delaware Court of Chancery, Rafal v. U.S., D.C., Dell 1967-267 F SUPP 61 Internal Revenue Key 3549. Taxpayer was not entitled to head of household filing status, absent evidence that he and his wife were legally separated at close of taxable year, or that he provided more than half the cost of maintaining household for his daughter. John 316. No. John Nadal v. CIR, U.S. Tax Court, 2005, WL 675-444, unreported. Internal Revenue 3549. Taxpayer was not entitled to filing status as head of household, where he did not live separately from his estranged wife. Since taxpayer was not considered unmarried, his filing status was married, filing separately. Chiosi v. CIR, U.S. Tax Court 2000 WL 349749, unreported. Internal Revenue 3549. 7. Residence, head of household. Taxpayer who obtained divorce from his wife for therapeutic reasons connected with her drinking habits, who thereafter lived at various hotels or with his brother, but who never established another residence and left his personal effects at a former home, where he also received his non-business mail, was head of household. Lariah v. U.S., D.C., Mass., 1964, 232, F. Supplement 602, Internal Revenue 3549. 8. Qualifying child, head of household. Taxpayer, father of minor child who was divorced and whose ex-wife had legal and physical custody of child during tax year, failed to establish qualifying child or qualifying relative status, precluding his claiming dependency, exemption deduction, child tax credit, or head of household status. Taxpayer's only evidence of child qualifying status was that taxpayer had paid child support of $1,872 during year, and that child had lived with taxpayer on weekends and during summer. Irons v. CIR, U.S. Tax Court 2009, 2009 WL 1324022, unreported. Internal Revenue 3300, Internal Revenue 3537, Internal Revenue 3552. Taxpayer qualified for head of household filing status. Taxpayer was not married. She maintained household because she furnished over half of cost of maintaining household, and her minor nieces with whom she resided were qualified children. Pavia v. CIR, U.S. Tax Court, 2008, WL 5100856, unreported. Internal Revenue 3549.
Gulp.
Taxpayer's minor cousin was not qualifying child for purpose of taxpayer's claim to head of household filing status. Felix v. CIR, U.S. Tax Court, 2008, WL 1722011, unreported. Internal Revenue 3549. 9. Custody of child, head of household. Where a taxpayer and wife were divorced, wife had custody of child and exclusive use and benefit of family residence, taxpayer spent substantial sums on upkeep of home and for upkeep of child, and taxpayer's only other contact with home, to which he was forbidden access, was legal title and intent to return to it in the future. Taxpayer did not qualify as head of the household. Grace v. CIR, CA5, Texas, 1969, 421 F2D 165, Internal Revenue. Taxpayer was not entitled to head of household filing status for income tax, since custody of his 3 children was with their mother, and children resided with her. Hughes v. CIR, U.S. Tax Court, 2000, WL424230, unreported, Internal Revenue 3549. Number 10, residence of child, head of household. Taxpayer did not qualify for head of household status, even though taxpayer was sole source of support for her daughter and grandchildren, where the daughter and grandchildren did not reside with taxpayer and taxpayer only visited, or resided temporarily with the daughter and grandchildren. Roberts v. U.S. ND Cal 1971 337 F Sup 1188 Internal Revenue 3549. Taxpayer failed to show that his two children lived with him for more than 1/2 of a relevant tax year, and thus children were not qualifying children, and taxpayer was not entitled to head of household filing status on his income tax. Eckinger v. CIR. U.S. Tax Court 2010. 2010 WL 2300 605 unreported Internal Revenue 3549. Taxpayer was not entitled to head of household filing status, where her children resided in home of their foster parents. Linton v. CIR, U.S. Tax Court 2003 WL 212-54884 Internal Revenue 3549. 11. Presence of child, head of household. Taxpayer was not entitled to claim head of household filing status, where he stipulated his child did not live with him during relevant tax year, and where taxpayer indicated on his Form 1040A the child did not live with him. Jordan v. CIR, U.S. Tax Court 2006 WL 122-8587. Unreported affirmed 226 Fed, approximately 15 2007 WL 1765113. Internal Revenue 3549. Taxpayer provided no evidence that his children live with him as required to qualify for head of household filing status. Castleton v. CIR, U.S. Tax Court 2005 WL 69761 unreported affirmed 188 Fed approximately 561 2006 WL 1750033 Internal Revenue 3549. Dependency, head of household 12. Taxpayer was not entitled to claim head of household filing status as taxpayer failed to establish she was entitled to dependency exemption deduction with respect to her minor granddaughter, and that granddaughter was her qualifying child. Horsley v. CIR, U.S. Tax Court 2009 WL 513417 unreported Internal Revenue 3549. Taxpayer failed to show her entitlement to head of household status or dependency exemption deductions and earn income tax credits as she claimed on her returns. Taxpayer admitted she received support from father of children she claimed on her returns whenever it was needed. She failed to establish by introduction of credible evidence that any children she claimed on her returns with respect to dependency exemption deductions and earned income credits were her children, and that children she claimed resided with her during years in issue. She failed to establish amount of support she contributed for such children, total cost of maintaining household, and part of such costs contributed by her for years in issue. Smith v. CIR, U.S. Tax Court 2008 WL 4500-300 unreported Internal Revenue 3297. Internal Revenue 3532, Internal Revenue 3549. Based on taxpayers' entitlement to dependency exemptions for his children, he was entitled to claim head of household filing status. Mayer v. CIR, U.S. Tax Court 2003 WL 1562152 unreported Internal Revenue 3549. And ladies and gentlemen, I am proud to announce we have made it to Title 26, Section 3. Tax tables for individuals. Imposition of tax table tax. In general, in lieu of the tax imposed by Section 1, there is hereby imposed for each taxable year on the taxable income of every individual, A, who does not itemize his deduction for the taxable year, and B, whose taxable income for such taxable year does not exceed the ceiling amount. A tax determined under tables applicable to such taxable year, which shall be prescribed by the Secretary, and which shall be in such form as he determines appropriate. In the table so prescribed, the amount of the tax shall be computed on the basis of the rates prescribed by Section 1. 2. Ceiling amount defined. For purpose of paragraph 1, the term ceiling amount means, with respect to any taxpayer, the amount not less than 20 grand, determined by the Secretary for the tax rate category in which such taxpayer falls. 3. Authority to prescribe tables for taxpayers who itemize deductions. I wish there was a section in the tax code that told you how to hold this canopy in place. The Secretary may provide that this section, that this section shall apply also for any taxable year to individuals who itemize their deductions. Any tables prescribed in the preceding sentence shall be on the basis of taxable income. B. Section inapplicable to certain individuals. This section shall not apply to 1. Individual making a return under Section 443A1 for a period of less than 12 months on account of a change in annual accounting period, and 2. An estate or trust. C. Tax treated as imposed by Section 1. For purposes of this title, the tax imposed by this section shall be treated as tax imposed by Section 1. D. Taxable income. Whenever it is necessary to determine the taxable income of an individual to whom this section applies, taxable income shall be determined under Section 63. And then we have loads of statutory notes, and cross-references, and library references. 4. Repealed. Public Law 94-455, Title 5, Section 501B1, October 4th, 1976, 90 Stat, 1558. 5. Section 5. Wow. Cross-references relating to tax on individuals. A. Other rates on tax on individuals, etc. 1. For rates of tax on non-resident aliens, see Section 871. 2. For doubling of tax on citizens of certain foreign countries, see Section 891. 3. For rate of withholding in the case of non-resident aliens, see Section 1441. 4. For alternative minimum tax, see Section 55. B. Special limitations on tax. 1. For limitation on tax in case of income in members of armed forces, astronauts, and victims of certain terrorist attacks on death, see Section 692. 2. For computation of tax where a taxpayer restores substantial amount held under claim of right, see Section 1341. Part 2. Tax on corporations. Section 11. Tax imposed. Section 12. Cross-references related to tax on corporations. 11. Tax imposed. A. Corporations in general. A tax is hereby imposed for each taxable year on the taxable income of every corporation. B. Amount of tax. 1. In general. The amount of tax imposed by subsection A shall be the sum of A. 15% of so much of the taxable income as does not exceed $50,000. B. 25% of so much of the taxable income as exceeds $50,000 but does not exceed $75,000. C. 34% of so much of the taxable income as exceeds $75,000 but does not exceed $10 million. And D. 35% of so much of the taxable income as exceeds $10 million. In the case of a corporation who has taxable income in excess of $100,000 for any taxable year, the amount of tax determined under the preceding sentence for such taxable year shall be increased by the lesser of I. 5% of such excess, or 2, or I, 2, double I. 11,750. In the case of a corporation who has taxable income in excess of $15 million, the amount of tax determined under the foregoing provisions of this paragraph shall be increased by an additional amount equal to the lesser of I, 3% of such excess, or double I, 100,000. 2. Certain personal service corporations not eligible for graduated rates. Notwithstanding paragraph 1, the amount of the tax imposed by subsection A on the taxable income of a qualified personal service corporation, as defined in section 448D2, shall be equal to 35% of the taxable income. C. Exceptions. Subsection A shall not apply to a corporation subject to a tax imposed by 1. Section 594, related to mutual savings banks conducting life insurance business. 2. Subchapter L, Section 801 and following, related to insurance companies. Or 3. Subchapter M, Section 851 and following, related to regulated investment companies and real estate investment trusts. D. Foreign corporations. In the case of a foreign corporation, the taxes imposed by subsection A and Section 55 shall apply only as provided by Section 882. Lots of statutory notes. Decision notes. Credits 3. Dissolution of corporation 2. Personal Service Corporation, 1. Surtax, 4. 1. Personal Service Corporation. Temporary regulation which included land surveying within the field of engineering services implemented congressional mandate in reasonable manner and was not arbitrary or capricious, and Tennessee Corporation, which performed only land surveying, was thus qualified personal service corporation subject to flat 35% income tax rate. Although surveyors and engineers were subject to different licensing regimes in Tennessee. Although statute would list engineering as a qualifying personal service field, did not define engineering. Congress report showed that Congress intended surveying to be treated as an engineering service for purpose of qualified personal service corporation function test. Land surveying was within ordinary dictionary meaning of engineering. Publications of National Engineering Society included surveying within practice of civil engineering. There is no evidence that Congress intended a continued definition of engineering on different licensing standards states might adopt. Kratz and Craig, Surveying Inc. versus CIR, U.S. Tax Court 2010-2010, WL 146-0066, unreported internal revenue 3545, internal revenue 3547. Taxpayer, a professional medical corporation that provided radiation therapy for cancer patients, employed persons who rendered services in field of health, as required to satisfy function test for a taxpayer's qualified personal service corporation status. Taxpayer's field was not creation and containment of radiation. WWURMD Inc. versus CIR, U.S. Tax Court 2007-2007, WL 145-1975, unreported internal revenue 3545. Employee-owned corporate taxpayer that employed individuals to provide tax return preparation and bookkeeping services performed accounting services, and thus was qualified personal service corporation within meaning of statutory provisions setting flat 35% income tax rate for such entities. Even though taxpayer employed no certified public accountants, CPAs, and did not perform services which are restricted under state law to CPAs, statutory field of accounting was not limited to public accounting and historically comprised tax return preparation and bookkeeping. Rainbow Tax Service Inc., VCIR, U.S. Tax Court 2007, 128 TC 42 2007, WL 701-597, unreported internal revenue 3545. Subchapter C, corporations changed from one furnishing both accounting and financial consulting services to one which performed only accounting services, a result of spin-off of limited liability company to do financial accounting work. Did not render corporation a qualified personal services corporation, QPSC, subject to flat 35% income tax rate. Corporation remained outside regulations QPSC criterion. 95% or more of the time spent by employees serving in their capacity as such is devoted to qualifying field, since LLC's employees drawn from corporations continued to have their wages, benefits, and employment tax paid by corporations after spinoff and thus remain employees of corporation. Ron Likens Inc. v. CIR, U.S. Tax Court 2006, WL 509-546, unreported internal revenue 3545. Corporation which performs services of engineering and of geotechnical testing was not subject to flat tax for personal service corporation in field of engineering, since taxpayers' geotechnical testing services were separate and distinct from its engineering services, were more than 5% of a corporation's services, and were not incidental to engineering services. Essence of engineering services was an application of mathematical, physical, and engineering sciences to services or projects, such as consultation, investigation, evaluation, planning, design, and review of structures and buildings, while geotechnical testing would not require same education, training, and mastery as engineering, and data from testing could be used in engineering analysis for other purposes by other parties. Alron Engineering Testing Corps v. CIR, U.S. Tax Court 2000 WL 1635404. 2. Dissolution of corporation. The liability of a corporation for income tax cannot be discharged by the expedient of dissolution and the turning over of all its assets, including current and unreported income, to its sole stockholder. Though such corporation receives no money consideration for the transfer of such income, since it is the actuality of income rather than the disposition that is important in determining the tax consequence. Judd Plumbing and Heating v. CIR, CCA 5, Texas 1946 153 F2D 681, internal revenue 3620. 3. Credits. Tax credits have no effect on taxable income or on tax calculated according to basic corporate tax provision of Internal Revenue Code, Berkshire Hathaway Inc., VUS, CA, Fed, 1986, 802 F2D, 429, Internal Revenue 3520. 4. Surtax. In absence of demonstration of overwhelming need for risk minimization by organization of several corporations for subdivisions and construction of houses, risk minimization was not sufficiently persuasive to overcome substantial evidence indicating that chief motivation was to obtain multiple surtax exemptions so as to render corporations liable for surtax. House Beautiful Homes Inc., VCIR CA 10 1968 405 F2D 61, Internal Revenue 3845. Inaction by 18 corporations for refund of income taxes. Evidence supported Commissioner's conclusion that each of the 3 geographical groups of corporations was in effect conducted as a single integrated warehouse business, and such evidence, together with evidence of the income of each corporation, in many instances what held a critical maximum of 25,000 surtax exemption, failed to sustain corporation's burden of proof that tax avoidance was not principal purpose of acquisition of corporation, and Commissioner properly allowed only one surtax exemption to each of the 3 groups. Atlas Storage Company, VUS, SD, West Virginia, 1969, 306, F sub, 570, affirm, 437, F2D, 1319, Internal Revenue 3634. 12. Cross references relating to tax on corporations. 1. For tax on the unrelated business income of certain charitable and other corporations exempt from tax under this chapter, see section 511. 2. For accumulated earning tax and personal holding company tax, see parts 1 and 2 of subchapter G, section 531 and following. 3. For doubling of tax on corporations of certain foreign countries, see section 891. 4. For alternative tax in case of capital gains, see section 1201A. 5. For rate of withholding in case of foreign corporations, see section 1442. 6. For limitation on benefits, a graduated rate schedule provided in section 11B, see section 1551. 7. For alternative minimum tax, see section 55. 15. Effective changes. A. General rule. If any rate of tax imposed by this chapter changes, and if the taxable year includes the effective date of the change, unless that date is the first day of the taxable year, then 1. Tentative taxes shall be computed by applying the rate for the period before the effective date of the change and the rate for the period on and after such date to the taxable income for the entire taxable year, and 2. The tax for such taxable year shall be in the sum of that proportion of each tentative tax which the number of days in each period bears to the number of days in the entire taxable year. B. Repeal of tax. Sounds like a crazy concept. For purposes of subsection A, 1. If a tax is repealed, and the repeal shall be considered a change of rate, and 2. The rate for the period after the repeal shall be 0. C. Effective date of change. For purposes of subsection A and B, if the rate changes for taxable years beginning after or ending after a certain date, the following day shall be considered the effective date of the change. And 2, if a rate changes for taxable years beginning on or after a certain date, that date shall be considered the effective date of the change. D. Section not to apply to inflation adjustments. This section shall not apply to any change in rates under subsection F of section 1 related to adjustments in tax tables so that inflation will not result in tax increases. E. References to highest rate. If the change referred to in subsection A involves a change in the highest rate of tax imposed by section 1 or 11B, any reference in this chapter to such highest rate, other than in a provision imposing a tax by reference to such rate, shall be treated as a reference to the weighted average of the highest rates before and after the change determined on the basis of the respective portions of the taxable year before the date of the change and on or after the date of the change. F. Rate reductions enacted by the Economic Growth and Tax Relief Reconciliation Act of 2001. This section shall not apply to any change in rates under subsection I of section 1 related to rate reductions after 2000. Holy America. Part 4, credits against tax. Subpart A, non-refundable personal credits. Subpart B, other credits. Subpart C, refundable credits. Subpart D, business-related credits. E, rules for computing investment credit. F, rules for computing work opportunity credit. G, credit against regular tax for prior year minimum tax liability. H, non-refundable credit to holders of clean renewable energy bonds. I, qualified tax credit bonds. J, Build America bonds. Section 21, or Subpart A, non-refundable personal credits. Section 21. Expenses for household and dependent care services necessary for gainful employment. A. Allowance of credit. 1. In general, in case of an individual for which there are one or more qualifying individuals, as defined in subsection B1, with respect to such individual, there shall be allowed as a credit against the tax imposed by this chapter for the taxable year an amount equal to the applicable percentage of the employment-related expenses as defined in subsection B2, paid by such individual during the taxable year. 2. Applicable percentage defined. For purposes of paragraph 1, the term applicable percentage means 35% reduced but not below 20% by 1 percentage point for each 2,000 or fraction thereof by which the taxpayer's adjusted gross income for the taxable year exceeds 15,000. B. Definitions of qualifying individual and employment-related expenses. For the purposes of this section, 1. The term or qualifying individual. The term qualifying individual means A. A dependent of the taxpayer as defined in section 152A1 who has not attained age 13. B. A dependent of the taxpayer as defined in section 152 determined without regard to subsections B1, B2, and D1B, who is physically or mentally incapable of caring for himself or herself, and who has the same principal place of abode as the taxpayer for more than 1/2 of such taxable year. Or C. The spouse of the taxpayer, if the spouse is physically or mentally incapable of caring for himself or herself, and who has the same principal place of abode as the taxpayer for more than 1/2 of such taxable year. 2. Employment-related general expenses. A. In general, the term employment-related expenses means amounts paid for the following expenses, but only if such expenses are incurred to enable the taxpayer to be gainfully employed for any period for which there are one or more qualifying individuals with respect to taxpayer. I do solemnly swear that I will never do this again. Expenses for household services. And 2. Expenses for the care of a qualifying individual. Such term shall not include any amount paid for services outside the taxpayer's household at a camp where the qualifying individual stays overnight. This does not apply to concentration camps. B. Exception. Employment-related expenses described in subparagraph A, which are incurred for services outside the taxpayer's household.
Does this experiment count as a camp?
I think I'm being unlawfully detained.
You are not free to leave. Do you have...
This is an undue burden.
Do you have sunscreen because you're sunburning?
I'm burning for you, the taxpayer.
I look forward to going back through this video in fast motion and watching your face turn red. Continue, please. From page 207. Wow.
We're rolling. Okay. B exception. That now this may come with further commentary because I'm losing my patience with this thing. Employment-related expenses described in subparagraph A, which are incurred for services outside the taxpayer's household, shall be taken into account only if incurred for the care of I. A qualifying individual described in paragraph 1A, or II. A qualifying individual not described in paragraph 1A who regularly spends at least 8 hours each day in the taxpayer's household. C. Dependent care centers. Employment-related expenses described in subparagraph A, which are incurred for services provided outside the taxpayer's household by a dependent care center, as defined in subparagraph D, shall be taken into account only if Such a center complies with all applicable laws and regulations of a state or unit of local government. And I, the requirements of subparagraph B are met. D, dependent care center defined. For the purposes of this paragraph, the term dependent care center means any facility which I, provides care for more than 6 individuals other than individuals who reside at the facility, and I, receives a fee, payment, or a grant for providing services for any of the individuals, regardless of whether such facility is operated for profit, and I, provides care for those forced to read tax code on tax day. Not really. But C, dollar amount on amount creditable. The amount of employment-related expenses incurred during any taxable year, which may be taken into account under subsection A, shall not exceed 1, $3,000 if there is one qualifying individual with respect to the taxpayer for such taxable year, or 2, $6,000 if there are 2 or more qualifying individuals with respect to the taxpayer for such taxable year. D, earned income limitation. 1, in general, except as otherwise provided in this subsection, the amount of the employment-related expenses incurred during any taxable year which may be taken into account under subsection A shall not exceed A. In the case of an individual who is not married at the close of such year, such individual's earned income for such year, or B. In the case of an individual who is married at the close of such year, the lesser of such individual's earned income, or the earned income of his spouse for such year. 2. Special rule for special people. For spouse who is student or incapable of caring for himself. In the case of a spouse who is a student or qualifying individual, described in subsection B1C, for purposes of paragraph 1, such spouse shall be deemed for each month during which such spouse is a full-time student at an educational institution, or is such a qualifying individual, to be gainfully employed and to have earned income of not less than A, $250 if subsection C1 applies for the taxable year, or B, $500 if subsection C2 applies for the taxable year. In the case of any husband and wife, this paragraph shall apply with respect to only one spouse for only 1 month. E, special rules. For purposes of this section, 1, place of abode. An individual shall not be treated as having the same principal place of abode of the taxpayer if at any time during the taxable year of the taxpayer the relationship between the individual and taxpayer is in violation of local law. Interesting. 2, married couples must file joint return. If the taxpayer is married at the close of the taxable year, the credit shall be allowed under subsection A only if the taxpayer and his spouse file a joint return for the taxable year. 3, marital status. An individual legally separated from his spouse under decree of divorce or of separate maintenance shall not be considered as married. 4, certain married individuals living apart. If A, an individual who is married and files a separate return, I, maintains as his home and household which constitutes for more than 1/2 of the taxable year the principal place of abode of a qualifying individual, and I, furnishes over half of the cost of maintaining such household during the taxable year, and B, during the last 6 months of such taxable year, such individual's spouse is not a member of such household. Such individual shall not be considered as married. 5, special dependency test in case of divorced parents, etc. If A, section 152E applies to any child with respect to any calendar year, and B, such child is under the age of 13 or is physically or mentally incapable of caring for himself. In the case of any taxable year, beginning in such calendar year, such child shall be treated as a qualifying individual described in subparagraph A or B of subsection B1, whichever is appropriate with respect to the custodial parent as defined in section 152E4A, and shall not be treated as a qualifying individual with respect to the non-custodial parent. 6, payments to related individuals. No credit shall be allowed under subsection A for any amount paid by the taxpayer to an individual. A, with respect to whom for the taxable year, a deduction under section 151C, related deduction personal exemptions or for dependents, is allowable either to the taxpayer or his spouse, or B, who is a child of the taxpayer, within the meaning of section 152F1, who has not attained the age of 19 at the close of the taxable year. For purposes of this paragraph, the term taxable year means the taxable year of the taxpayer in which the service is performed. 7. The term student means an individual who during each of the 5 calendar months during the taxable year is a full-time student at an educational organization. 8. Educational organization. The term educational organization means an educational organization, which is great circular logic, described in section 17B1A II. 9. Identifying information required with respect to service provider. No credit shall be allowed under subsection A for any amount paid to any person unless A. The name, address, and taxpayer identification number of such person are included on the return claiming the credit. B. If such person is an organization described in section 501c3 and exempt from tax under section 501a, the name of the person of such and address of such person are included on the return claiming the credit. Or C. If they fraudulently get a hold of your taxpayer identification number and file your return for you. I mean, it's not really in there, but that's okay. In the case of failure to provide the information required in the preceding sentence, the preceding sentence shall not apply if it is shown the taxpayer exercised due diligence in attempting to provide the information so required. 10. Identifying information required with respect to qualifying individuals. No credit shall be allowed under this section with respect to any qualifying individual, unless the TIN of such individual is included on the return claiming the credit. F. Regulations. The Secretary shall prescribe such regulations as may be necessary to carry out the purposes of this section, because it isn't actually complicated enough. Notes of decisions. 1. Constitutionality. Taxpayer was not entitled to claim children living with her as dependents because of H's payments under divorce decree, could not deduct under former section 214 of this title expenses for child care, which enabled her to be employed in 1973. Since children were not qualifying individuals under former section 214 of this title, and legislative establishment of class of individuals entitled to child care deduction under predecessor of this section and limiting such class to individuals entitled to dependency exemption was not unconstitutional. Classification violated of USCA Constitutional Amendment 5 Due Process Clause. Keeler v. Commissioner of Internal Revenue, U.S. Tax Court, 1978. Got a few more left. I have to know what qualifying person means. Tax court determined former section 214 of this title as amended and in effect in 1972 and 1973 did not constitute unconstitutional discrimination on basis of marital status, sex, or interference with family relations in violation of Due Process Clause, U.S. Constitution, Amendment 5. Namack v. Commissioner. I have to note, we're on page 218, and they finally mentioned the Constitution.
That's nice.
Good start. Denied Constitution unconstitutional intrusion to free exercise of religion prohibited by Amendment 1 of the Constitution. Black v. Commissioner of Internal Revenue, U.S. Tax Court, 1977, 69, TC 505. 2. Employment-related expenses. Where in 1977 to 78, taxpayer was employed as an accountant, which required her absence from home approximately 55 hours per week, and taxpayer's 11-year-old son was qualifying individual under former section 44A of this title. The tax court determined one entire $1,000 8-week summer camp expense qualified an employment-related expense within meaning of such former section. Since sending son to camp enabled taxpayer to work and her primary concern was his protection and well-being. 2. Sending son on school trip to Washington, D.C. during Easter vacation enabled taxpayer to be gainfully employed and was motivated by her concern for his well-being and protection, but substantial portion of $116 cost was for educational aspect of trip, which did not qualify under former section, and $350 paid to daughter for 8 weeks care of son in France did not qualify under former section, since taxpayer failed to prove services for which money was paid constituted employment within meaning of 3121B of this title. Zoltan v. Commissioner of Internal Revenue, U.S. Tax Court, 1982, 79, TC 490, ACQ in result. 3. Children. Non-custodial parent was not entitled to child care credit since his child did not live with him. Meyer v. CIR, U.S. Tax Court, 2003-2003, WL 118258, unreported Internal Revenue, Section 3534. Section number 22. Credit for the elderly and permanently and totally disabled. A. General rule. In the case of a qualified individual, there shall be allowed as a credit against the tax imposed by this chapter for the taxable year an amount equal to 15% of such individual's Section 22 amount for such taxable year. B. Qualified individual. For purposes of this section, the term qualified individual means any individual who 1. Who hasn't attained age 65 before the close of the taxable year. 2. Who retired in disability before the close of the taxable year and who, when he retired, was permanently and totally disabled. Sorry, women, you can't qualify for that section. C. Section 22 amount. For purposes of subsection A, 1. In general, an individual's Section 22 amount for the taxable year shall be the applicable initial amount determined under paragraph 2, reduced as provided in paragraph 3 and in subsection D. 2. Initial amount. A. In general, except as provided in paragraph B, subparagraph B, the initial amount shall be I. $5,000 in case of a single individual or joint return where only one spouse is a qualified individual. 2. $7,500 in the case of a joint return where both spouses are qualified individuals. Or 3. $3,750 in case of a married individual jointly filing a separate return. B. Limitation in case of individuals who have not attained age 65. I. In general, in the case of a qualified individual who has not attained age 65 before the close of the taxable year, except as provided in clause 2, the initial amount shall not exceed the disability income for the taxable year. I. Special rules in case of joint return. In the case of a joint return where both spouses are qualified individuals and at least one spouse has not attained age 65 before the close of the taxable year, if both spouses have not attained age 65 before the close of the taxable year, the initial amount shall not exceed the sum of such spouse's disability income. 2. If one spouse has attained age 65 before he finishes reading the tax code, or before the close of the taxable year, the initial amount shall not exceed the sum of $5,000 plus the disability income for the taxable year of the spouse who has not attained age 65 before they are done reading the tax code or before the close of the taxable year. You can guess which part of that's actually in the tax code. I. Disability income. For purposes of this subparagraph, the term disability income means the aggregate amount includable in the gross income of the individual for the taxable year under Section 72 or 105A to the extent such amount constitutes wages or payments in lieu of wages for the period during which the individual is absent from work on account of permanent and total disability. 3. Reduction. A. In general, the reduction under this paragraph is an amount equal to the sum of the amounts received by the individual, or in the case of the joint return by his or spouse, as a pension or annuity, or as a disability benefit. I. Which is excluded from gross income and payable under I. 3AI1. Title II of the Social Security Act, 3AI2. The Railroad Retirement Act 1974, or 3AI3, a law administered by the Veterans Administration, or II, which is excluded from the gross income under any provision of law not included in this title. No reduction shall be made under clause I, III, for any amount described in section 104A4. B. Treatment of certain workmen's compensation benefits. For purpose of subparagraph A, any amount treated as a Social Security benefit under section 86D3 shall be treated as a disability benefit received under Title II of the Social Security Act. D. Adjusted gross income limitation. If the adjusted gross income of the taxpayer exceeds 1. $7,500 in case of a single individual, 2. $10,000 in case of a joint return, or 3. $5,000 in case of a married individual filing a separate return. The Section 22 amount shall be reduced by 1/2 of the excess of the adjusted gross income over $7,500, $10,000, or $5,000 as the case may be. E. Definitions and special rules. For purposes of this section, 1. Married couple must file joint return. except in the case of a husband and wife who live apart at all times during the taxable year. If the taxpayer is married, at the close of the taxable year, the credit provided by this section shall be allowed only if the taxpayer and his spouse file a joint return for the taxable year. 2. Marital status. Marital status shall be determined under Section 7703. 3. Permanent and total disability defined. An individual is permanently and totally disabled if he is unable to engage in any substantial gainful activity by reason of any medically determinable physical or mental impairment, which can be expected to result in death, or which has lasted and can be expected to last for a continuous period of not less than 12 months. An individual shall not be considered to be permanently and totally disabled unless she furnishes proof of the existence thereof in such form and manner at such time as the Secretary may require. You mind sliding me another water?
Yeah.
Non-resident alien ineligible for credit. No credit shall be allowed under this section to any non-resident alien. Thank you, sir. Notes of decisions. Indeed. Just got asked if we were still reading. I don't want to think about our answer to that question. Civil service benefits. 3. Community property. 2. Constitutionality. 1. Disability income. 4. Qualifying child. 6. Sick pay exclusion. 5. 1. Constitutionality. Tax treatment distinction between Social Security benefits and civil service retirement benefits was not arbitrary or capricious and was not repugnant to the Fifth Amendment of the Constitution. Heard v. CIR, CA 8, Missouri, 1964, 326 F2D 962, certiorari denied 84S Court, 1884, 377 U.S. 97812, LED 2D 746, Constitutional Law 4149. In computing retirement income credit under this section for husband and wife filing joint return, in community property state, portion of wife's retirement income taken into account should be reduced to reflect earned community income she derived from husband's earnings, which was in such substantial amount that no retirement income credit was allowable. And although computation resulted in different treatment of taxpayers in community property states, inconsistency did not violate USCA Article 6, Amendment 14, Gant v. CIR, Tax Court 1966, 46 TC 290. 2. Community property. Where a taxpayer who had enlisted in the Army in 1914, while domiciled in Ohio, moved with his wife to Arizona in February 1944 and on retirement in November 1944 after 30 years active duty, became entitled to retirement pay. Taxpayer and wife remained in Arizona thereafter. Taxpayer and wife established domicile in Arizona in February 1944. And taxpayer's entire retirement pay, under Arizona law, constituted community property. Though he was unmarried and not domiciled in Arizona during all of such 30-year periods, so that one half of such retirement pay was properly attributed in computing retirement income credit for joint income tax return for 1961 to taxpayer's wife. CIR v. Wilkerson, CA 9, Arizona, 1966, 368 F2D 552, domicile, key symbol again, 41, husband and wife, key symbol 249, Internal Revenue 3535. For computing retirement income credit of H&W residing in community property state, capital was not material income producing factor in H's real estate brokerage proprietorship so as to limit earned income figure to 30% of net profits under 911B of this title. His income being attributable primarily to his business reputation and ability. Earned income consisted of net profits, not gross commissions, used by Commissioner under Treasury regulations. Absent statutory language consistent with legislative purpose of giving tax credit to self-employed retirees roughly equivalent to tax exemption given Social Security beneficiaries, and W's community portion of retirement income should be reduced by her community portion of H's earned income, there being no basis for consistency in attributing all earned income to H. Warren R. Miller, Sr. and Hilda B. Miller, petitioners v. Commissioner of Internal Revenue. Respondent, Tax Court 1969 51 TC 755, acquired. Let me finish this. I'll get to 24. Retirement income of H, who spent roughly 20% of more than 30 years federal service, married, and domiciled in community property states, and started to receive retirement annuity while domiciled in the community property state of Arizona, was acquired over a period of time services were performed and contributions made. So was community property in proportion to domicile of community and community property state bore to his entire period of federal service, and such apportionment governed computation of retirement income credit for H. and W. Williams v. Commissioner of Internal Revenue, Tax Court 1968 51 TC 346. 3. Civil service benefits. In enacting former Section 37 of this title allowing certain credit for Civil Service Retirement Act benefits, Congress intended a partial adjustment but not complete exemption. Heard v. CIR, CA8, Missouri 1964 36 F2D 962. Certiorari denied 84S count 1884 377 US 978 12 LED 2D 746 Internal Revenue 3575. 4. Disability income. Where a petitioner received retirement disability payments exceeding maximum exclusion of $5,200 under 105A of this title, Tax Court determined petitioner failed to qualify for retirement income credit under this section, since $5,679 excess over excluded portions of disability benefits constituted payments in lieu of wages, and as such were earned income within the meaning of limitation under this section. Woodford v. Commissioner of Internal Revenue, U.S. Tax Court 1979 71 TC 991. 5. Sick pay exclusion. Court determined, considering statutory language, Treasury regulations, legislative history, and congressional intendment, that Air Force officer retired on disability prior to reaching mandatory retirement age was not entitled to retirement income credit under this section for income received in excess of sick pay exclusion provided by Section 105 of this title. Diap Howlis v. Commissioner of Internal Revenue, U.S. Tax Court 1977 69 TC 283. 6. Qualifying child. Taxpayer's sister satisfied age requirement for qualifying child as required for taxpayer to claim earned income tax credit for sister. Although sister was 54 years old, where sister was permanently and totally disabled from various ailments, including congestive heart failure. Bobo v. CIR, U.S. Tax Court 2010, WL 219-5278, unreported, Internal Revenue 3532. Section 23, renumbered Section 36C. And on to Section 24. You don't have to read any of the historical or statutory notes, just the code and the notes on decisions. Oh my God.
Yeah, start at 24.
Well, here we are again. Section 24, the child tax credit. A, allowance of credit. There shall be allowed as a credit against the tax imposed by this chapter for the taxable year with respect to each qualifying child of the taxpayer for which the taxpayer is allowed a deduction under Section 151 in amount equal to $1,000. B, limitations. Limitations based on adjusted gross income. The amount of the credit allowable under subsection A shall be reduced, but not below zero, by $50 for each 1,000 or fraction thereof by which the taxpayer's modified adjusted gross income exceeds the threshold amount. For purposes of the preceding sentence, the term modified adjusted gross income means adjusted gross income increased by any amount excluded from gross income under section 911, 931, or 933. 2. Threshold amount. For purposes of paragraph 1, the term threshold amount means A, $110,000 in case of a joint return, B, $75,000 in case of an individual who is not married, and C, $55,000 in the case of a married individual filing a separate return. For purposes of this paragraph, marital status shall be determined under section 7703. Limitation based on amount of tax. In the case of a taxable year to which section 26A2 does not apply, the credit allowed under subsection A for any taxable year shall not exceed the excess of A, the sum of the regular tax liability as defined in section 26B, plus the tax imposed by section 55 over B, the sum of the credits allowable under this subpart other than this section in sections 25A1, 25B, 25D, 30, 30B, and 30D, and section 27 for the taxable year. C. Qualifying child. For purposes of this section, 1. In general, the term qualifying child means qualifying child of the taxpayer as defined in section 152C who has not attained age 17. Exception for certain non-citizens. The term qualifying child shall not include any individual who would not be a dependent if subparagraph A of section 125B3 were applied without regard to all that follows. Resident of the United States. D. Portion of credit refundable. 1. In general, the aggregate credits allowed to a taxpayer under subpart C shall be increased by the lesser of A, the credit which would be allowed under this section without regard to this subsection, and the limitation under section 26A2 or subsection B3, as the case may be, or B, the amount by which the aggregate amount of credits allowed by this subpart determined without regard to this subsection would increase if the limitation imposed by section 26A2 or subsection B3, as the case may be, were increased by the greater of 1. 15% of so much of the taxpayer's earned income within the meaning of section 32, which is taken into account in computing taxable income for the taxable year as exceeds $10,000, or 2, in the case of a taxpayer with 3 or more qualifying children, in excess, if any, of 1, the taxpayer's Social Security taxes for the taxable year, over 2, the credit allowed under section 32 for the taxable year. The amount of the credit allowed under this subsection shall not be treated as a credit allowed under this subpart and shall reduce the amount of credit otherwise allowable under subsection A without regard to section 26A2 or subsection B3, as the case may be. For purposes of subparagraph B, any amount excluded from gross income by reason of section 112 shall be treated as earned income, which is taken into account in computing taxable income for the taxable year. The amount of the credit allowed under this subsection shall not be treated as a credit allowed under this subpart and shall reduce the amount of credit otherwise allowable under subsection A without regard to section 26A2 or subsection B3, as the case may be. For purposes of subparagraph B, any amount excluded from gross income for this reason of section 112 shall be treated as earned income, which is taken into account in computing taxable income for the taxable year. I think I said that already. 2. Social Security taxes. For purposes of paragraph 1, A, in general, the term Social Security taxes means, with respect to any taxpayer for any taxable year, 1. The amount of taxes imposed by sections 3101 and 3201A on amounts received by the taxpayer during the calendar year in which the taxable year begins. 2.
50% of the taxes imposed by Section 1401 on the self-employment income of a taxpayer for the taxable year. And 3, 50% of the taxes imposed by Section 3211A on amounts received by the taxpayer during the calendar year in which the taxable year begins. B, coordination with special refund of Social Security taxes. The term Social Security taxes shall not include any taxes to the extent that the payer is entitled to a special refund of such taxes under Section 6413C. C, special rule. Any amounts paid pursuant to an agreement under Section 3121L relating to agreements entered into by American employers with respect to foreign affiliates, which are equivalent to the taxes referred to in subparagraph A1, shall be treated as taxes referred to in such subparagraph. In the case of any taxable year beginning in the calendar year after 2001, the $10,000 amount contained in paragraph 1B shall be increased by an amount equal to A, such dollar amount multiplied by B, the cost of living adjustment determined under Section 1F3 for the calendar year in which the taxable year begins, determined by substituting the calendar year 2000 for calendar year 1992 in subparagraph B thereof. Any increase determined under the preceding sentence shall be rounded to the nearest multiple of $50. 4. Special rule for 2009 and 2010. Notwithstanding paragraph 3, in the case of any taxable year beginning in 2009 or 2010, the dollar amount in effect for such taxable year under paragraph 1B1 shall be $3,000. Identification requirement. No credit shall be allowed under the section to a taxpayer with respect to any qualifying child unless the taxpayer includes the name and taxpayer identification number of such qualifying child on the return of tax for the taxable year. F. Taxable year must be full taxable year. Except in the case of a taxable year closed by reason of the death of the taxpayer, no credit shall be allowable under this section in the case of a taxable year covering a period of less than 12 months. Statutes. Here we go. Sunset provisions. Notwithstanding. None of that's the fun stuff. That's all references. Construction with other laws. Additional child tax credit granted to debtor taxpayers under Internal Revenue Code because they had at least 3 children was not type of public assistance within meaning of Idaho exemption for benefits that individual is entitled to receive under federal, state, or local public assistance legislation, notwithstanding that tax credit might be refundable. High income threshold adopted by Congress before credit started to phase out clearly show that credit was not intended as a form of public assistance legislation. 2. Taxpayer failed to show that either of his children was qualifying child for purposes of dependency exemption deduction, and thus he was not entitled to any child tax credit. Taxpayer was entitled to child tax credit. Taxpayer was entitled to treat both children in question as qualifying children, and both children were under the age of 17. Taxpayer was not entitled to child tax credit. Child was not taxpayer's qualifying child as she did not have the same principal place of abode as taxpayer for more than 1/2 of the taxable year. That's Thomas versus the CIR unreported. Because taxpayer's $3,000 child tax credit did not exceed their $3,309 tax liability, they were not entitled to additional tax credit. child taxpayer's failure to substantiate either dollar amount of total support received by female companions 2 children during a year in which taxpayer, companion, and children all lived in companion's father's mobile home, or dollar amount of support that taxpayer provided to children precluded taxpayer taking dependency exemption deductions, assuming head of household status, and claiming child tax credits based on children. Nobles versus CIR. Non-custodial divorce taxpayer's failure to attach to his return ex-spouse's Form 8832 release of claim to exemption precluded taxpayers claiming dependency exemption and child tax credit for former marriage, regardless of the fact that years earlier ex-spouse had executed form for all future years and taxpayers' copy of that form had been lost in fire. Under unambiguous language of governing statute and regulations, strict adherence was required as to written declaration condition for non-custodial taxpayers claiming exemption. Qualifying children. 2 minor children of non-custodial taxpayer were not qualifying children of taxpayer as required for taxpayer to be entitled to child tax credit, where children did not have the same principal place of abode as taxpayer. For more than 1/2 of the taxable year, and taxpayer was not entitled to claim dependency exemptions for children. Guessing versus CIR. Taxpayer, father of minor child who was divorced and whose ex-wife had legal and physical custody of child during tax year, failed to establish qualifying child or qualifying relative status, precluding his claiming dependency exemption, deduction, child tax credit, and head of household status. Taxpayer only evidence of child qualifying status is the taxpayer had paid child support of $1,872 during the year, and that child had lived with taxpayer on weekends and during summer. Taxpayer was not entitled to head of household filing status or child tax credit. At no time during relevant year did taxpayer have same principal place of abode as his sons. None of his sons was qualifying child, as taxpayer failed to carry his burden of establishing total child support he provided during the year. And that's Daniels versus CIR. Taxpayer was not entitled to use child tax credit for children of taxpayer's friend to whom taxpayer was not related by blood. Taxpayer did not establish that he was related to children within the meaning of governing statute, or that he provided over half support for either child. AURI versus CIR. Number 4, dependency. Taxpayer is eligible to claim child tax credit for each qualifying child if the taxpayer establishes entitlement to the dependency exemption deduction under statutory exception when custodial parent has signed document waiving right to the exemption. Hines versus CIR. Taxpayer was not entitled to child tax credit with respect to granddaughter, and the granddaughter was her qualifying child. Horsley versus CIR. Because taxpayers' minor nieces with whom taxpayer resided were qualified children so as to entitle taxpayer to dependency exemption deductions, taxpayer was also entitled to child tax credits. Pavia versus CIR. Taxpayer was not entitled to child tax credits with respect to his children. His children were not qualifying children, as taxpayer was not entitled to dependency exemption deductions for them. Campos versus CIR. Taxpayer and father was not entitled to claim dependency exemption for his minor daughter, whom taxpayer purportedly had custody of and supported, nor was he entitled to claim child tax credit. Taxpayer and child's mother had no credit.
Boring. You should be singing the code. Sing it as an opera. Don't plug what?
Is that a comfort for folks?
because divorced father was not entitled to dependency exemption deduction for his son. He was not entitled to
Claim child tax credit. That guy was strangely enthusiastic. I wish you could have all seen him. Anyhow, this is what you get. Section 25. Interest on certain home mortgages. A. Allowance of credit. 1. In general, there shall be allowed as a tax credit against the tax imposed by this chapter for the taxable year in an amount equal to the product of A. The certificate credit rate, and B. Interest paid or accrued by the taxpayer during the taxable year on the remaining principal of the certified indebtedness amount. Limitation 2. Limitation where credit rate exceeds 20%. A. In general, if the certificate credit rate exceeds 20%, the amount of the credit allowed to the taxpayer under paragraph 1 for any taxable year shall not exceed $2,000. I was asked to sing it, so I did.
Seriously?
Mm-hmm. B. Special rule where 2 or more persons hold interest in residence. If 2 or more persons hold interest in any residence, the limitation of subparagraph A shall be allocated among such persons in proportion to their respective interest in the residence. B. Certificate credit rate. Certified indebtedness amount. For purposes of this section, 1. Certificate credit rate. The term certificate credit rate means the rate of the credit allowable by this section, which is specified in the mortgage credit certificate. 2. Certified indebtedness amount. The term certified indebtedness amount means the amount of indebtedness which is A. Incurred by the taxpayer. 1. To acquire the principal residence of the taxpayer.
You guys are all set now?
2. As a qualified home improvement loan as defined in section 143K4 with respect to such residence, or 3. As a qualified rehabilitation loan as defined in section 143K5 with respect to such residence, and B. Specified in the mortgage credit certificate. C. Mortgage credit certificate, qualified mortgage credit certificate program. For purposes of this section, 1. Mortgage credit certificate. The term mortgage credit certificate means any certificate which A. is issued under a qualified mortgage credit certificate program by the state or political subdivision having the authority to issue a qualified mortgage bond to provide financing on the principal interest of the taxpayer. B. Is issued to the taxpayer in connection with the acquisition, qualified rehabilitation, or qualified home improvement of the taxpayer's principal residence. C. Specifies 1. The certificate credit rate, and B. The certified indebtedness amount, and D. Is in such form as the Secretary may prescribe. 2. Qualified Mortgage Credit Certificate Program. A. In general, the term Qualified Mortgage Credit Certificate Program means any program, 1. Which is established by a state or political subdivision thereof for any calendar year for which is authorized to issue qualified mortgage bonds. 2. Under which the issuing authority elects in such manner and form as the Secretary may prescribe not to issue an amount of private activity bonds which it may otherwise issue during the such calendar year under sections 146. 3. Under which the indebtedness certified by mortgage credit certificates meets the requirements of the following subsections of section 143 as modified by subparagraph B in this paragraph. 1. Subsection C, relating to residence requirements. 2. Subsection D, relating to 3-year requirement. 3. Subsection E, relating to purchase price requirement.
You have a request to sing it to the tune of Old MacDonald Had a Farm.
Old MacDonald Had a Farm? Subsection 8, relating to portion of loans required to be placed in targeted areas, and that is 5. Paragraph 1 of subsection 9, relating to other requirements under no mortgage credit certificate may be issued. I have a feeling that was somebody from my family. With respect to any residence
any of the financing of which is provided from the proceeds of a qualified mortgage bond or a qualified veteran's mortgage bond. 5. Except the extent provided in regulation, which is not limited to indebtedness incurred from particular lenders. 6. Except to the extent provided in regulations, which provides what a mortgage credit certificate is not transferable. And 7. If the issuing authority allocates a block of mortgage credit certificates for use in connection with a particular development which requires the developer to furnish the issuing authority and the home buyer a certificate that the price for the residence is no higher than it would be without the use of mortgage credit certificates. Under regulation, rules similar to the rules of subparagraphs B and C of section 143A2 shall apply to the requirements of this subparagraph. B. Modifications of section 143. Under regulations prescribed by the Secretary in applying section 143 for purposes of subclauses 2, 4, and 5 of subparagraph A, 3. 1. Each qualified mortgage certificate credit program shall be treated as a separate issue. 2. The product determined by multiplying 1. The certified indebtedness amount of each mortgage credit certificate issued under such program by 2. The certificate credit rate specified in such certificate shall be treated as proceeds of such issue, and the sum of such products shall be treated as the total proceeds of such issue. And 3. Paragraph 1 of section 143D shall be applied by substituting 100% for 95% or more. Clause 3. Shall not apply if the issuing authority submits a plan to the Secretary for administering the 95% requirement of section 143D1. We all know that one. And the Secretary is satisfied that the requirement will be met under such plan. D. Determination of certificate credit rate. For purposes of this section, 1. In general, the credit certificate rate specified in any mortgage credit certificate shall not be less than 10% or more than 50%. 2. Aggregates limit on the certificate credit rates in general. In the case of each qualified mortgage credit certificate program, the sum of the products determined by multiplying 1. The certified indebtedness amount of each mortgage credit certificate issued under such program by 2. The certificate credit rate with respect to such certificate shall not exceed 25% of the non-issued bond amount. It's good news. B. Non-issued bond amount. For purposes of subparagraph A, the term non-issued bond amount means the amount of qualified mortgage bonds which the issuing authority is otherwise authorized to issue and elects not to issue under subsection 2CA2. E. Special rules and definitions. For purposes of this section, 1. Carry forward of unused credit. A. In general, if the credit allowable under subsection A for any taxable year exceeds the applicable tax limit for such tax year, such excess shall be a carryover to each of the 3 succeeding taxable years, and subject to the limitations of subparagraph B, shall be added to the credit allowable by subsection A for such succeeding taxable year. Limitation. The amount of the unused credit which may be taken into account under subparagraph A for any taxable year shall not exceed the amount, if any, by which the applicable tax limit for such taxable year exceeds the sum of 1. Credit allowable under subsection A for such taxable year determined without regard for its paragraph, and 2. The amounts which by reason of this paragraph are carried to such taxable year, and are attributed to taxable years before the unused credit year. C. Applicable tax limit. For purposes of this paragraph, the term applicable tax limit means 1. In the case of a taxable year to which section 26A2 applies, the limitation imposed by section 26A2 for the taxable year reduced by the sum of the credits allowable under this subpart other than this section and sections 25D and 1400C. And 2.
in the case of a taxable year to which Section 26A2 does not apply, the limitation imposed by the Section 26A1 for the taxable year reduced by the sum of credits allowable under this subpart other than its Sections 24A, 25A1, 25B, 25D, 30, 30B, 30D, and 1400C.
With respect to the applicable tax limit, would you tax that?
I would tax that.
You would tax that?
I would tax that.
Tax the hell out of it?
All day.
Every day.
Per day. Two, indebtedness is not treated as certified where certain requirements are not in fact met. Subsections shall not apply to any indebtedness if all requirements of subsections C1D, E, F, I of section 143 and clauses 4, 5, and 6 of subsection right C2A were not in fact met with respect to such indebtedness, except to the extent provided in regulations. The requirements described in the preceding sentence shall be treated as met if there is a certification under penalty of perjury that such requirements are met. 3. Period for which certificate in effect, A, in general, except as provided in subparagraph B, a mortgage credit certificate shall be treated as in effect with respect to interest attributable to the period. 1. Beginning on the date such certificate is issued, and 2. Ending on the earlier of the date on which 1. The certificate is revoked by issuing authority, or 2. The resident to which such certificate relates ceases to the principal residence of the individual to whom the certificate relates. B. Certificate invalid unless indebtedness incurred within certain periods. A certificate shall not apply to any indebtedness which is incurred after the close of the second calendar year following the calendar year for which the issuing authority made the applicable election under subsection 2, C, A, 2. C. Notice the Secretary when certificate is revoked. Any issuing authority which revokes any mortgage credit certificate shall notify the Secretary of each revocation at such time and in such manner as the Secretary shall prescribe by regulations. 4. Reissuance of mortgage credit certificates, the Secretary may prescribe regulations which allow the administrator of a mortgage credit certificate program to reissue the mortgage credit certificates, specifying a certified mortgage indebtedness that replaces the outstanding balance of the certified mortgage indebtedness specified in the original certificate to any taxpayer to whom the original certificate was issued under such terms that conditions of the Secretary determines are necessary to ensure that the amount of credit allowable under subsection A with respect to such reissued certificate is equal or less than the amount of credit which would be allowable under subsection A with respect to the original certificate for any taxable year ending after such reissuance. Yay. 5. Public notice that certificates will be issued. At least 90 days before any mortgage credit certificate is to be issued after a qualified mortgage credit certificate program, the issuing authority shall provide reasonable public notice of A. Eligibility requirements for such certificate. B. The methods by which certificates are to be issued. And C. Such other information as the Secretary may require. 6. Interest paid or accrued to related persons. No credit shall be allowed under subsection A for any interest paid or accrued to a person who is related to the taxpayer within the meaning of section 144A3A. Principal residence. The term principal residence has the same meaning as when used in section 121. A. Qualified rehabilitation and home improvement. A. Qualified rehabilitation. The term qualified rehabilitation has a meaning given such term by section 143K5B. B. Qualified home improvement. Horrible show. The term qualified home improvement means
an alteration, repair, or improvement described in section 143K4. Qualified mortgage bond. The term qualified mortgage bond has a meaning given such term by section 143A1. 10. Manufactured housing. For purposes of this section, the term single-family residence includes any manufactured home which has a minimum of 400 square feet of living space and a minimum width in excess of 104 inches, and which is a kind of customary use at a fixed location. Nothing in the preceding sentence shall be construed as providing that such a home will be taken into account in making determinations under section 143. Reduction in aggregate amount of qualified mortgage bonds which may be issued where certain requirements not met. This is important. 1. In general, if for any calendar year any mortgage credit certificate program which satisfy procedural requirements with respect to volume limitations prescribed by the Secretary fails to meet the requirements of paragraph 2 of subsection D, such requirements shall be treated as satisfied with respect to any certified indebtedness of such program, but the applicable state ceiling under subsection D of section 146 and the state in which such program operates shall be reduced by 1.25 as the correction amount with respect to such failure. Such reduction can be applied to such state ceiling for the calendar year following the calendar year in which the Secretary determines the correlation amount with respect to such failure. 2. Correction amount. Did you get that? A. In general, for purposes of paragraph 1, the term correction amount means an equal amount to the excess credit amount divided by which would have been the credit amount for the program met the requirements of paragraph 2, subsection D. If you couldn't hear that, just check page 257. For purposes of clause 1, the term credit amount means the sum of the products determined under clauses 1 and 2 of subsection D2A. 3. Special rule for states having constitutional home rule cities. Home rules. In the case of a state having one or more constitutional home rule cities, within the meaning of section 146D3C, the reduction of in the state ceiling by reason of paragraph 1 shall be allocated to the constitutional home rule city or to the portion of the state not within such city, whichever caused the reduction. 4. Exception where certification program. The provisions of this subsection shall not apply in any case in which there is a certification program which is designated to ensure that the requirements of this section are met and which meets such requirements as the Secretary may by regulations prescribe. 5. Waiver. The Secretary may waive the application of paragraph 1 in any case if he determines that the failure is due to reasonable cause. G. Reporting requirements. Each person who makes a loan which is a certified indebtedness amount under any mortgage credit certificate shall file a report with the Secretary containing 1. The name, address, and social security account number of the individual to which the certificate was issued. 2. The certificate's issuer, date of issue, certified indebtedness amount, and certificate credit rate. And 3. Such other information as the Secretary may require by regulations. Each person who issues a mortgage certificate shall file a report showing such information as the Secretary by the regulations prescribed. Any such report shall be filed at such a time and in such a manner as the Secretary may require by regulations. You mean to tell me you didn't recognize this was the tax code random passerby? How dare you? H. Regulations and contracts. 1. Regulations. The Secretary shall prescribe such regulations as they may be necessary to carry out the purposes of this section, including regulations which may require recipients of mortgage credit certificates to pay a reasonable processing fee to defray the expenses incurred in administering the program.
See, we have a request for you to do so. This isn't a Bedtime. I don't know what that is.
Oh, I got it. 2. Contracts. Secretary is authorized to either contracts with any person
to provide services in connection with the administration of this section. Alright, recapture, force of federal subsidy, use of mortgage credit certificates, yada yada, you know what I'm saying, all day, you know what I'm saying, baby, all day. Get through these statutes, you know what I'm saying, what's called everything is everything. Section 25A, hope and lifetime learning credits. A, allowance of credit. In the case of an individual, there should be allowed as a credit against the tax imposed by this chapter for the taxable year amount equal to the sum of 1, Hope Scholarship Credit plus 2, Lifetime Learning Credit. B, Hope Scholarship Credit 1 per student credit. In the case of any eligible student for whom an election is in effect, word to God, under the section for any taxable year, the Hope Scholarship Credit is an equal amount to the sum of
A, 100% of so much the qualified tuition and related expenses paid by the taxpayer during a taxable year for education furnished to the eligible student during any academic period beginning in such a taxable year, as does not exceed 1,000 plus.
B, 50% of such expenses so paid as exceeds 1,000, but it does not exceed the applicable limit. Shut up, Blanche.
What page are we on?
265. 2. Limitations applicable to the Hope Scholarship Credit.
What book?
The first book of the tax code. This is like the definition of a Snickers commercial. An election to have this section apply with respect to any eligible student for purposes of the Hope Scholarship Credit under subsection A1 may not be made for any taxable year if such an election by the taxpayer or by any other individual is in effect with respect to such student for any 2 prior taxable years. B, credit allowed for a year only if individual is at least a half-time student for portion of the year. The Hope Scholarship Credit under subsection A1 shall not be allowed for a taxable year with respect to the qualified tuition and regulated expenses of an individual unless such individual is an eligible student for at least 1 academic period which begins during such year. Credit allowed for only 2 years of post-secondary education. The Hope Scholarship Credit under subsection A1 shall not be allowed for a taxable year with respect to the qualified tuition and related expenses of an eligible student if the student has completed before the beginning of such taxable year the first 2 years of post-secondary education at an eligible educational institution. D, denial of credit if student convicted of a felony drug offense. Oh, this should be good. D, denial of student if student of credit convicted of a felony drug offense. Snub, kids. The Hope Scholarship Credit under subsection A1 shall not be allowed for qualified tuition and related expenses for the enrollment or attendance of a student for any academic period if such student has been convicted of a federal or state felony offense consisting of possession or distribution of a controlled substance, drugs, before the end of the taxable year with or within such period ends.
Notice how murder's okay, but you lose the credit with drugs.
The drug war seeped into page, what, 250, where are we?
We're on 266.
Page 266 of the tax code has a little drug war. It's just like, throw them in prison, oh, and by the way, taking away your tax credit.
Yep.
It's kind of interesting, actually.
3, eligible student. For purposes of this subsection, the term eligible student means with respect to any academic period, a student who A, meets the requirements of section 484A1 of the Higher Education Act of 1965, 20 USC 1091A1 as in effect on the date of the enactment of this section, and B, is carrying at least half the normal full-time workload of the course of study the student is pursuing. And they don't sell drugs. 4. Applicable limit. For purposes of paragraph 1B, the applicable limit for any taxable year is an amount equal to 2 times the dollar amount in effect under paragraph 1A for such taxable year. The lifetime learning credit. 1. Per taxpayer credit. The lifetime learning credit is for any taxpayer for any taxable year is an amount equal to 20% of so much of the qualified tuition and related expenses paid by the taxpayer during the taxable year for education furnished during any academic period beginning in such taxable year, as does not exceed $10,000, $5,000 in the case of taxable years beginning before January 1st, 2003. 2. Special rules for determining expenses. A. Coordination with the Hope Scholarship. The qualified tuition and regulated expenses with respect to an individual who is an eligible student for whom the Hope Scholarship credit under subsection A1 is allowed for the taxable year shall not be taken into account under this subsection. B. Expenses eligible for lifetime learning credit. For purposes of paragraph 1, qualified tuition and related expenses shall include expenses described in subsection F1 with respect to any course of instruction at an eligible education institution to acquire or improve job skills of the individual. D. Limitation based on modified adjusted gross income. 1. In general, the amount which would be for this subsection can be taken into account under subsection A for the taxable year shall be reduced, but not below 0 by the amount determined under paragraph 2. Let's get into the meat of this then. 2. Amount of reduction. The amount determined under this paragraph is the amount which bears the same ratio to the amount which will be taken into account as A. The excess of I. The taxpayer's modified adjusted gross income for such taxable year over 2I, $40,000, $80,000 in the case of a joint return bears to B, $10,000, $20,000 in the case of a joint return. 3. Modified adjusted gross income. The term modified adjusted gross income means the adjusted gross income of the taxpayer for the taxable year increased by any amount excluded from the gross income under section 911, 931, or 933. E. Election does not have section apply. Taxpayer may elect not to have this section apply with respect to the qualified tuition and related expenses of an individual for any taxable year. F. Definitions. For the purposes of this section, 1. Qualified tuition and related expenses. A. In general, the term qualified tuition and related expenses means tuition and fees required for the enrollment or attendance of 1. The taxpayer, 2. The taxpayer's spouse, or 3. Any dependent of the taxpayer with respect to whomever the taxpayer is allowed a deduction under section 151. At an eligible educational institution for courses of instruction of such individual at such institution. B. Exception for education involving sports. Such term does not include expenses with respect to any course or other education involving sports, games, or hobbies, unless such course is other education is a part of the individual's degree program. C. Exception for non-academic fees. Such term does not include student activity fees, athletic fees, insurance expenses, and other expenses related to the individual's academic course of instruction. Eligible educational institution. The term eligible educational institution means an institution A, which is described in section 481 of the Higher Education Act of 1965 has an effect on the date of the enactment of this section, and B, which is eligible to participate in a program under Title IV of such act. G. Special rules. Identification requirement. No credit shall be allowed under subsection A to a taxpayer with respect to the qualified tuition and related expenses of an individual unless the taxpayer includes the name and taxpayer identification number of such individual on the return of tax for the taxable year. 2. Adjustment for certain scholarships, etc. The amount of qualified tuition and related expenses otherwise taken into account under subsection A with respect to an individual for an academic period shall be reduced before the application of subsections B, C, and D by the sum of any amounts paid for the benefit of such individual which are allocable to such period as A. A qualified scholarship which is excludable from gross income under section 117. B. An educational assistance allowance under Chapter 30, 31, 32, 34, 35 of Title 38 United States Code or under Chapter 1606 of Title 10 United States Code. And C. A payment other than a gift, bequest, devise, or inheritance within the meaning of Section 102A for such individual education expenses or attributable to such individual's enrollment at an eligible educational institution, which is excludable from a gross income under the law of the United States. 3. Treatment of expenses paid by dependent. If a deduction under Section 151 with respect to an individual is allowed to another taxpayer for a taxable year beginning in the calendar year in which such individual's taxable year begins, no credit shall be allowed under the subsection 8 to such individual for such individual's taxable year. And B. Qualified tuition and related expenses paid by such individual during such individual's taxable year shall be treated for purposes of this section as paid by such other taxpayer. 4. Treatment of certain prepayments. If qualified tuition and treatment of qualified tuition and related expenses are paid by a taxpayer during a taxable year for an academic period which begins during the first 3 months following such taxable year, such academic period shall be treated for purposes of this section as beginning during such taxable year. Friends, I don't know when, and I don't know where. Channel the inner Morgan Freeman. We may go down again. We're killing batteries like it's going out of style. So I'm going to keep reading, and I hope that this carries you through until we get back up. But we're not stopping. And if you're watching, you're a lunatic if you've been watching from the beginning. On with the story. Kids, be quiet. The parents are busy listening to this fantastic tale. Treatment of certain prepayments. If qualified tuition and related expenses are paid for by the taxpayer during a taxable year for an academic period which begins during the first 3 months following such taxable year, such academic period shall be treated for purposes of this section as beginning during such taxable year. I agree. 5. Denial of double benefit. No credit shall be allowed under this section for any expense for which a deduction is allowed under any other provision of this chapter. 6. No tax credit for married individuals filing separate returns. If a taxpayer is a married individual within the meaning of Section 7703, this section shall apply only if the taxpayer and the taxpayer's spouse file a joint return for the taxable year. Non-resident aliens. If the taxpayer is a non-resident alien individual for any portion of the taxable year, this section shall apply only if the individual is treated as a resident alien of the United States for purposes of this chapter by reason of an election under subsection G or H of section 6013. Inflation adjustments. Dollar limitation on amount of credit. A. In general, in the case of a taxable year beginning after 2001, each of the 1,000 amounts under subsection B and 1 shall be increased by an equal amount to 1. Such dollar amount multiplied by 2, the cost of living adjustment determined under section 1F3 for the calendar year in which the taxable year begins, determined by substituting calendar year 2000 for calendar year 1992 in subparagraph B thereof, B rounding. If any amount is adjusted under subparagraph A is not a multiple of 100, such amount shall be rounded to the next lowest multiple of 100. Duh. 2.
Income limits. A. In general, in the case of a taxable year beginning after 2001, the 40,000 and 8,000 amounts in subsection D2 shall be increased by an equal amount to 1. Such dollar amount multiplied by 2. The cost of living adjustment determined under section 1F3 for the calendar year in which the taxable year begins, determined substituting calendar year 2000 for calendar year 1992 in subparagraph B thereof. Rounding again. If any amount is adjusted under subparagraph A is not a multiple of 1,000, such amount shall be rounded to the next lowest multiple of 1,000. J. American Opportunity Credit Tax. In the case of a taxable year beginning in 2009 or 2010, one, increase in credit. The Hope Scholarship credit shall be an amount equal to the sum of 100% of so much of the qualified tuition and related expenses paid by the taxpayer during the taxable year for education furnished to the eligible student during any academic period in such taxable year as does not exceed $2,000 plus B. 25% of such expenses so paid as exceeds $2,000 but does not exceed $4,000. 2. Credit allowed for first 4 years of post-secondary education. Subparagraphs A and C of subsection B2 shall be applied by substituting 4 for 2. Qualified tuition and related expenses to include required course materials. Subsection F1A shall be applied by substituting tuition, fees, and course materials for tuition and fees. 4. Increase in AGI limits for Hope Scholarship credit in lieu of applying subsection C with respect to the Hope Scholarship credit. Such credit determined without regard to this paragraph shall be reduced to, but not below 0, by the amount which bears the same ratio to such credit as so determined as A. The excess of 1. Taxpayer's modified adjusted gross income as defined in section D3 for such taxable year over 2. $8,000, $80,000, or $160,000 in the case of a joint return bears to B. $10,000, $20,000 in the case of a joint return. Five, credit allowed against alternative minimum tax. In the case of a taxable year to which section 26A2 does not apply, so much of the credit allowed under subsection A as is attributable to the Hope Scholarship credit cannot exceed the excess of A. The sum of the regular tax liability as defined in section 26B plus the tax imposed by section 55 over B, the sum of credits allowable under this subpart other than this subsection and sections 25D and 30D and section 27 for the taxable year. Any reference in this section or section 24, 25, 26, 25B, 904, or 1400C to a credit allowable under this subsection shall be treated as a reference to so much of the credit allowable under the subsection as is attributable to the Hope Scholarship credit. 6. Portion of credit made refundable. 40% of so much of the credit allowed under subsection is attributable to the Hope Scholarship credit determined after application of paragraph 4 and without regard to this paragraph and section 26A2 or paragraph 5 as the case may be shall be treated as a credit allowable under subpart C and not allowed under subsection A. The preceding sentence shall not apply to any taxpayer for any taxable year if such taxpayer is a child to whom subsection G of section 1 applies for such taxable year. Coordination with Midwestern disaster area benefits.
In the case of a taxpayer with respect to whom Section 702A1B of the Heartland Disaster Tax Relief Act of 2008 applies for any taxable year, such taxpayer may elect to waive the application of this subsection to such taxpayer for a taxable year. J. Regulations. The Secretary may prescribe such regulations as may be necessary or appropriate to carry out this section, including regulations providing for a recapture of the credit allowed under this of any amount which was taken into account in determining the amount of such credit. Yay! Do you...
Now we just gotta move that shit all the way around. Got it? Keep that there. Right with the sign. Because this may not. Yeah.
They're live. It's live. Like the world can see nobody.
All right.
Where's my little umbrella?
Previously on the tax code.
We had just gone on an adventure, but then we stopped. But now we're back, and we're not afraid. There's a comb in this book.
What's happened in the tax code so far?
Well, there was a guy that tried to get away with using drug money, but they got a law against that. That was on page 266. It was like, so we're basically just drudging through. We know that there's a lot of material you guys want to cover. Just stick around. It's tough, but you know, we're gonna stick with it. We believe in this. Previously, we were on section 25B, so that's where we'll start now. Elective deferrals and IRA contributions by certain individuals. A. Allowance of credit. In the case of an eligible individual, there shall be allowed as a credit against the tax imposed by this subtitle for the taxable year an amount equal to the applicable percentage of so much of the qualified retirement savings contributions of the eligible individual for the taxable year as do not exceed $2,000. B. Applicable percentage. For purposes of this section, 1. Joint returns. In the case of a joint return, the applicable percentage is A. If the adjusted gross income of the taxpayer is not over $30,000, 50%. B. If the adjusted gross income of the taxpayer is over $30,000, but not over $32,500, 20%. C. If the adjusted gross income of the taxpayer is over $32,500, but not over $50,000, 10%. And D. If the adjusted gross income of the taxpayer is over $50,000, 0%. 2. Other returns. In the case of A. a head of household, the applicable percentage shall be determined by paragraph 1, except that such paragraph shall be applied by substituting for each dollar amount therein as adjusted under paragraph 3, a dollar amount equal to 75% of such dollar amount. And B, any taxpayer not described in paragraph 1 or subparagraph A, the applicable percentage shall be determined under paragraph 1, except that such paragraph shall be applied by substituting for each dollar amount therein as adjusted under paragraph 3, a dollar amount equal to 50% of such dollar amount. Inflation adjustment, yay! In the case of any taxable year beginning in the calendar year after 2006, each of the dollar amounts in paragraph 1 shall be increased by an equal amount to A, such dollar amount multiplied by B, the cost of living adjustment determined under section 1F3 for the calendar year in which the taxable year begins, determined by substituting calendar year 2005 for calendar year 1992 in subparagraph B thereof. Any increase determined under the preceding sentence shall be rounded to the nearest multiple of 500. C, eligible individual. Is this you? For purposes of this section, 1, in general, the term eligible individual means any individual if such individual has attained the age of 18 as of the close of the taxable year. Something to shoot for, kids. 2, dependents and full-time students, not eligible. The term eligible individual shall not include any individual with respect to whom a deduction under section 151 is allowed to another taxpayer for a taxable year beginning in the calendar year in which such individual's taxable year begins, and B, any individual who's a student as defined in section 152F2, which basically assumes you don't have any money anyway. D, qualified retirement savings contributions. For purposes of this section, 1, in general, the term qualified retirement savings contributions means with respects to any taxable year, the sum of A, the amount of qualified retirement contributions as defined in section 219E made by the eligible individual. B, the amount of I, any elective deferrals as defined in section 402G3 of such individual, and 2, any elective deferral of compensation by such individual under eligible deferred compensation plan. An eligible employer described in section 457E1A, and C, the amount of voluntary employee contributions by such individual to any qualified retirement plan as defined in section 4974C. 2, reduction for certain distributions. In general, the qualified retirement savings contributions determined in paragraph 1 shall be reduced, but not below 0, by the aggregate distributions received by the individual during the testing period from any entity a type to which contributions under paragraph 1 may be made. The preceding sentence shall not apply to the portion of any distribution that is not includable in gross income by reason of a trustee-to-trustee transfer or rollover distribution. B, testing period. Yeah. For purposes of subparagraph A, the testing period with respect to a taxable year is a period which includes I, such taxable year, 2, the 2 preceding taxable years, and 3, the period after such taxable year and before the due date, including extensions for filing the return of tax for such taxable year. C, accepted distributions. There shall be not taken into account under subparagraph A, 1, any distribution referred to in section 72P, 401K8, 401M6, 402G2, 404K, or 408D4, and 2, any distribution to which section 408AD3 applies. D, treatment of distributions received by spouse of individual. For purposes of determining distributions received by an individual under subparagraph A, for any taxable year, any distribution received by the spouse of such individual shall be treated as received by individual if such individual and spouse file a joint return for such taxable year and for the taxable year during which the spouse receives a distribution. For those of you that watch Shawshank Redemption, that's 278. E, adjusted gross income. For purposes of this section, adjusted gross income shall be determined without regard to sections 911, 931, and 933. F. Investment in the contract. Notwithstanding any other provisions of law, qualified retirement savings contribution shall not fail to be included in determining the investment in the contract for purposes of Section 72 by reason of the credit under this section. Limitation based on amount of tax. In the case of a taxable year to which Section 26A2 does not apply, the credit allowed under subsection A for the taxable year shall not exceed the excess of 1. The sum of a regular tax liability as defined in Section 26B plus a tax imposed by Section 55 over 2. The sum of credits allowable under this subpart other than this section and Sections 25A1, 25D, 30, 30B, and 30D, and Section 27 for the taxable year. (25C) Non-business energy property. A. Allowance of credit. In the case of an individual, there shall be allowed as a credit against the tax imposed by this chapter for the taxable year an amount equal to 30% of the sum of 1. The amount paid or incurred by the taxpayer during such taxable year for qualified energy efficiency improvements, and 2. The amount of residential energy property expenditures paid or incurred by the taxpayer during such taxable year. B. Limitation. The aggregate amount of the credits allowed under this section for taxable years beginning in 2009 and 2010 with respect to any taxpayer shall not exceed $1,500. Qualified energy efficiency improvement. For purposes of this section, 1. In general, the term qualified energy efficiency improvements mean any energy efficient building envelope component which meets the prescriptive criteria for such component established by the 2000 International Energy Conservation Code. Such as code, including supplements, is in effect in the date of the enactment of this section, or in the case of a metal roof with appropriate pigmented coatings or an asphalt roof with appropriate cooling granules, which meet the Energy Star program requirements if A. Such component is installed in or on a dwelling unit located in the United States and owned and used by the taxpayer as the taxpayer's principal residence within the meaning of Section 121. B. The original use of such component commences with the taxpayer. And C. Such component reasonably can be expected to remain in use for at least 5 years. Building envelope component. The term building envelope component means A. Any insulation material or system which is specifically and primarily designed to reduce the heat loss or gain of a dwelling unit when installed in or on such dwelling unit and meets the prospective criteria for such material or system established by the 2009 International Energy Conservation Code, as such code, including supplements, is in effect on the date of enactment of the American Recovery and Reinvestment Act of 2009. B. Exterior windows, including skylights. C. Exterior doors. And D. Any metal roof or asphalt roof installed on a dwelling unit, but only if such roof has appropriate pigmented coating or cooling granules which are specifically and primarily designed to reduce the heat gain of such dwelling unit. Yay. Manufactured homes included. Everyone gets to play. The term dwelling unit includes a manufactured home which conforms to federal manufactured home construction and safety standards. That means you can get this track's break even with a trailer. 4. Qualifications for exterior windows, doors, and skylights. Such term shall not include any component described in subparagraph B or C of paragraph 2 unless such component is equal to or below a U factor of 0.3 and SHGC of 0.3. Residential energy property expenditures. For purposes of this section, 1. In general, the term residential energy property expenditures means expenditures made by a taxpayer for qualified energy property which is installed on or in connection with a dwelling unit located in the United States and owned and used by the taxpayer as a taxpayer's principal residence within the meaning of Section 121 and originally placed in service by the taxpayer. Such term includes expenditures for labor costs properly allocated to the on-site preparation, assembly, or original installation of the property. Qualified energy property. In general, the term qualified energy property means an energy sufficient, efficient building property. 2, any qualified natural gas furnace, qualified propane furnace, qualified oil furnace, qualified natural gas hot water boiler, qualified hot propane hot water boiler and propane accessories, or qualified oil hot water boiler, or 3, an advanced main air circulating fan. B, performance and quality standards. Property described under subparagraph A shall meet the performance and quality standards and the certification requirements, if any, which 1, have been described by the Secretary by regulations. After consultation with the Secretary of Energy or the Administrator of the Environmental Protection Agency as appropriate, and 2, are in effect in the same of the acquisition of the property or at the time of completion of the construction, reconstruction, or erection of the property, this case may be. C, requirements and standards for air conditioners and heat pumps. The standards and requirements prescribed by the Secretary under subparagraph B with respect to the energy efficient ratio, EER, for central air conditioners and electric heat pumps shall require measurements to be based on published data which is tested by manufacturers at 95 degrees Fahrenheit, and 2, may be based on certified data of the Air Conditioning and Refrigeration Institute that are prepared in partnership for the Consortium for Energy Efficiency. You can make it big in heating and air conditioning. 3, energy efficient building property. The term energy efficient building property means A, an electric heat pump water heater which yields an energy factor of at least 2.0 in the Standard Department of Energy test procedure. B, an electric heat pump which achieves the highest efficiency tier established by the Consortium for Energy Efficiency as in effect on January 1st, 2009. C, a central air conditioner which achieves the highest efficiency tier established by the Consortium for Energy Efficiency as in effect January 1st, 2009. D, a natural gas, propane, or oil water heater which has either an energy factor of at least 0.82 or a thermal efficiency of at least 90%. And a stove which uses a burning of biomass fuel to heat a dwelling unit located in the United States and used as a residence by the taxpayer, or to heat water for use in such a dwelling unit, and which has thermal efficiency rating of at least 75% as measured using a lower heating value. 4, qualified natural gas, propane, and oil furnaces and hot water boilers. A, qualified natural gas furnace. The term qualified natural gas furnace means any natural gas furnace which achieves an annual fuel utilization efficiency rate of not less than 95. B, qualified natural gas hot water boiler. The term qualified natural gas hot water boiler means any natural gas hot water boiler which achieves an annual fuel utilization efficiency rate of not less than 90. C, qualified propane furnace. The term qualified propane furnace means any propane furnace which achieves an annual fuel utilization efficiency rate of not less than 95. D, qualified propane hot water boiler. The term qualified propane hot water boiler means any propane hot water boiler which achieves an annual fuel utilization efficiency rate of not less than 90. E, qualified oil furnaces. The term qualified oil furnace means any oil furnace which achieves an annual fuel utilization efficiency rate of not less than 90. F, qualified hot oil water boiler. The term qualified oil hot water boiler means any oil hot water boiler which archives an annual fuel utilization efficiency rate of not less than 90. These are some high-powered things we got going on here. 5, advanced main air circulating fan. The term advanced main air circulating fan means a fan used in a natural gas, propane, or oil furnace which has an annual electricity use of no more than 2% of the total annual energy use of the furnace, as determined in the standard Department of Energy test procedures. They are, sir. They're very comfortable chairs. 6. Biomass fuel. The term biomass fuel means any plant-derived fuel available on a renewable or recurring basis, including agricultural crops, trees, and wood waste, and residues, including wood pellets, plants, including aquatic plants, grasses, residues, and fibers.
Let me stop you there.
All right.
Advanced main air circulating fan. Do you like their definition of that term?
I'm actually glad you asked that. When you really think about what an advanced main air circulating fan is, it's basically a main advanced circulating fan. It's the central one, and a lot of people were really going to start finding out about that. I'm glad that it's in the tax code.
What about biomass fuel? See, I'm not sure if that's how I would have described it.
But yeah, no, biomass fuel is important. Biomass fuel, because it includes wood pellets.
Right.
And I invented something called BECO, and we use that in our fights, and we have wars.
Right.
And so
yeah, I was just surprised it includes residues and fibers.
yeah, anything that you can basically burn, that's what we're about here in America. So,
Right.
So if we can burn it, then you
So
know.
by page 286 of the United States Tax Code, we're describing what we can burn.
Right. What we can burn, and then a fan that goes over it.
All
An
right.
advanced main fan.
All right, tell us about the special rules in Section 8.
I'm glad you asked. Here we go. E. Special rules. For purposes of this section, 1. Application of rules. Rules similar to the rules under paragraphs 4, 5, 6, 7, and 8 of Section 25DE shall apply. I'm sure you remember them all. 2. Joint ownership of energy items. That guy remembers them. A. In general, any expenditure otherwise qualifying as an expenditure under this section shall not be treated as failing to so qualify merely because such expenditure was made with respect to 2 or more dwelling units. B. Limits applied separately. In the case of any expenditure described in subparagraph A, the amount of the credit allowable under subsection A shall, subject to paragraph 1, be computed separately with respect to the amount of expenditure made for each dwelling unit. F. Basis adjustments. For purposes of this subtitle, if a credit is allowed under this section for any expenditure with respect to any property, the increase in the basis of such property, which would, but for this subsection, result from such expenditure shall be reduced by the amount of the credit so allowed. G. Termination. One could only be so hopeful. This section shall not apply with respect to any property placed in service. 1. After December 31st, 2007, and before January 1st, 2009, or 2. After December the 31st, 2010. And then there's notes. And then there's notes. And it's 25D. We're at section 25D. Residential energy efficient property. A. Allowance of credit. In the case of an individual, there shall be allowed as a credit against the tax imposed by this chapter for the taxable year of an amount equal to the sum of 1. 30% of the qualified solar or electric property expenditures made by the taxpayer during such year. 2. 30% of the qualified solar, water, heating property expenditures made by the taxpayer during such year. B. 3. 30% of the qualified fuel cell property expenditures made by the taxpayer during such year. 4. 30% of the qualified small wind energy property expenditures made by the taxpayer during such year. And 5. 30 of the qualified geothermal heat pump property expenditures made by the taxpayer during such year. B. Limitations. 1 maximum for fuel cells. In the case of any of the qualified fuel cell property expenditure, the credit allowed under subsection A determined without regard to subsection C for any taxable year shall not exceed 500 with respect to each half
kilowatt of capacity to the qualified fuel.
And this is why we have the First Amendment, gents.
Brandon, do you feel like you're blocking the sidewalk?
You want to maybe spin the camera around and see just how little of the sidewalk was?
Yeah, right. Actually, let's go handheld for a second here. All right. So we got one camera there. We got a little table. There's him in his chair. There's Dan. Look at all that sidewalk. Look at that. Wowee. That's too much sidewalk, if you ask me. That's a bit matter.
Agreed.
But that lady actually just went up to the security guard and tried to inform him that the sidewalk was being blocked
May I?
by this tax code.
May you what? Address that?
Please, what do you think?
The lady is right. I don't want anyone to think that she's not. Was like, the sidewalk should never be blocked, which is why whenever you do something like that, you do have to abide by the laws. We appreciate the guys at DC Metro and especially Officer Braxton for being able to wake up early in the morning and make sure that we were in compliance, because the last thing that we want to do is minimize the efforts that we're making here. So with DC Metro and all the guys at the headquarters, Officer Braxton, thank you so much for making sure we were clear and in compliance, and hopefully the lady gets a chance to call him and she can figure it out, and then she'll know and she'll be informed, and then everyone wins. So anyway, back to this riveting tale, because that's not exciting to me. Section 25D, residential energy efficient property. It's gonna be a barn burner. Limitations: 1 maximum credit for fuel cells. In the case of any qualified fuel cell property expenditure, the credit allowed under subsection A, determined without regard to subsection for any taxable year, shall not exceed $500 with respect to each half kilowatt of capacity of the qualified fuel cell property as defined in section 48C1 to which such expenditure relates. And 2, certification of solar water heating property. No credit shall be allowed under this section for an item of property described in subsection D1 unless such property is certified for performance by the nonprofit Solar Rating Certification Corporation or a comparable entity endorsed by the government of the state in which such property is installed. C. Limitation based on amount of tax carry forward of unused credit. 1. Limitation based on amount of tax. In the case of a taxable year in which section 26A2 does not apply, the credit allowed under subsection A for the taxable year shall not exceed the excess of A, the sum of the regular tax liability as defined in section 26B, plus the tax imposed by section 55 over B, the sum of the credits allowable under this subpart other than this section and section 27 for the taxable year. Carry forward of unused credit. Rule for years in which all personal credits allowed against regular and alternative minimum tax. In the case of a taxable year to which section 26A2 applies, if the credit allowable under subsection A exceeds the limitation imposed by section 26A2 for such taxable year reduced by the sum of the credits allowable under this subpart other than this section shall be carried to the succeeding taxable year and added to the credit allowable under subsection A for each succeeding taxable year. B. Rule for other years. In the case of a taxable year to which section 26A2 does not apply, if the credit allowable under subsection A exceeds the limitation imposed by paragraph 1 for such taxable year, such excess shall be carried to the succeeding taxable year and added to the credit allowable under subsection A for such succeeding taxable year. Definitions. For the purposes of this section, 1. Qualified solar water heating property expenditure. The term qualified solar water heating property expenditure means an expenditure for property to heat water for use in a dwelling unit located in the United States and used as a residence by the taxpayer if at least half of the energy by such property for such purpose is derived from the sun.
2. Qualified solar electric property expenditure. The term qualified solar electric property expenditure means an expenditure for property which uses solar energy to generate electricity for use in a dwelling unit located in the United States and used as a residence by the taxpayer. 3. Qualified fuel cell property expenditure. The term qualified fuel cell property expenditure means an expenditure for qualified fuel cell property as defined in section 48C1, installed in or on connection with a dwelling unit located in the United States and used as a principal residence within the meaning of section 121 by the taxpayer. Qualified small wind property expenditure. The term qualified small wind energy property expenditure means an expenditure for property which uses a wind turbine to generate electricity for use in connection with a dwelling unit located in the United States and used as a residence by the taxpayer. 5. A qualified geothermal heat pump property expenditure. A. In general, the term qualified geothermal heat pump property expenditure means an expenditure for qualified geothermal heat pump property installed on or in connection with the dwelling unit located in the United States and used as a residence by the taxpayer. B. Qualified geothermal heat pump property. The term qualified geothermal heat pump property means any equipment which 1. Uses the ground or groundwater as a thermal energy source to heat the dwelling unit referred to in subparagraph A, or as a thermal energy sink to cool such dwelling unit, and 2, meets the requirements of the Energy Star program, which are in effect at the time that the expenditure for the ship equipment is made. E. Special rules. For purposes of this section, 1. Labor costs. Expenditures for labor costs properly allocable on the on-site preparation, assembly, or original installation of the property described in subsection, and for piping or wiring to interconnect such property to the dwelling unit shall be taken into account for purposes of this section. 2. Solar panels. No expenditure relating to a solar panel or other property installed as a roof or portion thereof shall fail to be treated as properly described in paragraph 1 or 2 of subsection D, solely because it constitutes a structural component of the structure on which it was installed. Swimming pools, etc., used as storage medium. Expenditures which are properly allocable as a swimming pool, hot tub, or any other energy storage medium which has a function other than the function of such storage should not be taken into account for purposes of this section. Fuel cell expenditure limitations in case of joint occupancy. In the case of any dwelling unit with respect to which qualified fuel cell property expenditures are made and which is jointly occupied and used during any calendar year as a residence by 2 or more individuals, the following rules shall apply. A. Maximum expenditures for fuel cells. The maximum amount of expenditures which can be taken into account under subsection A by all individuals with respect to such dwelling unit during such calendar year shall be $1,667 in the case of each half kilowatt of capacity of qualified fuel cell property as defined in section 48C1. With respect to such expenditures relate. Allocation of expenditures. The expenditures allocated to any individual for the taxable year in which such calendar year ends shall be the amount equal to the lesser of 1. The amount of expenditures made by such individual with respect to such dwelling during such calendar year, or 2. The maximum amount of such expenditures set forth in subparagraph A multiplied by a fraction. What fraction, you might add? Well, the numerator of which is the amount of such expenditures with respect to such dwelling made by such individual during such calendar year, and denominator of which is the total expenditures made by all such individuals with respect to such dwelling during such calendar year. Tenant stockholder in cooperative housing cooperation. In the case of an individual who is a tenant stockholder, as defined in Section 216, in a cooperative housing corporation, as defined in such section, such individual shall be treated as having made his tenant stockholder's proportionate share, as defined in Section 216B3, of any expenditures of such corporation. 6. Condominiums. A, in general, in the case of an individual who is a member of a condominium management association with respect to a condominium which the individual owns, such individual shall be treated as having made the individual's proportionate share of any expenditures of such association. Condominium management association. For purposes of this paragraph, the term condominium management association means an organization which meets the requirements of paragraph 1 of section 528C, other than subparagraph E thereof, with respect to a condominium project, substantially all of the units of which are used as residences. 7. Allocation in certain cases. If less than 80% of the use of an item is for non-business purposes, only that portion of the expenditures for such item which is properly allocable to use for non-business purposes shall be taken into account. When expenditure is made, amount of expenditure. A, in general, except as provided in subparagraph B, an expenditure with respect to an item shall be treated as made when the original installation of the item is completed. Expenditures part of the building construction. I just wanted to try and, the way we're talking, I just got to finish it.
Finish the whole code, right?
It feels weird telling the guy that got me hired, I just want to do this. I got kids.
They're counting on it.
If less than 80% of the use of an item is for non-business purposes, only that portion of the expenditures for that item which is properly allocable to use for non-business shall be taken into account. Okay? Basis adjustments. For purposes of this subtitle, if a credit is allowed under this section for any expenditure with respect to any property, the increase in the basis of such property, which would, but for this subsection, result from such expenditure shall be reduced by the amount of credit so allowed. G. Termination. The credit allowed under this section shall not apply to property placed in service after December 31st, 2016. Did you guys get that?
They want it sung to.
Again? Well, you're gonna have to wait till next time because it's not my turn anymore. I'm done with that section.
I guess where'd the little fuzzy thing go?
Whatever. Just put it on.
Hi. Excuse me while I whip this out. Where were we? Mr. Flores? I don't want to leave the taxpayers in the dark.
I finished here, so you can skip all that.
Oh, I'm skipping historical and statutory notes. 1, 2, 3, 4. Then we've got some library references, some more research references, and why you need research references to do your taxes, I'm not sure. All right, we're getting to something interesting here. We're in the tax code, Title 26, Section 26. Limitation based on tax liability. Definition of tax liability. Limitation. Limitation based on the amount of tax. One. In general, the aggregate amount of credits allowed by this subpart, parenthetical, other than sections 24, 25A1, 25B, 25D, 30, 30B, and 30D, in parenthetical, for the taxable year shall not exceed the excess, parenthetical, if any, of the following. A, the taxpayer's regular tax liability for the taxable year over, gotta do math. B, the tentative minimum tax for the taxable year, parenthetical, determined without regard to the alternative minimum tax, foreign tax credit. Period. For purposes of subparagraph B, the taxpayer's tentative minimum tax for any taxable year beginning during 1999 shall be treated as being 0. All right, we've hit a milestone. We're up to page 300 of the tax code. Only 73,700 pages to go. Which brings us to parenthetical 2, the special rule for taxable years 2000 through 2009, because you know 2000 and 2009 are coming up soon, and you're going to have to, we still need that in the tax code. For purposes of any taxable year beginning during 2000, 2001, 2002, 2003, 2004, 2005, 2006, 2007, 2008, 2009. The aggregate amount of credits allowed by this subpart for the taxable year shall not exceed the sum of, drumroll, the taxpayer's regular tax liability for the taxable year reduced by the foreign tax credit allowable under Section 27A, and B, the tax imposed by Section 55A for the taxable year. Could somebody help me out with that? I was here earlier, and I really intended to share something before while I'm waiting on some water. It's been attributed to either Madison or Hamilton, but something very relevant in Federalist 62. And I quote, "It will be of little avail to the people that the laws are made by men of their own choice. If the laws be so voluminous that they cannot be read, or so incoherent that they cannot be understood, if they be repealed or revised before they are promulgated, or undergo such incessant changes that no man who knows what the law is today can guess what it will be tomorrow. Law is defined to be a rule of action. But how can that be a rule which is little known and less fixed?" Federalist 62. That's what we're supposed to have. That ought to be an addendum in here too. Regular tax liability. For the purposes of this part, 1. In general, the term regular tax liability means the tax imposed by this chapter for the taxable year. But there are exceptions. And 2, exceptions for certain taxes. A through X. For the purposes of paragraph 1, any tax imposed by any of the following provisions shall not be treated as tax imposed by this chapter. Let's read that one again. For the purposes of this part, under exceptions for certain taxes, any tax imposed by any of the following provisions shall not be treated as a tax imposed by this chapter. A, Section 55 relating to minimum tax. B, Section 59A relating to environmental tax. We get taxed for having an environment. They want us to live in a vacuum. C, subsection M5B, Q, T, or V of Section 72, parenthetical, relating to additional taxes on certain distributions. D, Section 143M, relating to recapture of proration of federal subsidy from use of mortgage bonds and mortgage credit certificates. That was all wrapped up in a parenthetical. E, Section 530D4, parenthetical, relating to additional tax on certain distributions from, pay attention, it's a proper name, Coverdell, Coverdell, education savings accounts, in parenthetical. F, Section 531, relating to accumulated earnings tax. G, Section 541, relating to personal holding company tax. H, Section 1351D1, parenthetical, relating to recoveries of foreign expropriation losses. We know how bad foreign expropriation losses are. I, Section 1374, relating to tax on certain built-in gains of S corporations. Some of those non-people. J, Section 1375, parenthetical, relating to tax imposed when passive investment income of corporation having subchapter C earnings and profits exceed 25% of gross receipts. In parenthetical. K, subparagraph A of section 7518 G6, parenthetical, relating to non-qualified withdrawals from capital construction funds taxed at highest marginal rate. L, sections 871A and 881, parenthetical, relating to certain income of non-resident aliens and foreign corporations. M, section 860E, parenthetical E, parenthetical, relating to taxes with respect to certain residual interest, if you're still interested. N, section 884, parenthetical, relating to branch profits tax. O, sections 453L3 and 453AC, parenthetical, relating to interest on certain deferred tax liabilities. Section 860K, relating to treatment of transfers of high yield interest to disqualified holders. Q, section 220F4, relating to additional tax on another proper name, Archer, A-R-C-H-E-R, MSA, all caps, MSA, distributions not used for qualified medical expenses. R, section 138C2, relating to penalty for distributions for Medicare Advantage MSA not used for qualified medical expenses if the minimum balance is maintained, whatever that is. S, sections 106E, 3A, 2 little i's, 223B, 8B, little I, big Roman numeral 2, and 408D, 9D, little I, Roman numeral 2, parenthetical, relating to certain failures to maintain high deductible health plan coverage. T, section 170.03B, parenthetical, relating to recapture of certain deductions for fractional gifts. Fractional gifts, just a partial gift, I guess. U, I don't see a definition for fractional gifts, so maybe there's one in here in another book somewhere. U, section 223F4, relating to additional tax on health savings account distributions not used for qualified medical expenses.
Mr. Lewis, we have a surprise guest who would like to read some of the tax code with us.
Well, he is in luck because I'm up to U of A through X of exceptions for certain taxes. So let me finish the section I'm in, and V, subsections A1BI and B4A of section 409A, relating to interest and additional tax with respect to certain deferred compensation. W, section 36F, relating to recapture of homebuyer credit. And last but not least, these are exceptions for certain taxes that if there is a tax imposed by any of these provisions that I've been reading, A through X, there should not be treated as a tax imposed by this chapter. Don't treat a tax as a tax. A through X of them. X being 457A, Charlie 1B, relating to determinability of amounts of compensation. Does our guest have a name?
Alexander Penley, attorney at law.
Alexander Penley, attorney at law. Would like to give me a break, or give y'all a break from me. He's going to pick up with the tentative minimum tax. Actually, that's going to get into a bunch of the cross references and library references, research references. Historical and statutory notes. Okay, he's going to start at section 27, taxes of foreign countries and possessions of the United States, possession tax credit. Are you ready?
No, they don't.
All right. Drop your gear wherever.
Just somewhere along in there. Up a little higher. Get a lot of.
All right. Starting where?
Starting with and
Taxes of foreign countries and possessions of the United States. Possession tax credit. Subsection 21 of IRS Subtitle A, Chapter 1. Section 20, subsection 27, taxes of foreign countries and possessions of the United States. Possession tax credit. A, foreign tax credit. The amount of taxes imposed by foreign countries and possessions of the United States shall be allowed as a credit against the tax imposed by this chapter to the extent provided in section 901. 27 subsection B, section 936 credit. In the case of a domestic corporation, the amount provided by section 936 relating to Puerto Rico and possession tax credit shall be allowed as a credit against the tax imposed by this chapter. Subsection 28 and 29 are renumbered, so subsection 30. Certain plug-in electric vehicles. A, allowance of credit. There shall be allowed as credit against the tax imposed by this chapter for the taxable year an amount equal to 10% of the cost of any qualified plug-in electric vehicle placed in service by the taxpayer during the taxable year. Subsection 30, subsection B, per vehicle dollar limitation. The amount of the credit allowed under subsection A with respect to any vehicle shall not exceed $2,500. Subsection 30, subsection C, application with other credits. Subsection 30C1, business credit treated as part of a general business credit. So much of the credit which would be allowed under subsection A for any taxable year determined without regard to the subsection that is attributable to property of a character subject to an allowance for depreciation shall be treated as a credit listed in section 38B for such taxable year and not allowed under subsection A. Subsection 30C2, personal credit. Subsection 30C2A. In general,
that's why the mic's right there.
In general, for purposes of this title, the credit allowed under subsection A for any taxable year determined after application of paragraph 1 shall be treated as a credit allowable under subpart A for such taxable year. Subsection 30C2B, limitation based on amount of tax. In the case of a taxable year to which subsection 26A2 does not apply, the credit allowed under subsection A for any taxable year determined after the application of paragraph 1 shall not exceed the excess of subsection 32BI, the sum of the regular tax liability as defined in subsection 26B, plus the tax imposed by section 55 over subsection yada yada Double I, or 2. The sum of the credits allowable under Subpart A, other than this section and sections 25D and 30D, and section 27 for the taxable year. Subsection D, qualified plug-in electric vehicle. For the purposes of this section, subsection D1, in general, the term qualified electric vehicle means a specified vehicle, D1A, the original use of which commences with the taxpayer, D1B, which is acquired for use and leased by the taxpayer and not for resale, subsection D1C, which is made by a manufacturer, subsection D1D, which is manufactured primarily for use on public streets, roads, and highways, subsection D1E, which has a gross vehicle weight rating of less than 14,000 pounds, and subsection D1F, which is propelled to a significant extent by an electric motor which draws electricity from a battery, which subsection D1F1 or I has the capacity of not less than 4 kilowatt hours, 2.5 kilowatt hours in the case of a vehicle with 2 or 3 wheels, and subsection D1F2 or double I is capable of being recharged from an external source of electricity. Subsection D2, specified vehicle. The term specified vehicle means any vehicle which subsection D2A is a low-speed vehicle within the meaning of the section 571.3 of Title 49 Code of Federal Regulations as an effect of the date on the enactment of the American Recovery and Reinvestment Tax Act of 2009, or subsection D2B has 2 or 3 wheels. Subsection D3, manufacturer. The term manufacturer has the meaning given in such term and regulations prescribed by an administrator of the EPA and the Environmental Protection Agency for purposes of the administration of Title II of the Clean Air Act, 42 U.S.C. 7521 et seq. Subsection D4. Battery capacity. The term capacity means, with respect to any battery, the quantity of electricity which the battery is capable of storing expressed in kilowatt hours as measured from a 100% state of charge to a 0% state of charge. Subsection D2E, special rules. Subsection D2E1, basis reduction. For purposes of the subtitle, the basis of any property for which credit is allowable under subsection A shall be reduced by the amount of such credit so allowed. Subsection subsection E2. I read that. Subsection D3, E3, property used by tax exempt entity. In the case of a vehicle, the use of which is described in paragraph 3 or 4 of section 50B, and which is not subject to a lease, the person who sold such vehicle to the person or entity using such vehicle shall be treated as a taxpayer that pays such vehicle and service, but only if such person clearly discloses to such person or entity in the document the amount of any credit allowable under subsection A with respect to such vehicle determined without regard to subsection C. Subsection D4, property used outside the United States not qualified. No credit shall be allowable under subsection A with respect to any property referred to in subsection 50B1. Subsection E5, recapture. The Secretary shall, by regulations, provide for recapturing the benefit of any credit allowable under subsection A with respect to any property which ceases to be property eligible for such benefit. Subsection E6, election not to take credit. No credit shall be allowed under subsection A for any vehicle if the taxpayer elects not to have this section applied to such vehicle. Subsection F, termination. The section shall not apply to any vehicle acquired after December 31st, 2011. Next.
It's up to you.
Yeah, I'm out of breath.
Been a pleasure. Thank you for dropping by.
Absolutely.
We've only got 69,000 pages to go.
I have a union meeting I must go to now. So.
Wait. I'm gonna get.
Thank you, sir.
Because it's kind of hooked on the chair.
Yep. And my card. I'm an attorney.
My pleasure.
Thank you, sir.
And thank you.
Pleasure.
I looked you up. We were actually already friends.
Oh, cool.
You're back, stuck with me. That was Penley, Alexander Penley from Penley Global Law, helping us share the tax code with you. Penley, Alex, where'd you leave off it? Was it?
At the end of the end there.
Oh, right
so
here.
Next.
Okay.
All right, fantastic.
So we're in Title 26, Section 30. And in the historical and statutory notes for Title 26, Section 30, there are 1, 2, 3, almost 3 pages of amendments that's been made to Section 30. We'll suffer you through that. Library references, research references. Section 30A, Title 26, Puerto Rico Economic Activity Credit. A, allowance for credit. In general, except as otherwise provided in this section, if the conditions of both paragraph 1 and 2 of subsection B are satisfied with respect to a qualified domestic corporation, there shall be allowed as a credit against the tax imposed by this chapter an amount equal to the portion of the tax which is attributable to the taxable income from sources without the United States, from A, the active conduct of a trade or business within Puerto Rico, or B, the sale or exchange of substantially all of the assets used by the taxpayer in the active conduct of such trade or business. In the case of any taxable year beginning after December 31st, 2001, the aggregate amount of taxable income taken into account under the preceding sentence, parenthetical, and in applying subsection D, double in parent, shall not exceed the adjusted base period income of such corporation as determined in the same manner as under section 936J. Hope you understood that. 2, qualified domestic corporation. This is still under Puerto Rico Economic Activity Credit, allowance of credit. A qualified domestic corporation in Puerto Rico, for purposes of paragraph 1, the term qualified domestic corporation means a domestic corporation which, A, is an existing credit claimant with respect to Puerto Rico, and B, with respect to which section 936A4B does not apply for the taxable year. 3, separate application. For purposes of determining A, whether a taxpayer is an existing credit claimant with respect to Puerto Rico, and B, the amount of the credit allowed under this section, and so much of section 936 as relates to this section shall be applied separately with respect to Puerto Rico. There's a lot of respect there. B, conditions which must be satisfied. The conditions referred to in subsection A, which is what we just read, are 1, a 3-year period if 80% or more of the gross income of the qualified domestic corporation for the 3-year period immediately preceding the close of the taxable year, parenthetical, or for such part of such period immediately preceding the close of such taxable year as may be applicable, was derived from sources within a possession, parenthetical, determined without regard to section 904F. Another condition, trade or business. If 75% or more of the gross income of the qualified domestic corporation for such period or such part thereof was derived from the active conduct of a trade or business within a possession. Is that I don't know what a possession is. Possession of the United States, possession of Puerto Rico, possession of the taxpayer, it doesn't specify. Perhaps that's somewhere else in here. C, credit not allowed against certain taxes. The credit provided by subsection A shall not be allowed against the tax imposed by 1, Section 59A relating to the environmental tax, Section 531 relating to tax on accumulated earnings, 3, Section 541 relating to personal holding company tax. I'm sparing you some parentheticals. Or 4, Section 1351 relating to recoveries of foreign expropriation losses. D, limitations on credit for active business income, all related to Title 26, Section 38, Puerto Rico Economic Activity Credits. D, limitations on that credit for active business income. The amount of the credit determined under Section A for any taxable year shall not exceed the sum of the following amounts. Get your calculators out. 60% of the sum of, and don't use Common Core math. A, the aggregate amount of the qualified domestic corporation's qualified possession wages for such taxable year, plus B, the allocable employee fringe benefit expenses of the qualified domestic corporation for such taxable year. 2, the sum of 15% of the depreciation allowances for the taxable year with respect to short life qualified tangible property. Mayflies. B, you're still summing these, right? B, 40% of the depreciation allowances for the taxable year with respect to medium life qualified tangible property, plus C, 65% of the depreciation allowances for the taxable year with respect to long life qualified tangible property. So you got short, medium, long life properties, 15, 40, and 65% of each of those. And then you take 60% of that, and that'll get you the limit on credit for active business income that can't go above that number for a Puerto Rico economic activity credit and the allowance of the credit. So I don't live in Puerto Rico for that reason alone. B. E. If the qualified domestic corporation does not have an election to use the method described in Section 936H5C2, that's two little I's, of the qualified possession income taxes for the taxable year allocable to non-sheltered income, not even a complete sentence, so I'm not sure what they're saying there. E, administrative provisions. They must have had a public education. For purposes of this title, 1, the provisions of Section 936, parenthetical, including any applicable election thereunder, shall apply in the same manner as if the credit under the section were a credit under another section. 936A1A for domestic corporation to which Section 936A4A applies. 2, these are administrative provisions. The second one is, the credit under this section shall be treated in the same manner as the credit under Section 936. And, last but not least, 3, a corporation to which this section applies shall be treated in the same manner as if it were a corporation electing the application of Section 936. So you don't get a double dipping. F is the denial of double benefit. Any wages or other expenses taken into account in determining the credit under this section may not be taken into account in determining the credit under Section 41. So if you live in Puerto Rico and you take the economic activity credit under Section 30A, you can't take it from 41. According to this. G, definitions. We need some definitions. For purposes of this section, any term used in this section, which is also used in Section 936, shall have the same meaning given such term by Section 936. H, application of section. This section shall apply to taxable years beginning after December 31st, 1995 and before January 1st, 2006. Another page of historical and statutory notes, library references, other references. Title 26, Section 30, Bravo. The alternative motor vehicle credit. A is the allowance of the credit for an alternative motor vehicle credit. That's your second car maybe. There shall be allowed as a credit against the tax imposed by this chapter for the taxable year an amount equal to the sum of, you got to do more math, 1. The new qualified fuel cell motor vehicle credit determined under subsection B. 2. The new advanced lean burn technology motor vehicle credit determined under subsection C. 3. The new qualified hybrid motor vehicle credit determined under subsection D. 4. The new qualified alternative fuel motor vehicle credit determined under subsection E. 5. The plug-in conversion credit determined under subsection I. Or 6. The sale or manufacture of dilithium crystals used in warp power on starships. No, that's not there. Just checking if you're listening. B. New qualified fuel cell, so you can still take your dilithium crystal credit. Unless it's denied somewhere else here. B. New qualified fuel cell motor vehicle credit. In general. For purposes of subsection A, the new qualified fuel cell motor vehicle credit determined under this subsection with respect to a new qualified fuel cell motor vehicle placed in service by the taxpayer during the taxable year is, drumroll, A, $8,000, $4,000 in the case of a vehicle placed in service after December 31st, 2009, if such vehicle has a gross vehicle weight rating of not more than 8,500 pounds. So you full-size pickup guys can still keep it. They're around 5,000 pounds. B, $10,000 credit if such vehicle has a gross vehicle weight rating of more than 8,500 pounds, but not more than 14,000. C, $20,000 credit if such vehicle has a gross vehicle weight rating of more than 14,000 pounds, 7 tons, but not more than 26,000 pounds, 13 tons. D, $40,000 tax credit for a new qualified fuel cell motor vehicle if such vehicle has a gross vehicle weight rating of more than 26,000 pounds. 2, increase for fuel efficiency. The amount determined under paragraph 1A, and that's where you get your $8, $10, or $20 or $40,000 credit. If the amount determined under paragraph 1A with respect to a new qualified fuel cell motor vehicle, which is a passenger automobile or light truck, shall be increased by, your credit's going up. If one, $1,000 if such vehicle achieves at least 150%, but less than 175% of the 2000 year model year city fuel economy. 2. These are little 2. $1,500 if such vehicle achieves at least 175%, but less than 200% of the 2002 model year city fuel economy. Little 3, little I. $2,000, and this is on top of the amount in A or B1. These are bonus credits for your qualified fuel cell motor vehicle credit. $2,000 if such vehicle achieves at least 200% or less than 225 of the 2002 model year city fuel economy. $2,500 if it's at least 225% but less than 250% of the 2002 model year city fuel economy. $3,000 more to your credit if such vehicle achieves at least 250% but less than 275% of the 2002 model year city fuel economy. Little 6. $3,500 if such vehicle achieves at least 275% but less than 300% of the 2002 model year city fuel economy. And they had to stop somewhere. So if your new qualified fuel cell motor vehicle credit actually exceeds at least 300% of the 2002 model year city fuel economy, you can add another $4,000 to the tax credit that you were getting, 8, 10, 20, or 40, based on the weight. That was described in Title 26, Section 30B, subsection or clause B1, A through D. In the case of a passenger motor vehicle, the 2002 model year city fuel economy, if the vehicle inertia weight class is 1,500 or 1,750 pounds, 45.2 miles per gallon, 2,250 pound vehicle, 39.6 miles per gallon, 2,250 pounds, 35.2 miles per gallon, 2,500 pounds, 31.7 miles per gallon, 2,750 pounds, 28.8 miles per gallon, 3,000 pounds, 26.4 miles per gallon, 3,500 pounds, 22.6 miles per gallon, 4,000 pounds, 19.8 miles per gallon, 4,500 pounds, 17.6, 6,000, 13.2, 6,500, 12.2, 7,000, 8,500 pounds, 11.3 miles per gallon. So we have the fuel economy for city for the 2002 model year for just about every weight class of vehicle right here in the tax code. That's where it belongs, right? Thought I was in motorcraft for a minute there. Oh, I wasn't done. That was for a passenger vehicle. In the case of a light truck, we also have all the weight classes and the 2002 model year city, not country, city fuel economy.
Halfway through?
Oh! Volume 1.
Chipping away.
Rome wasn't built in a day. So if you have a light truck and it was a 2002, back when you bought it new, because it had to be new, you could get that tax credit. C, the vehicle inertial weight class. For purposes of subparagraph B, the term vehicle inertia weight class has the same meaning as when defined in regulations prescribed by the Administrator of the Environmental Protection Agency for purposes of the administration of Title II of the Clean Air Act, 42 U.S.C. 7521 et sec. 3. A new qualified fuel cell motor vehicle. For purposes of this subsection, The term new qualified fuel cell motor vehicle means a motor vehicle which A, is propelled by power derived from one or more cells which convert chemical energy directly into electricity by combining oxygen with hydrogen fuel, which is stored on board the vehicle in any form and may or may not require reformation prior to use. You may need a chemist for this. B, for your new qualified fuel cell motor vehicle, under Title 26, Section 30B, Clause 3B, which in case of a passenger automobile or light truck has received on or after the date of the enactment of this section a certificate that such vehicle meets or exceeds the formal name BIN, BIN, number 5, Tier 2, emission level established in regulations prescribed by the Administrator of the Environmental Protection Agency under Section 202I of the Clean Air Act for that make and model year vehicle. C, the original use of which commences with the taxpayer. D, which is required for use or lease by the taxpayer and not for resale, so you didn't steal it. That's good. And E, which is made by a manufacturer, which means it didn't come from like manna from heaven. It didn't grow out of the ground, and you didn't build it in your garage, unless you're a manufacturer. 1. For new advanced lean burn technology motor vehicle credit, in general, for purposes of subsection A, the new advanced lean burn technology motor vehicle credit determined under this subsection for the taxable year is the credit amount determined under paragraph 2 with respect to a new advanced lean burn technology motor vehicle placed in service by the taxpayer during the taxable year. 2. Credit amount. Clause A, fuel economy. Little I, in general, the credit amount determined under this paragraph shall be determined in accordance with the following table. See following table. Following table. In the case of a vehicle which achieves a fuel economy expressed as a percentage of the 2002 model year city fuel economy of at least 125%, to less than 150%, the credit amount is $400. If it's at least 150% but less than 175%, $800. At least 175% but less than 200%, $1,200. At least 200% but less than 225%, $1,600. At least 225% but less than 250%, $2,000. At least 250%, $2,400. The 2002 model year city fuel economy. 2. For the purposes of Clause I, 2002 model year fuel economy with respect to a vehicle. You don't respect any vehicle, say a lot about it. Shall be determined on a gasoline gallon equivalent basis as determined by the Administrator of the Environmental Protection Agency using the tables provided in subsection B2B. So we're B2B, or not to be. So that would be the ones on the previous page with respect to such vehicle. B, conservation credit. The amount determined under subparagraph A with respect to a new advanced lean burn as opposed to a fat burn technology motor vehicle shall be increased by the conservation credit amount determined in accordance with the following table. In the case of a vehicle which achieves a lifetime fuel savings expressed in gallons of gasoline at least 1,200 but less than 1,800 gallons saved, the conservation credit amount is $250. If the expressed in gallons of gasoline saved is at least 1,800 but less than 2,400, $500 credit, conservation credit amount is. If it's at least 2,400 but less than 3,000 gallons saved over the lifetime of that vehicle, save $750 for the conservation credit. And if your lean burn, new lean advanced lean burn technology motor vehicle saves at least 3,000 gallons of fuel, gasoline fuel, measured in gallons, over the lifetime of the vehicle, you get a $1,000 conservation credit. 3. New advanced lean burn technology motor vehicle. For the purposes of this subsection, the term new advanced lean burn technology motor vehicle means a passenger automobile or a light truck. A, with an internal combustion engine, which is designed to operate primarily using more air than is necessary for combustion of the fuel. 2, incorporates direct injection. 3, achieves at least 125% of the 2002 model year city fuel economy. Roman numeral 4, for 2004 and later model vehicles, has received a certificate that such vehicle meets or exceeds 1. In the case of a vehicle having a gross vehicle weight rating of 6,000 pounds or less, the BEN 5 Tier 2 emission standard established in regulations prescribed by the administrator of the Environmental Protection Agency under Section 202I of the Clean Air Act for that make and model year vehicle, and big Roman numeral 2 there, in the case of a vehicle having a gross vehicle weight rating of more than 6,000 pounds but not more than 8,500 pounds, the BEN 8 Tier 2 emission standard, which is so established. B. We'll get back to what A was. New advanced lean burn technology motor vehicle. We're still describing those. The original use of which commences with the taxpayer, which is required for use or lease. We're going there again, apparently. By the taxpayer and not for resale. D, which is made by a manufacturer. And 4, lifetime fuel savings. For purposes of this subsection, the term lifetime fuel savings means, in the case of any new advanced lean burn technology motor vehicle, a Prius, I guess, maybe, or maybe my Equinox, an amount equal to the excess, if any, of A, 120, get your calculator out again, 120,000 divided by the 2002 model year city fuel economy for the vehicle inertia weight class, over B, 120,000 divided by the city fuel economy for such vehicle. A lot of hot air here in Washington today. It's about to blow our tent down. D, a new qualified hybrid motor vehicle credit. 1, in general, for purposes of subsection A, the new qualified hybrid motor vehicle credit determined under this subsection for the taxable year is the credit amount determined under paragraph 2 with respect to a new qualified hybrid motor vehicle placed in service by the taxpayer during the taxable year. 2, the credit amount, well, that's broken down as well. A, credit amount for passenger automobiles and light trucks. In the case of a new qualified hybrid motor vehicle, which is a passenger automobile or light truck, and which has a gross vehicle weight rating of not more than 8,500 pounds, the amount determined under this paragraph is the sum of the amounts determined under clauses 1 and 2. Fuel economy is also taken into consideration for your credit amount. The amount determined under this clause is the amount which would be determined under subsection C to A if such vehicle were a vehicle referred to in such subsection. I'll read that one again. The amount determined, and this is your fuel economy portion of the credit amount for a new qualified hybrid motor vehicle credit, the fuel economy is determined under this clause. The amount which would be determined under subsection C2A if such vehicle were a vehicle referred to in such subsection. So treat it the same way you treat metal. 2. Conservation credit. The amount determined under this clause is the amount which would be determined under subsection C2B if such vehicle were a vehicle referred to in such subsection. Credit amount for other motor vehicles. It's under clause B. In general, in the case of any new qualified hybrid motor vehicle to which subparagraph A does not apply. I keep hearing hybrid. I'm a Whovian. The hybrid was bad. The amount determined under this paragraph is the amount equal to the applicable percentage of the qualified incremental hybrid cost of the vehicle as certified under clause little v. Little 2, applicable percentage. For purposes of clause 1, the applicable percentage is, and we're going to go through 1, 2, 3 of those, 20% if the vehicle achieves an increase in city fuel economy relative to a comparable vehicle of at least 30%, but less than 40%. I'm not sure what we're comparing on the vehicles. 2, 30% if the vehicle achieves such an increase of at least 40%, but less than 50%. And 3, not or, and 40% if the vehicle achieves such an increase of at least 50%. So the applicable percentage for the purposes of clause I include 40% of something that has an increase of at least 50%. Okay. Little 3, parenthetical. Qualified incremental hybrid cost. For purposes of this subparagraph, the qualified incremental hybrid cost of any vehicle is equal to the amount of the excess of the manufacturer's suggested retail price for such vehicle over such price for a comparable vehicle to the extent such amount does not exceed, and we've hit the 3s, 333, page 333 in your hymnal, and this would be Title 26, USCA 26, Section 1 through 45R in the United States Code annotated. We had a query. So where were we? Your qualified incremental hybrid cost, $7,500 if the vehicle, such vehicle, has a gross vehicle weight rating of not more than 14,000 pounds. 2, the Roman numeral 2. 15,000 if such vehicle has a gross vehicle weight rating of more than 14,000 but not more than 26,000 pounds. And 3, and that's Roman numeral parenthetical 3. $30,000 if such vehicle has a gross vehicle weight rating of more than 26,000 pounds. Parenthetical little Roman numeral 4, comparable vehicle. For purposes of this subsection, the term comparable vehicle means, with respect to any new qualified hybrid motor vehicle, any vehicle which is powered solely by a gasoline or diesel internal combustion engine and which is comparable in weight, size, and use to such vehicle. So how you use it matters too. Certification. A certification described in clause I shall be made by the manufacturer and shall be determined in accordance with guidance prescribed by the Secretary. Such guidance shall specify procedures and methods for calculating fuel economy savings an incremental hybrid cost. 3, and this is a little 3 under new qualified hybrid motor vehicle. For purposes of this subsection, on page 334 of U.S. Code annotated Title 26, Section 30B, Clause 3, new qualified hybrid motor vehicle. For purposes of this section, A, in general, the term new qualified hybrid motor vehicle means a motor vehicle, 1, which draws propulsion energy from onboard sources of stored energy, which are both 1, an internal combustion or heat engine using consumable fuel, and 2, a rechargeable energy storage system, batteries. 2A applies, has received a certificate of conformity under the Clean Air Act and meets or exceeds the equivalent qualifying California low-emission vehicle standard under Section 243E2 of the Clean Air Act for that make and model year, and 1, in the case of a vehicle having a gross vehicle weight rating of 6,000 pounds or less, the BEN 5 Tier 2 emission standard established in regulations prescribed by the Administrator of the Environmental Protection Agency under Section 202I of the Clean Air Act for that make and model year vehicle, and 2, in the case of a vehicle having a gross vehicle weight rating of more than 6,000 pounds but not more than 8,500 pounds, the BEN 8 Tier 2 emission standard, which is so established. Little 3, which has a maximum available power of at least, and there are 3 of those. 1, 4% in the case of a vehicle to which paragraph 2A applies, 10% in the case of a vehicle which has a gross vehicle weight rating of more than 8,500 pounds, not more than 14,000 pounds, and 3, 15% in the case of a vehicle in excess of 14,000 pounds. Little 4, IV, which, in the case of a vehicle to which paragraph 2B applies, has an internal combustion or heat engine which has received a certificate of conformity under the Clean Air Act as meeting the emission standards set in the regulations prescribed by the Administrator of the Environmental Protection Agency for 2004 through 2007 model year diesel heavy-duty engines or auto-cycle heavy-duty engines as applicable. The original use of which commences with the taxpayer. Little 6, which is acquired for use or leased by the taxpayer and not for resale. And little 7, which is made by a manufacturer. Again, you can't build this in your garage. Such terms shall not include any vehicle which is not a passenger automobile or light truck if such vehicle has a gross vehicle weight rating of less than 8,500 pounds. So if you want a new qualified hybrid motor vehicle, according to this, you ain't getting it if it weighs less than 8,500 pounds. Consumable fuel. For purposes of subparagraph A, July 1, the term consumable fuel means any solid, liquid, or gaseous matter which releases energy when consumed by an auxiliary power unit. So you need an engineer or 2 to do your taxes. C, maximum available power. Maximum effort. Deadpool. Little I, certain passenger automobile and light trucks. In the case of a vehicle to which paragraph 2A applies, the term maximum available power means the maximum power available from the rechargeable energy storage system during a standard 10-second pulse power or equivalent test, divided by such maximum power and the SAE net power of the heat engine. 2, for other motor vehicles, in the case of a vehicle which paragraph 2B applies, the term maximum available power means the maximum power available. Brilliant. From the rechargeable energy storage system during a standard 10-second pulse power or equivalent test divided by the vehicle's total traction power. I could see going to my mechanic and telling him I need him to check the maximum power available from the rechargeable energy storage system in my car during a standard 10-second pulse power test divided by the vehicle's total traction power. I won't repeat what he would probably say. For purposes of the preceding sentence, the term total traction power means the sum of the peak power from the rechargeable energy storage system and the heat engine peak power of the vehicle, except that if such storage system is a sole means by which the vehicle can be driven, the total traction power is the peak power of such storage system. D. Exclusion of plug-in vehicles. Any vehicle with respect to a credit which is allowable under Section 30D, parenthetical, and back to those, determined without regard to subsection C thereof, shall not be taken into account under this section. Now, for a new qualified alternative fuel motor vehicle credit,
So, I mean, at this point, I think we can just leave it here, but it's not for sure.
because that was for the qualified incremental hybrid cost credit, or that was the new qualified hybrid motor vehicle credit. And now we're into the new qualified alternative fuel motor vehicle credit. 1. Allowances of credit. Except as provided in paragraph 5, the new qualified alternative fuel motor vehicle credit determined under this subsection is an amount equal to the applicable percentage of the incremental cost of any new qualified alternative fuel motor vehicle placed in service by the taxpayer during the taxable year. If that ain't BS, I've never read it. Actually, I have. I read some earlier. 2. Applicable percentage. For purposes of paragraph 1, the applicable percentage with respect to any new qualified alternative fuel motor vehicle is A, 50% or plus, B, 30%, if such vehicle, little one, has received a certification of conformity under Clean Air Act and meets or exceeds the most stringent standard available for certification under the Clean Air Act for that make and model year vehicle, parenthetical, other than a zero emission standard, or, little 2, has received an order certifying the vehicle as meeting the same requirements as vehicles which may be sold or leased in California and meets or exceeds the most stringent standard available for certification under state laws in California, parenthetical, enacted in accordance with a waiver granted under Section 209B of the Clean Air Act, for that make and model year vehicle, parenthetical, other than a zero emission standard. That calls for a swallow of water. You wash that down. Water, because they won't allow us beer or whiskey here on the sidewalk in front of the Internal Revenue Service. Three, new qualified vehicle. New qualified hybrid motor vehicle. Oh, the wind blew my page over. Sorry. Well, let's get the water. Let me get back to 337. The incremental cost. And this is for your new qualified alternative fuel motor vehicle credit. For purposes of this subsection, The incremental cost of any new qualified alternative fuel motor vehicle is equal to the amount of the excess of the manufacturer's suggested retail price for such vehicle over such price for a gasoline or diesel fuel motor vehicle of the same model, to the extent that such amount does not exceed. A. We're back to the weight stuff. 5,000 if such vehicle has a gross vehicle weight rating of not more than 8,500 pounds. B. $10,000 if such vehicle has a gross vehicle weight rating of more than 8,500 pounds but not more than 14,000 pounds. Or C. 25,000 if such vehicle has a gross vehicle weight rating of more than 14,000 but not more than 26,000 pounds. And D. $40,000 credit if such vehicle has a gross vehicle weight rating of more than 26,000 pounds. I can see where attention deficit could be a problem reading this, making sense of it, without strings and chewing gum, and post-it notes and markers. 4. New qualified alternative fuel motor vehicle. For purposes of this subsection, A. In general, the term new qualified alternative fuel motor vehicle means any motor vehicle which, and there's 4 qualifiers, which is only capable of operating on an alternative fuel. 2, the original use of which commences with the taxpayer. You bought it for your use. 3, which is acquired by the taxpayer for use or lease but not for resale, so you didn't steal it again. And 4, which is made by a manufacturer, not in your garage. B, alternative fuel. The term alternative fuel means compressed natural gas, liquefied natural gas, liquefied petroleum gas, hydrogen, and any liquid, at least 85% of the volume of which consists of methanol.
Absolutely.
Speaking of mixed fuels. 5, credit for mixed fuel vehicles. A, in general, in the case of a mixed fuel vehicle placed in service by the taxpayer during the taxable year, the credit determined under this subsection is an amount equal to 1, in the case of a 75-25 mixed fuel vehicle, 70% of the credit which would have been allowed under this subsection if such vehicle was a qualified alternative fuel motor vehicle. And in the case of a 90-10 mixed fuel vehicle, 90% of the credit which would have been allowed under this subsection if such vehicle was a qualified alternative fuel motor vehicle. B, a mixed fuel vehicle. For the purposes of this subsection, the term mixed fuel vehicle means any motor vehicle described in subparagraph C or D of paragraph 3, which 1, is certified by the manufacturer as being able to perform efficient in normal operation on a combination of an alternative fuel and petroleum-based fuel. 2, either has received a certificate of conformity under the Clean Air Act, or has received an order certifying the vehicle as meeting the same requirements as vehicles which may be sold or leased in California and meets or exceeds the low emission vehicle standard under sections 88.105-94 of Title 40 Code of Federal Regulations for that make and model of your vehicle. 3, the original use commences with the taxpayer and little IV4, which is acquired by the taxpayer for use or lease, but not for resale. No stealing. That's the government's job. 5, which is made by a manufacturer not in your garage. C, 75-25 mixed fuel vehicle. For purposes of this subsection, the term 75-25 mixed fuel vehicle means a mixed fuel vehicle, which operates using at least 75% alternative fuel and not more than 25% petroleum-based fuel. D, a 90-10 mixed fuel vehicle. For the purposes of this subsection, the term 90-10, and this is a fraction. I don't know if they still do fractions in school. Fractions. 90/10 mixed fuel vehicle means a mixed fuel vehicle which operates using at least 90% alternative fuel and not more than 10% petroleum-based fuel. There are limitations on the number of new qualified hybrid and advanced lean burn technology vehicles eligible for the credit. Get them while they're going, while they're hot. Get these credits while they're hot. In general, in the case of a qualified vehicle sold during the phase-out period, only the applicable percentage of the credit otherwise allowable under subsection C or D shall be allowed. 2. Phase-out period. For purposes of this subsection, the phase-out period is the period beginning with the second calendar quarter following the calendar quarter, which includes the first date on which the number of qualified vehicles manufactured by the manufacturer of the vehicle referred to in paragraph 1 sold for the use in the United States after December 31st, 2005 is at least 60,000. What is at least 60,000? Didn't really say. The applicable percentage. For the amount of for the purposes of paragraph 1, the applicable percentage is A, 50% for the first 2 calendar quarters of the phase-out period, B, 25% of the 3rd and 4th calendar quarters of the phase-out period, and C, 0 for each calendar quarter thereafter. So if you don't get it in the first 2 calendar quarters or the 3rd and the 4th calendar quarter of the phase-out period, goose egg credit for each calendar quarter thereafter. Controlled groups. We know the government likes controlling us. Controlled groups in general. A, for purposes of this subsection, all persons treated as a single employer under subsection A or B of section 52 or subsection M or O of section 414 shall be treated as a single manufacturer. B, inclusion of foreign corporations. For purposes of subparagraph A, in applying subsections A and B of section 52 to this section, section 1563 shall be applied without regard to section B2C thereof. I feel so much better about that. 5, qualified vehicle. For purposes of this subsection, the term qualified vehicle means any new qualified hybrid motor vehicle, parenthetical described in subsections D to A, and any new advanced lean burn technology motor vehicle. G, the application, G, application with other credits. 1, business credit treated as part of a general business credit. For so much, and I quote, so much of the credit which would be allowed under subsection A for any taxable year, parenthetical, determined without regard to this subsection, that is attributable to property of a character subject to an allowance for depreciation, shall be treated as a credit listed in section 38B for such taxable year and not allowed under subsection A. That's a business credit treated as part of general business credit. 2, personal credit. In general, A, for purposes of this title, the credit allowed under subsection A for any taxable year determined after application of paragraph 1 shall be treated as a credit allowed under subpart A for such taxable year. B, limitation based on amount of tax. In the case of a taxable year to which section 26A2 does not apply, credit allowed under subsection A for any taxable year, parenthetical, determined after application to paragraph 1, don't forget to apply paragraph 1, shall not exceed the excess of 2 things. Well, more math, more ambulances, the sum of the regular tax liability as defined in Section 26B plus the tax imposed by Section 55 over, so you got to divide, by the sum of the credits allowable under subpart A, parenthetical, other than this section in sections 25D, 30, and 30D, in parenthetical, and section 27 for the taxable year. H, other definitions and special roles. For purposes of this section, 1, motor vehicle. The term motor vehicle means any vehicle which is manufactured primarily for use on public streets, roads, and highways, parenthetical, not including a vehicle operated exclusively on a rail or rails, and which has at least 4 wheels. We needed to define that. 2, city fuel economy. City fuel economy with respect to any vehicle shall be measured in a manner which is substantially similar to the manner city fuel economy is measured in accordance with procedures under Part 600 of Subchapter Q of Chapter 1 of Title 40 Code of Federal Regulations as in effect on the date of the enactment of this section. Other terms. I'm going to finish this section. I got 3 more pages and you can have it. I will. Oh, you're like, where'd you go? I see they all left. All right, other definitions and special rules. We're on page 339 of the U.S. Code, annotated, Title 26, Section 30B, Clause D, it looks like. Subsection H, other definitions and special rules. For the purposes of this section, we're going to define motor vehicles again, huh? No, we already did the 4 wheels. And we got the city economy. The city fuel economy with respect to any vehicle shall be measured. Yeah, we're doing that again. We keep measuring that. Shall be measured in a manner which is substantially similar to the manner city fuel economy is measured in accordance with procedures under Part 600 of Subchapter Q of Chapter 1 of Title 40 Code of Federal Regulations as in effect on the date of the enactment of this section. I had read that. Other terms. The terms automobile, passenger automobile, medium-duty passenger vehicle, light truck, and manufacturer have the meanings given such terms in regulations prescribed by the administrator of the Environmental Protection Agency for purposes of the administration of Title II of the Clean Air Act, 42 U.S.C. 7521, etc. 4. Reduction in basis. For the purposes of this subtitle, the basis of any property for which a credit is allowable under subsection A shall be reduced by the amount of such credit so allowed, parenthetical, determined without regard to subsection G. 5. No double benefit, no double dipping. The amount of any deduction or other credit allowable under this chapter has 2 parts, A and B. For any incremental cost taken into account in computing the amount of the credit determined under subsection E shall be reduced by the amount of such credit attributable to such cost. And B, with respect to a vehicle described under subsection B or C, shall be reduced by the amount of credit allowed under subsection A for such vehicle for the taxable year. 6. Property used by tax-exempt entity. In the case of a vehicle whose use is described in paragraph 3 or 4 of section 50 Bravo, and which is not subject to a lease, the person who sold such vehicle to the person or entity using such vehicle shall be treated as a taxpayer that placed such vehicle in service, but only if such person clearly discloses to such person or entity in a document the amount of any credit allowable under subsection A with respect to such vehicle determined without regard to subsection G. For purposes of subsection G, property to which this paragraph applies shall be treated as of a character subject to an allowance for depreciation. 7. Property used outside the United States, etc., not qualified. No credit shall be allowable under subsection A with respect to any property referred to in section 50B1 or with respect to the portion of the cost of any property taken into account under section 179. Recapture. 8. The Secretary shall, by regulations, provide for recapturing the benefit of any credit allowable under subsection A with respect to any property which ceases to be property eligible for such credit, including recapture in the case of a lease period of less than the economic life of the vehicle. And this has got a footnote, which we won't get to, except that no benefit shall be recaptured if such property ceases to be eligible for such credit by reason of conversion to a qualified plug-in electric drive motor vehicle. Election to not take credit. No, give credit where credit's due, but not where it's not. No credit shall be allowed under subsection A for any vehicle if the taxpayer elects to not have this section apply to such vehicle. Election to not take the credit. You don't have to take the money. You don't have to take your money back. No credit shall be allowed. They're not going to allow a tax credit if you elect not to take it, not to apply that section to your vehicle. 10. Interaction with air quality and motor vehicle safety standards. Unless otherwise provided in this section, a motor vehicle shall not be considered eligible for a credit under this section unless such vehicle is in compliance with A. The applicable provisions of the Clean Air Act for the applicable make and model of the year vehicle, or applicable air quality provisions of state law in the case of a state which has adopted such provision under a waiver under Section 209B of the Clean Air Act, and B, the motor vehicle safety provisions of Sections 30101 through 30169 of Title 49 U.S. Code. I, plug-in conversion credit. We're almost to you, Mr. Flores. Plug-in conversion credit. In general, for purposes of subsection A, the plug-in conversion credit determined under this subsection with respect, they got so much respect. How are you feeling it? To any motor vehicle which is converted to a qualified plug-in electric drive motor vehicle is 10% of so much of the cost of the converting such vehicle as does not exceed $40,000. I bet they struggle putting estimates together. 2. Plug-in conversion credits. 2. Qualified plug-in electric drive motor vehicle. For purposes of this subsection, the term qualified plug-in electric drive motor vehicle means any new qualified plug-in electric drive motor vehicle. Parenthetical as defined in Section 30D, determined without regard to whether such vehicle is made by a manufacturer, hey, you can make this one in your garage maybe, or whether the original use of such vehicle commences with the taxpayer. Maybe you could have stole this one. 3. Looks like if you stole your neighbor's car and ripped the motor out and put a couple of batteries in it, you might could get a tax credit for that because they're not requiring you be the original buyer or that you get it from a bona fide manufacturer. 3. Credit allowed in addition to other credits. The credit allowed under this subsection shall be allowed with respect to a motor vehicle, notwithstanding, that means regardless of, whether a credit has been allowed with respect to such motor vehicle under this section, parenthetical, other than this subsection, in any preceding taxable year. 4. Termination. This subsection shall not apply to conversions made after December 31st, 2011. So unless you have a TARDIS or some other kind of time machine, you can go back and do your plug-in electric drive motor vehicle conversion prior to December 31st, 2011. You can't take that credit. Regulations. 1. In general, except as provided in paragraph 2, the Secretary shall promulgate such regulations as necessary to carry out the provisions of this section. 2. Coordination and prescription of certain regulations. The Secretary of the Treasury, in coordination with the Secretary of Transportation and the Administrator of the Environmental Protection Agency, shall prescribe such regulations as necessary to determine whether a motor vehicle meets the requirements to be eligible for credit under this section. So the Secretary of the Treasury, in cooperation or coordination with the Secretary of Transportation and the Administrator of the EPA, is going to prescribe regulations as necessary to determine whether or not your vehicle meets the requirements for the credit under this section. That's a lot of man hours there. Termination. Okay. This section shall not apply to any property purchased after 1. In the case of a new qualified fuel cell motor vehicle, as described in subsection D, which was like back on like 334. But section 30B of Title 26. In the case of a new qualified fuel cell motor vehicle, described in subsection D, December 31, 2014. 2. In the case of a new advanced lean burn technology motor vehicle, parenthetical, as described in subsection C, or a new qualified hybrid motor vehicle as described in subsection D2A, December 31st, 2010. You're going to go further back in time to get this one. 3. In the case of a new qualified hybrid motor vehicle as described in subsection D2B, December 31st, 2009. 4. In the case of a new qualified alternative fuel vehicle as described in subsection E, December 31st, 2010. Now, termination of amendments for application and extensions of ECTRA sunset provisions by Public Law 111-148, Section 10909D. See sunset provisions note set out under this section. The rest of page 342 of Volume 1 of the U.S. Code Annotated, Title 26, Section 30B, has historical and statutory notes beginning at about halfway down page 342, consumes that, and page 343 and 344. Then we get into library references, research references, treatises, and practice aids. And that, my friends, is the Tax Code, Title 26, Section 30B. Our good friend, Mr. Brandon Flores, is going to pick up here with Title 26, Section 30C, the Alternative Fuel Vehicle Refueling Property Credit. I'm sure it will be exciting. Mr. Flores.
Mr. Lewis.
Do tell us about the Alternative Fuel Vehicle Refueling Property Credit.
I certainly will. All right. All right, Tasha, pay attention. We're at section 30C. You with me? Okay. Alternative fuel vehicle refueling property credit. Section A. Credit allowed. There shall be allowed as a credit against the tax imposed by this chapter for the taxable year in amount equal to
30% of the cost of any qualified alternative fuel vehicle refueling property placed in service by the taxpayer during the taxable year. B. Limitation. The credit allowed under subsection A with respect to all qualified alternative fuel vehicle refueling property placed in service by the taxpayer during the taxable year at a location shall not exceed 1. $30,000 in the case of a property of a character subject to an allowance for depreciation, and 2. $1,000 in any other case. C. Qualified alternative fuel vehicle refueling property. For purposes of this section, the term qualified alternative fuel vehicle refueling property has the same meaning as the term qualified clean fuel refueling property would have under section 179A. If 1. Paragraph 1 of section 179AD did not apply to property installed on property which was used in the principal residence within the meaning of section 121 of the taxpayer, and 2. Only the following were treated as clean burning fuels for purposes of section 179AD. A. Any fuel at least 85% of the volume which consists of one or more of the following: ethanol, natural gas, compressed natural gas, liquefied natural gas, liquefied petroleum gas, or hydrogen. B. Any mixture. 1. Which consists of 2 or more of the following: biodiesel as defined in section 40AD1, diesel fuel as defined in section 4083A3, or kerosene, and 2. At least 20% of the volume of which consists of biodiesel as so defined, determined without regard to any kerosene in such mixture. C. Electricity. D. Application with other credits. 1. Business credit treated as part of general business credit. So much of the credit which would be allowed under subsection A for any taxable year determined without regard to this subsection that is attributable to property of a character subject to an allowance for depreciation shall be treated as a credit listed in section 38B for such taxable year and not allowed under subsection A. We're on page 346 right now, and soon we'll be on 347. 2. Personal credit. The credit allowed under subsection A after the application of paragraph 1 for any taxable year shall not exceed the excess, if any, of A. The regular tax liability as defined in section 26B reduced by the sum of the credits allowable under subpart A and section 27 over B, the tentative minimum tax for the next taxable year. E. Special rules. For purposes of this section, 1. Basis reduction. The basis of any property shall be reduced by the portion of the cost of such property taken into account under subsection A. 2. Property used by tax-exempt entity. In the case of any qualified alternative fuel vehicle refueling property, the use of which is described in paragraph 3 or 4 of section 50B, which is not subject to a lease, the person who sold such property to the person or entity using such property shall be treated as a taxpayer that placed such property in service, but only if such person clearly discloses to such person or entity in a document the amount of any credit allowable under subsection A with respect to such property determined without regard to subsection D. For purposes of subsection D, property to which this paragraph applies shall be treated as of a character subject to an allowance for depreciation. 3. Property used outside the United States not qualified. No credit shall be allowable under subsection A with respect to any property referred to in section 50B1 or with respect to the portion of the cost of any property taken into account under section 179. 4. Election not to take credit. No credit shall be allowed under subsection A for any property if the taxpayer elects to have this section applied to such if the taxpayer elects not to have this section applied to such property. I don't want you to not get the right information. 5. Recapture rules.
Rules similar to the rules of Section 179A(e)(4) shall apply. 6. Special rule for property placed in service during 2009 and 2010. In the case of property placed in service in taxable years beginning after December the 31st, 2008 and before January 1st, 2011, A. In the case of any such property which does not relate to hydrogen, 1. Subsection A shall be applied by substituting 50% for 30%. 2. Subsection B1 shall be applied by substituting $50,000 for $30,000. And 3. Subsection B2 shall be applied by substituting $2,000 for $1,000. And B. In the case of any such property which relates to hydrogen, subsection B1 shall be applied by substituting $200,000, $30,000. And then the statutes. And we're to section 30D. New qualified plug-in electric drive motor vehicles. Your Prius. A. Allowance of credit. There shall be allowed as a credit against the tax imposed by this chapter for the taxable year an amount equal to the sum of the credit amounts determined under subsection B with respect to each new qualified plug-in electric drive motor vehicle placed in service by the taxpayer during the taxable year. B. Per vehicle dollar limitation. In general, the amount determined under this subsection with respect to any new qualified plug-in electric drive motor vehicle is the sum of the amounts determined under paragraphs 2 and 3 with respect to such vehicle. 2. Base amount. The amount determined under this paragraph is $2,500. 3. Battery capacity. In the case of a vehicle which draws propulsion energy from a battery with not less than 5 kilowatt hours of capacity, the amount determined under this paragraph is $417 plus $417 for each kilowatt hour of capacity in excess of 5 kilowatt hours. The amount determined under this paragraph shall not exceed $5,000. C. Application with other credits. 1. Business credit treated as a part of general business credit. So much of the credit which would be allowed under subsection A for any taxable year determined without regard to this subsection that is attributable property to a character subject to an allowance for depreciation shall be treated as a credit listed in section 38B for such taxable year and not allowed under subsection A. 2. Personal credit. A. In general, for purposes of this title, the credit allowed under subsection A for any taxable year determined after application of paragraph 1 shall be treated as a credit allowable under subpart A for such taxable year. B. Limitation based on amount of tax. In the case of a taxable year to which section 26A2 does not apply, the credit allowed under subsection A for any taxable year determined after application of paragraph 1 shall not exceed the excess of 1. The sum of a regular tax liability as defined in section 26B plus the tax imposed by section 55 over 2, the sum of the credits allowable under subpart A other than this section and section 25D and section 27 for the taxable year. D. New qualified plug-in electric drive motor vehicle. For purposes of this section, in general, the term new qualified plug-in electric drive motor vehicle means a motor vehicle, A, the original use of which commences with the taxpayer, B, which is acquired for the use or lease by the taxpayer and not for resale, C, which is made by the manufacturer, D, which is treated as a motor vehicle for purposes of Title II of the Clean Air Act, E, which has a gross vehicle weight rating of less than 1,400 pounds, and F, which is propelled to a significant extent by an electric motor which draws electricity from a battery which 1. Has a capacity of not less than 4 kilowatt hours, and 2. Is capable of being recharged from an external source of electricity. 2. Motor vehicle. The term motor vehicle means any vehicle which is manufactured primarily for use on public streets, roads, and highways, not including a vehicle operated exclusively on rails or a rail, and which has at least 4 wheels. 3. Manufacturer. The term manufacturer has the meaning given such term in regulations prescribed by the Administration of Environmental Protection Agency for purposes of the administration of Title II of the Clean Air Act, which is 42 U.S.C. 7521 in sequence. 4. Battery capacity. The term capacity means, with respect to any battery, the quantity of electricity which the battery is capable of storing expressed in kilowatt hours as measured from a 100% state of charge to a 0% state of charge. E. Limitation on number of new qualified plug-in electric drive motor vehicles eligible for credit. In general, in the case of a new qualified plug-in electric drive motor vehicle sold during the phase-out period, only the applicable percentage of the credit otherwise allowable under subsection A shall be allowed. Phase-out period. For purposes of this subsection, the phase-out period is the period beginning with the second calendar quarter following the calendar quarter, which includes the drive motor vehicles manufactured and the manufacturer of the vehicle referred to in paragraph 1, sold for use in the United States after December 31st, 2009, is at least 200,000, excuse me. 3. Applicable percentage. For purposes of paragraph 1, the applicable percentage is A. 50% for the first 2 calendar quarters of the phase-out period. B. 25% for the 3rd and 4th calendar quarters of the phase-out period. And C. 0% for each calendar quarter thereafter. 4. Control groups. Right? Rules similar to the rules of section 30B F4 shall apply for purposes of this subsection. F. Special rules. 1. Basis reduction. For purposes of this subtitle, the basis of any property for which a credit is allowable under subsection A shall be reduced by the amount of such credit so allowed. 2. No double benefit. None. Ever. Forever. The amount of any deduction or other credit allowable under this chapter for a new qualified plug-in electric drive motor vehicle shall be reduced by the amount of credit allowed under subsection A for such vehicle. 3. Property used by tax-exempt entity. In the case of a vehicle, the use of which is described in paragraph 3 or 4 of section 50B, and which is not subject to a lease, the person who sold such vehicle to the person or entity using such vehicle shall be treated as a taxpayer that placed such vehicle in service, but only if such person clearly discloses to such person or entity in a document the amount of any credit allowable under subsection A with respect to such vehicle determined without regard to subsection C. 4. Property used outside the United States not qualified. No credit shall be allowable under subsection A with respect to any property referred to in section 50B1. Recapture. The Secretary shall, by regulations, provide for recapturing the benefit of any credit allowable under subsection with respect to any property which ceases to be property eligible for such credit. 6. Election to not take credit. No credit shall be allowed under subsection A for any vehicle if the taxpayer elects to not have this section applied to such vehicle. Interaction with air quality and motor vehicle safety standards. A motor vehicle shall not be considered eligible for a credit under this section unless such vehicle is in compliance with A. Applicable provisions of the Clean Air Act for the applicable make and model year of the vehicle, or applicable air quality provisions of state law in the case of a state which has adopted such provision under a waiver under section 209B of the Clean Air Act. And B, the motor vehicle safety provisions of sections 30101 through 30169 of Title 49 United States Code. I appreciate you guys taking time to learn so much. This is going to benefit you in the long run. And I hate to take credit for all of it, but I mean, hey, you know. So on to section 31. tax withheld on wages. A. Wage withholding for income tax purposes. 1. In general, the amount withheld as taxed under Chapter 24 shall be allowed to the recipient of the income as a credit against the tax imposed by this subtitle. 2. Year of credit. The amount so withheld during any calendar year shall be allowed as a credit for the taxable year beginning in such calendar year. If more than one taxable year begins in a calendar year, such amount shall be allowed as a credit for the last taxable year so beginning. Credit for special funds of Social Security tax. 1. In general, the Secretary may prescribe regulations providing for crediting against the tax imposed by this subtitle of the amount determined by the taxpayer or the Secretary to be allowable under Section 6413C as a special refund of tax imposed on wages. The amount allowed as a credit under such regulation shall, for purposes of this subtitle, be considered an amount withheld at source as tax under Section 3402. 2. Year of credit. Any amount to which paragraph 1 applies shall be allowed as a credit for the taxable year beginning in the calendar year during which the wages were received. If more than one taxable year begins in the calendar year, such amount shall be allowed as a credit for the last taxable year so beginning. C. Special rule for backup withholding. Any credit allowed by subsection A for any amount withheld under Section 3406 shall be allowed for the taxable year of the recipient of the income in which the income is received. More statutes. Income taxes. Joint returns. In the case of a joint return filed by an eligible individual and such individual's spouse, the phase-out amount determined under subparagraph A shall be increased by 1, $1,000 in the case of taxable years beginning in 2002, 2003, and 2004. 2, $2,000 in the case of taxable years beginning in 2005, 2006, and 2007. And 3, $3,000 in the case of taxable years beginning after 2007. 3. Special rules for 2009, 2010, which is the bonus round. In the case of any taxable year beginning in 2009 or 2010, the bonus round. A. Increased credit percentage for 3 or more qualifying children. In the case of a taxpayer with 3 or more qualifying children, the credit percentage is 45%. Bonus. B. Reduction of marriage penalty. There's a marriage penalty. Yeah. 1. In general, the dollar amount in effect under paragraph 2B shall be $5,000. 2. Inflation adjustment. In the case of any taxable year beginning in 2010, the $5,000 amount in clause 1 shall be increased by an amount equal to 1. Such dollar amount multiplied by 2. The cost of living adjustment determined under Section 1F3 for the calendar year in which the taxable year begins, determined by substituting calendar year 2008 for calendar year 1992 in subparagraph B thereof. 3. Rounding. Subparagraph A of subsection J2 shall apply after taking into account any increase under clause 2. Definitions and special rules. For purposes
How
of this,
many pages are we at now?
we're at 365.
You seem to be really enjoying those special rules. How are those?
Well, the special rules are great. They're very dangerous. They're enigmatic. We've managed. When I got to the special rules, everyone back there went home. Everyone in the building, they left because they knew that this was the meat of the topic.
Right.
And I want you to know that this is the meat of the topic. It's the meat.
All right, so we got to pay extra attention to the special rules.
I'd pay close attention to this one. I'd tell a friend. I'd lie to them and tell them it's something else because they need to know this.
In fact, the viewer should probably rewind and make sure that they watch the special rules 2 or 3 times, right?
Absolutely.
Right.
You can't be too safe. I would suggest knowing as much of this as possible. And
we're going to go over all this stuff because we've got a couple more to go through.
Right.
But let's just focus on this right now. Don't worry about that.
A couple hundred.
Yeah,
more
not
to
so
go
much
through.
over here. Just focus on right here. Not so much there, just here.
Right. Take it one at a time.
One at a time.
Until we get through 70,000.
We're going to do it.
Okay.
We're going to do it.
So we're at what, page 366 now?
Yeah, we are. We're at 366 now. We just finished 365. So we've essentially covered one page for every day of the year.
Right. And so we are a 0.5% of the way there.
Right. We haven't even really scraped the surface. We're just warming up.
Right. So dig in, get some popcorn.
Yeah.
Get your notebook. Get ready to take some more notes on.
Give up on
those special rules.
Give up on everything you've been doing. This is what you're going to be doing until we get this done. It's not that much.
Right. Not too bad.
Isn't Ford great? Just great. A. In general, the term eligible individual means 1. Any individual who has a qualifying child for the taxable year, or 2. Any other individual who does not have a qualifying child for the taxable year if 1. Such individual's principal place of abode is in the United States for more than 1/2 of such taxable year. 2. Such individual, or if the individual is married, either the individual or the individual spouse has attained age 25 but not attained age 65 before the close of the taxable year. And 3. Such individual is not a dependent for whom a deduction is allowable under Section 151 to another taxpayer for any taxable year beginning in the same calendar year as such taxable year. For purposes of the preceding sentence, marital status shall be determined under Section 7703. B. Qualifying child ineligible. If an individual is the qualifying child of a taxpayer for any taxable year of such taxpayer beginning the calendar year, such individual shall not be treated as an eligible individual for any taxable year of such individual beginning in such calendar year. Such. C. Exception for individual claiming benefits under Section 911. The term eligible individual does not include any individual who claims the benefits of Section 911 relating to citizens or residents living abroad for the taxable year. D. Limitation on eligibility of non-resident aliens. The term eligible individual shall not include any individual who is a non-resident alien individual for any portion of the taxable year unless such individual is treated for such taxable year as a resident of the United States for purposes of this chapter by reason of an election under subsection G or H of Section 6013. E. Identification number requirement. No credit shall be allowed under this section to an eligible individual who does not include on the return of the taxable year. 1. Such individual taxpayer's identification number, and 2. If the individual is married within the meaning of Section 7703, the taxpayer identification number of such individual's spouse. F. Individuals who do not include their TIN, etc. of any qualifying child. No credit shall be allowed under this section to any eligible individual who has one or more qualifying children if no qualifying child of such individual is taken into account under subsection B by reason of paragraph 3D. Come on, guys, you know this. 2. Earned income. A. The term earned income means 1. Wages, salaries, tips, and other employee compensation, but only if such amounts are includable in gross income for the taxable year, plus 2. The amount of a taxpayer's net earnings from self-employment to the taxable year within the meaning of Section 1402A, but such net earnings shall be determined with regard to the deduction allowed to the taxpayer by Section 164F. For the purpose of subparagraph A, 1. The earned income of an individual shall be computed without regard to any community property laws. 2. No account received as a pension or annuity shall be taken into account. 3. No amount to which Section 87A applies relating to income of non-resident alien individuals not connected with the United States business shall be taken into account. 4. No amount received for services provided by an individual while the individual is an inmate at a penal institution can be taken into account. And 5. No amount described in subparagraph A received for service performed in work activities as defined in paragraph 4 or 7 of section 407D of the Social Security Act, to which the taxpayer is assigned under any state program under Part A of Title IV of such act shall be taken into account, but only to the extent such amount is subsidized under such state program. And 6. A taxpayer may elect to treat amounts excluded from gross income by reason of section 112 as earned income. Qualifying child. A. In general, the term qualifying child means a qualifying child of the taxpayer as defined in section 152C, determined without regard to paragraph 1D thereof, section 152E. B. Married individual. The term qualifying child does not include an individual who is married as of the close of the taxpayer's taxable year, unless the taxpayer is entitled to a deduction under section 151 for such taxable year with respect to such individual, or would be so entitled but for section 152E. C. Place of abode. For purposes subparagraph A and requirements of section 152C1B shall be met only if the principal place of abode is in the United States. D. Identification requirements. 1. In general, a qualifying child should not be taken into account under subsection B unless the taxpayer includes the name, age, and TIN of the qualifying child on the return of tax for the taxable year. Other methods. The Secretary may prescribe other methods for providing the information described in Clause I. Treatment of military personnel stationed outside the United States. For purposes of paragraphs 1A to 1 and 3C, the principal place of abode of a member of the armed forces of the United States shall be treated as in the United States during any period during which such member is stationed outside of the U.S. while serving on extended active duty with the armed forces of the United States. For purposes of the preceding sentence, the term extended active duty means any period of active duty pursuant to a call or order, or to such duty for a period in excess of 90 days or for an indefinite period. Married individuals. In the case of an individual who is married within the meaning of section 7703, this section shall apply only if a joint return is filed for the taxable year under section 6013. E. Taxable year must be full taxable year. Except in the case of a taxable year closed by reason of the death of the taxpayer, no credit shall be allowable under its section in the case of a taxable year covering a period of less than 12 months. F. Amount of credit to be determined under tables. In general, the amount of credit allowed by the section shall be determined under tables prescribed by the Secretary. Requirements for tables. Tables prescribed under paragraph 1 shall reflect the provisions of subsections A, and B shall have income brackets of not greater than $50 each. For earned income between 0 and the amount of earned income at which the credit is phased out under subsection B, and B for adjusted gross income between the dollar amount at which the phase out begins under subsection B and the amount of adjusted gross income at which the credit is phased out under subsection B. G has been repealed. H has been repealed. I is a denial of credit for individuals having excessive investment income. In general, no credit shall be allowed under subsection A for a taxable year if the aggregate amount of disqualified income of the taxpayer for the taxable year exceeds $2,200. Disqualified income. For purposes of paragraph 1, the term disqualified income means interest or dividends to the extent includable in gross income for the taxable year, interest received or accrued during the taxable year which is exempt from tax imposed by this chapter. C. The excess, if any, of 1. Gross income from rents or royalties not derived in the ordinary course of a trade or business over 2. The sum of 1. The deductions other than interest which are clearly and directly allocable to other gross income, plus interest deductions properly allocable to such gross income. D. The capital gain net income as defined in section 1222
of the taxpayer for such taxable year, and E, the excess, if any, of 1. Aggregate income from all passive activities for the taxable year determined without regard to any amount included in earned income under subsection C2 or described in the preceding subparagraph over 2. The aggregate losses from all passive activities for the taxable year as so determined. For purposes of subparagraph E, the term passive activity has the meaning given such term by section 469. Statutes. '83 amendments. Subsect C2A2. Section 124C4B added, but such net earnings shall be determined with regard to the deduction allowed to the taxpayer by Section 164F. 1981 amendments. Subsection C1C 9734 struck out reference to Section 913 in the subpar C, catch line substituted relating to citizens or residents of the United States living abroad for relating to income earned by individuals in certain camps outside the United States. In CL 1 stuck out CL2, which made reference to Section 913 and redesignated former CL3 as 2. 1980 amendments. Subsect C1C, published 96-222. Section 101A1. In subpar, catch line substituted who claims benefit of Section 911, 913, or 931 for entitled to exclude income under Section 911, and in text substituted claims to the benefits of for is entitled to exclude any amounts from gross income under, and added reference to Section 913 relating to deduction for certain expenses of living abroad. 1978 amendments. Subsect, published 95-600. Section 104A, substituted subtitle for chapter, and 5,000 for 4,000. Subsect B, published 95-600, Section 104B, substituted provision limiting the allowable credit to an amount not to exceed, able credit to be an amount not to exceed the excess of $500 over 12.5% or so of the adjusted gross income for much of the taxable year, and the provision limiting the allowable credit to an amount reduced by 10% of so much of the adjusted gross income for taxable year as exceeds $4,000. Subsect C1, published 95-600, Section 104E, substituted in definition of eligible individual, one who is married and is entitled to a deduction under Section 151 for a child, provided the child has the same principal abode and as the individual and the and the abode is in the United States, is a surviving spouse or is a head of a household, provided the household is in the United States, for one who maintains a household in the United States which is in the principal abode of that individual, and the child of that individual who meets the requirements of Section 151 E1B, or a child of that individual who is disabled within the meaning of Section 72 M7, and whom the individual is entitled to claim a deduction under Section 151. Subsect C1C, published 95-615, substituted relating to income earned by employees in certain camps. 4. Relating to earned income from sources without the United States. Subsection C2B, published 95/600. Section 104D, redesign former CLs 2 to 4 as CLs 1 to 3 respectively. Former CL 1, which provided that amounts be taken into account only if includable in the gross income of the taxpayer for the taxable year, was struck out. Subsect F, published 95/600, section 104C, added subsect F. Subsection H, added subsection H. 1976 amendments. Subsection A, substituted is allowed for shall be allowed.
Yep.
Yes, we are. We've read through, what are we at?
We're at page 382.
What are you doing?
Reading the tax code.
Fascinating?
Absolutely.
Are you absorbing it?
Into our very souls.
Smart man. Are you writing notes or a highlighter? Or?
They've got it all written down.
We're broadcasting. Watching on the Where Those Cards, the website.
Yeah.
Wow, senator.
It really is what I'm here for. I apologize, friends.
Well, we're highlighting the absurdity of
Amendments, subsection A, section 401C1B, substituted is allowed for shall be allowed, and eliminated provisions relating to the application of the 6-month rule. Subsection B, 94-455, section 401C1B, eliminated provisions related to the application of the 6-month rule. Subsection C1A, 94-455, section 401C2, among other changes, substituted section 44AF1 for section 214B3, and if such child meets the requirements of section 151E1B, for with respect to whom he is entitled to claim a deduction under section 151E1B, and added reference to a child of that individual who is disabled within the meaning of section 72M7, and with respect to whom that individual is entitled to claim a deduction under section 151. 1975 amendments. Subsect 94-164 designated existing provisions as Part 1, and added Part 2, subsection B, 194 through 164, designating existing provisions as Part 1, and added Part 2. That's awesome. Effective and applicability provisions. 2010 Acts. 111-226, Title 2, Section 219C, August the 10th, 2010. 124, Stat 2403, provided that the repeals and amendments made by this section, amending this section, and 26 USCA Section 6012, 6051, and 6302, and repealing 26 USCA Section 3507 shall apply to taxable years beginning after December 31st, 2010. 2009 Acts. 111-5, February 17th, 2009, 123 Statute 312 provided that, quote, the amendments made by this section enacting subsection B3 of this section shall apply to taxable years beginning after December the 31st, 2008. That's good news. 2008 Acts. Amendments by 110-246, except as otherwise provided, shall take effect on the earlier of June 18th, 2008 or May 22nd, 2008. C 110-246. Section 4B. Set out in a repeal of duplicative enactment note under 7 USCA section 8701. Amendment to the Title IV of Publication 110-246, except as otherwise provided, take effect on October the 1st, 2008. C 110-246, section 4407, set out as a note under T2 USCA's section 1161. 110-245, Title I, Section 102D, June 17th, 2008. 122, Statute 1625, provided that the amendments made by this section, amending this section, and 26 USCA, Section 6428E4, shall apply to taxable years ending after December 31st, 2007. 2006 Acts 109-432, Division A, Title I, Section 106B, December 20th, 2006, 120 stat, made this section, amending this section by made this section, amending this section, shall apply to taxable years beginning after December the 31st, 2006. 2005 Acts 109-135, Title III, Section 302B, December 21st, 2005. 119, Stat 2608, provided that the amendment made by subsection A, amending this section, shall apply to taxable years beginning after December the 31st, 2005. 2004 Acts 108-311, Title I, Section 104C2, October the 4th, 2004. 118 Statute 1169, provided that the amendments made by subsection B, amending subsection C2B4 to 5 of this section, shall apply to taxable years ending after the date of enactment of this Act, October 4th, 2004. Amendments made by 108-311, Title II, amending subsection C1C to apply to taxable years beginning after the December 31st, 2004. C 108-311, Section 208, set out as a note under 26 USCA Section 2. 2002 Acts 107-147, Title IV, Section 416A2, March 9th, 2002, 116, Statute 55, provided that the amendment made by this subsection amending this section shall take effect as if included in Section 474 of the Tax Reform Act of 1984. Refer to 98-369, Division A, July 18th, 1984, 98 Statute 830. 2010 Acts, amendment by 107-16, Title II, Section 201C3, applicable to taxable years beginning after December 31st, 2000. C 106-16, Title II, Section 201E1, set out as a note number under 26 USCA Section 24. See also sunset provisions set out under this section. 107-16, Title III, Section 303.1. June 7th, 2001, 115, Statute 57, provided that 1. In general, except as provided in paragraph 2, the amendments made by this section, amending this section, and Section 6213 of this title, shall apply to taxable years beginning after December 31st, 2001. 2. Subsection G. The amendment amending Section 6213 of this title made a subsection by amending Section 6213, which takes effect on January 1st, 2004. See also sunset provisions note set out under this section. 1999 Acts 106-170, Title IV, Section 412B, December 17th, 1999. 113 Stat 1917 provided that the amendments made by this section amending this section shall apply to taxable years beginning after December 31st, 1999. 1998 Acts. Section 6021C of 105-206 provided that 1. Eligible individuals, the amendment made by subsection A, section 6021A of 105-206, which amended subsection C1F to this section, shall take effect as if needed in the amendments made by section 451 of the Personal Responsibility and Work Opportunity Reconciliation Act of 1996. Section 451 of 104-193, Title 4, August 6, 1996. 110, Statute 2276, which amended this section and section of 6213 of this title and enacted provisions set out as a note under this section. 2. Qualifying children. The amendments made by subsection B, section 6021B of Public L 105-206, which amended this section, shall take effect as if included in the amendments made by succession 11111 of Revenue Reconciliation Act of 1990, section 11111 of Title 11 of 101-508, November 5th, 1990, 104 Statute 1388, which amended this section, and sections 162, 213, 3507 of this title and enacted provisions set out as a note under this section. Amendments by Title 5, Section 6001 and to 6024 of 105-206, except as otherwise provided in such title, shall take effect as if included in the Taxpayer Relief Act of 1997. 105-34, August 5th, 1997, Statute 788, to which they relate, see Section 6024 of 105-206, set out as a note under Section 1 of this title. 1997 Acts. Amendment by Section 101B of 105-34 applicable to taxable years beginning after December 31st, 1997. See Section 101E of 105-34 set out as a note under Section 24 of this title. Amendment by Section 312D2 set out first by 105-34 applicable sales and exchanges after May 6, 1997.
Probably not the most,
with special rules for sales on or before August 5th, 1997, and certain sales within 2 years of August 5th, 1997, and exception relating to binding contracts, see Section 312D, set out second, of 105-34, as amended by 105-206, Title 6, Section 6005E3, July 22nd, 1998, 112, Statute 806, set out as a note under Section 121 of this title. Section 1085E of 105-34 provided, 1. The amendments made by subsection A amending this section and Section 6213 and 6695 of this title shall apply to taxable years beginning after December 31st, 1996. The amendments made by subsections B, C, and D amending this section shall apply to taxable years beginning after December 31st, 1997. 1996 at Section 451D of 104-193 provided that the amendments made by this section, amending this section, and Section 6213 of this title shall apply with respect to the returns, the due date for which, without regard to extension, is more than 30 days after the date of enactment of this Act, August the 22nd, 1996. Section 909C
of 104-193 provided that 1. In general, except as provided in paragraph 2, the amendments made by this section amending this section shall apply to taxable years beginning after December 31st, 1995. 2. Advance payment individuals. In the case of any individual who on or before June 26, 1996 has in effect an earned income eligibility certificate for the individual's taxable year beginning in 1996, the amendments made by this section amending this section shall apply to taxable years beginning after December 31st, 1996. Section 910C of 104-193 provided that 1. In general, except as provided in paragraph 2, the amendments made by this section amending this section shall apply to taxable years beginning after December the 31st, 1995. 2. Advance payment individuals. In the case of an individual who on or before June 26, 1996 has in effect an earned income eligibility certificate for the individual's taxable year beginning in 1996, the amendments made by this section amending this section shall apply to taxable years beginning after December 31st, 1996. 1995 Acts. Section 4B of 104-7 provided that the amendments made by this section amending this section shall apply to taxable years beginning after December 31st, 1995. 1994 Acts. Section 72D1 of 104-7 provided that amendments made by this section amending this section shall apply to taxable years beginning after December 31st, 1995. 1994 Acts. Section 721D1 of 103-465 provided that the amendment made by subsection amending this section shall apply to taxable years beginning after December 31st, 1994. Section 722B of Sorry. 722B of 103-465 provided that the amendment made by subsection A amending this section shall apply to taxable years beginning after December 31st, 1994. You guys getting all this? It's big news. Section 723B 103-465 provided that the amendment made by subsection A amending this section shall apply to taxable years beginning after December 31st, 1993. Section 742C of 103-465 provided that 1. In general, except as provided in paragraph 2, the amendments made by this section amending this section and section 6109 of this title shall apply to returns for taxable years beginning after December 31st, 1994. 2. Exception. The amendments made by this section shall not apply to A. Returns for taxable years beginning in 1995 with respect to individuals who were born after October 31st, 1995, and returns for taxable years beginning in 1996 with respect to individuals who were born after November 30th, 1996. 1993 Acts. Section 1313E 103-66 provided that the amendments made by this section amending this section in sections 162, 213, and 3507 of this title shall apply to taxable years beginning after December 31st, 1993. 1990 Acts. Amendment by Section 11101D1B of 101-508 applicable to taxable years beginning after December 31st, 1990. See Section 11101E of 101-508 set out as a note under Section 1 of this title. Section 11111F
of 101-508 provided that the amendments made by this section, amending the section 32 and sections 162, 213, and 3507 of this title, shall apply to taxable years beginning after December 31st, 1990. 1988 Acts. Amendment made by 100-647 effective as if included in the provisions of 99-514 to which such amendment relates, except that no addition to tax shall be made under section 6654 or 6655 of this title for any period before April 16, 1989, March 16, 1989 in the case of a taxpayer subject to section 6655 of this title, with respect to any underpayment to the extent such underpayment was created or increased by any provision of titles 1 or 2, 100-647, see section 1019 of 100-647 set out as a note under section 1 of this title. 1986 Acts. Amendment by sections 104 and 111 of 99-514 applicable to tax years beginning after December 31st, 1986. See section 151A of 99-514 set out as a note under section 1 of this title. Amendment by section 1272 of 99-514 to apply to taxable years beginning after December 31st, 1986 with certain exceptions and qualifications. See section 1277 of 99-514 set out as a note under section 931 of this title. Amendment by section 1301 of 99-514 applicable to bonds issued after August 15, 1986, except as otherwise provided. See sections 1311 to 1318 of 99-514 set out as a note under section 141 of this title. Now that's smooth. 1984 Acts. Amendment by the section 423C3 of 98-369 applicable to taxable years beginning after December 31st, 1984. See section 423D of 98-369 set out as a note under section 2 of this title. Section 1042E of 98-369 provided that the amendments made by this section amending this section and section 3507 of this title shall apply to taxable years beginning after December 31st, 1984. 1983 Acts. Amendment by 98-21 applicable to taxable years beginning after December 31st, 1989. See section 124D2 of 98-21 set out as a note under section 1401 of this title. 1981 Acts. Amendment by 97-34 applicable with respect to taxable years beginning after December 31st, 1981. See section 115 of 97-34 set out as a note under section 911 of this title. 1980 Acts. Section 101B1A of 96-222 provided that the amendment made by subsection A1 amending this section shall apply to taxable years beginning after December 31st, 1977. Section 201 96-222
It's gone up and down.
provided that
I took
except as otherwise provided in Title I, any amendment made by Title I shall take effect as if it had been included in the provision of the Revenue Act of 1978. See tables for classification as to which amendment relates.
His bags bags of tissues. Milwaukee Beer Factory.
1978 acts. Section 104F 95-600 provided that the amendments made by this section amending this section shall apply to taxable years beginning after December 31st, 1978. Section 105G1 95-600 provided that the amendments made by subsections A and D amending this section and section 6012 of this title shall apply to taxable years beginning after December 31st, 1978. Section 105G3 of 95-600 provided that subsection F amending a provision set out as a note under this section shall take effect on the date of enactment of this act, November 6, 1978. 1976 acts. Section 401E 94-455 as amended, 95-30, Title I, Section 103C, May 23, 1977, 91, Statute 139 of 95-600, Title I, Section 103B, November 6, 1978, 92, Statute 2771, provided that amendments made by subsection A, amending sections 43, now 32, and 1696B of this title shall apply to taxable years ending in December 31st, 1975, and shall cease to apply to taxable years ending in December 31st, 1978. The amendments made by subsection C amending this section shall apply to taxable years ending after December 31st, 1975. The amendments made by subsection amending sections 141 and 6012 shall apply to taxable years ending after December 31st, 1975. The amendments made by subsection D shall apply to wages paid after September 14th, 1976. Let's see where we are. Only a little bit more. 1975 acts. Section 2G 94-164 as amended from 95-455, Title 4, Section 402B, October the 4th, 1976. 90. Statute 1558 provided that amendments made by this section amending sections 43, now 32, 141, 3402, 6012, and this title and provisions set out as notes under sections 42 and 43, now 32 of this title, other than by subsection D, enacting provisions set out as a note under this section, apply to taxable years ending after December the 31st, 1975, before January 1st, 1978. Subsection D applies to taxable years ending after December 31st, 1975. Repeals. (110-234) repealed effective May 22nd, 2008. See repeal of duplicative enactment by 110-246, Section 4A, set out in a note under 7 USCA, Section 8701. Report. Preliminary report. Not later than July the 30th, 2004, the Commissioner of the Internal Revenue Service shall submit to Congress a preliminary report on the study conducted under subsection A of this note. 2. Final report. Not later than June 30th, 2005. The Commissioner of the Internal Revenue Service shall submit to Congress a final report detailing the findings of the study conducted under subsection A of this note. Program to increase public awareness. Taxpayer awareness program respecting credit for department care, earned income credit, and child health insurance. See Section 1114 of 101-508, Title 11, November 5th, 1990, 104, Statute 1388-414. Set it out as a note under Section 21 of this title. Employee notification of refund eligibility. Section 111E 99-514 provided that the Secretary of the Treasury is directed to require
Under regulations, employers to notify any employee who had not had any tax withheld from wages other than an employee whose wages are exempt from withholding pursuant to Section 3402N of the Internal Revenue Section Code of 1986, that such employee may be eligible for a refund because of the Earned Income Credit. Disregard of refund for determination of eligibility for federal benefits or assistance. Section 2D of 94-164 as amended, 94-455, Title 4, Section 402A, October the 4th, 1976, 90, Statute 1558, 95-600, Title 1, Section 105F, November 6, 1978, 92, Statute 2776, 99-514, Section 2, October the 22nd, 1986. 100, Statute 2095 provided that any refund of federal income taxes made to any individual by reason of Section 43, now 32 of the Internal Revenue Code of 1986, formerly IRC 1954, relating to earned income credit and any payment made by an employer under Section 3507 of such code relating to advance payment of earned income credit shall not be taken into account in any year before 1980 as income or receipts for purposes of determining the eligibility for the month in which such refund is made for any month thereafter for such individual or any other individual for benefits or assistance, or the amount or extent of benefits or assistance under any federal program or under any state or local program financed in whole or in part with federal funds, but only if such individual or the family unit of which he is a member is recipient of benefits or assistance under a program for the month before the month in which such refund is made. And then there are statutes. We're at page 388. It's 8 o'clock and it's dark. It's getting dark to read. Ask them if they'd like to read more. Are they done? Are they done?
Do you want to switch?
Yeah, you guys. Are you guys done?
Stand by, everyone. They plan to continue momentarily. They're just figuring out their game plan. They're drawing straws. They're considering dealing with it with a duel by firearm to decide who is forced to read the rest of the tax code.
The therapist just left.
So, no, in all seriousness, they've got to figure out the plan. Things are getting dark, but this is not over. They are continuing to read the tax code outside the IRS, even though everybody has left at the IRS itself.
It's just about everybody's left the city.
Now, next we're going to chain ourselves to the planters. Fast.
We'll file a First Amendment suit. All right, we are entering the final rounds of the tax code. Final waters. I wish I could say final pages of the book. just refer to it as the book.
The book.
It's been an experience. All right.
The good book.
So now, don't tarnish the good book's name by attaching this to
We
it.
need to make the tax code great again.
Okay. So section 26, or Title 26, Section 32. Notes of decisions. Generally, though given effect through income tax laws, earned income credit is in substance an item of social welfare legislation intended to provide low-income families with the very means at which to live. In re. Searles, D.C., Con, 1978, 445 F, Supplemental 749, Internal Revenue 3532. 2. Purpose. Earned income credit was enacted to reduce the disincentive to work caused by the imposition of Social Security taxes on earned income, to stimulate the economy by funneling funds to persons likely to spend the money immediately, and to provide relief for low-income families hurt by rising food and energy prices. Sorensen, v. Secretary of Treasury of the United States, U.S., Washington, 1986, 106, S. Court, 1600, 475, U.S., 851, 89 L. Ed. 2D, 855, Internal Revenue 3532. The Earned Income Credit was designed to provide relief to low-income families who pay little or no income tax, and was intended to provide an incentive for low-income people to work rather than to receive federal assistance. Fun fact, the Earned Income Tax Credit is the legislative implementation of the negative income tax, an idea first introduced by economist Milton Friedman. Earned Income Credit is designed to benefit only working low-income taxpayers with dependent children. In re. Searles, D.C., Connecticut, 1978, 445 F, Supplemental 749, Internal Revenue 3532. 3. Retroactive effect. Retroactive application of amendment to statute governing Earned Income Tax Credit, EITC, to taxable year which was 1 year before amendment was reasonable, and comported with due process, since time period was within precedential limits, and lent support to constitutionality of retroactive amendment. Sutherland v. CIR, U.S. Tax Court, 2001, WL 46996, unreported. Constitutional Law, Key 4149, Internal Revenue 3521. 4. Due process. Retroactive amendment to Earned Income Tax Credit, EITC, permitting only person and family unit with highest modified AGI, adjusted gross income, to take EITC, did not violate due process, since it served primarily as a clarification to existing law, as opposed to a change of existing law, and thus amendment was a curative measure that did not impose new tax liabilities or alter substantive rights of taxpayers. Congressional purpose was rationally related to legitimate government purpose of ensuring that only the most needy individuals received EITC. Sutherland v. CIR, U.S. Tax Court 2001, WL 46996, unreported. Constitutional Law 4149, Internal Revenue 3521. 5. Persons entitled to credit. Taxpayer was not entitled to earn income credit for her minor granddaughter with respect to second of 2 years at issue. Taxpayer failed to establish that granddaughter was her qualifying child. And taxpayer also failed to establish that she and granddaughter had same principal place of abode for more than one half of first year at issue. Horsley v. CIR, U.S. Tax Court 2009, WL 513417, unreported, Internal Revenue 3532. And now, in honor of our communications director, I shall continue to read in a British accent. Taxpayer failed to show her entitlement to head of household status or to dependency exemption deductions and earned income tax credits she claimed on her returns. Taxpayer admitted that she received support from father of children she claimed on her returns whenever it was needed. She failed to establish by introduction of credible evidence that any children she claimed on her returns with respect to dependency exemption deductions and earned income credits were her children, and that children she claimed resided with her during years in issue and she failed to establish amount of support she contributed for such children, total costs of maintaining household, and part of such costs contributed by her for years in issue. Smith v. CIR, U.S. Tax Court, 2008, WL 4500300, unreported, Internal Revenue 3297, Internal Revenue 3532, Internal Revenue 3549. Tax. Absolutely, for Robin Kerner. A shout out to our communications director who made this so possible, and I'm paying homage to your home country.
I used to be bloody limey.
I'm really a Yankee, but I really have some respect for the British after the way we've treated the country recently. The taxpayer was not entitled to earned income credit with respect to children of taxpayer's friend, to whom taxpayer was not related by blood. Children's parents were living during year in issue. Children lived with their parents for all of that year. Records did not indicate that children were taxpayers' foster children, and because taxpayers' earned income exceeded 11,230, phase-out limitation prevented receipt of any earned income credit. O'Roy v. CIR, U.S. Tax Court, 2006, WL 1280887, unreported, Internal Revenue 3532. Taxpayer who lived with cohabitant, their daughter, and cohabitant's mother in latter's home, was not entitled to earn income credit, even though taxpayer satisfied statutory requirements necessary to qualify as eligible individual, and child satisfied requirements for qualifying child, because cohabitant's mother had higher adjusted gross income than taxpayer did. She was treated as the only eligible individual with respect to child. Lear v. CIR, U.S. Tax Court, 2004, WL 2504392, unreported, Internal Revenue 3532. Now let me tell you, you have never really read the tax code until you've tried to read it in a British accent. This is absolutely insane. Although school records reflected that the child lived at mother's residence, father was entitled to earn income tax credit for his child who was under age of 19, since he credibly testified that, due to volatility in neighborhoods surrounding mother's residence, child lived with father for at least 9 months during taxable year. Coates v. CIR, U.S. Tax Court, 2003, WL 12333020, unreported, Internal Revenue 3532. You also realize just how close British is to Bostonian, because I've had a hard time keeping away from one and for the other. Retroactive amendment to Earned Income Tax Credit, EITC, permitting only person and family unit with highest modified AGI, adjusted gross income, to take EITC, did not violate due process, since it served primarily as clarification to existing law. I feel like I've read this before, as opposed to a change of existing law, and thus amendment was a curative measure that did not impose new tax liabilities or alter substantive rights of taxpayers. Congressional purpose was rationally related to legitimate governmental purpose of ensuring that only the most needy individuals received EITC. Sutherland v. CIR, U.S. Tax Court, 2001, WL 46996, unreported. Constitutional Law 4149, Internal Revenue 3521. 6. Income. Even if taxpayers were eligible taxpayers and had 2 or more qualifying children, they would not be entitled to earned income credit because their adjusted gross income exceeded $37,263. Richmond v. CIR, U.S. Tax Court, 2009, WL 2923824, unreported, Internal Revenue 3532. Taxpayer without qualifying child was not entitled to earned income tax credit, though he satisfied statutory eligibility requirements as to principal place of abode, age, and non-dependent status, where taxpayers' adjusted gross income exceeded ceiling established for claiming of credit. Arians v. CIR, U.S. Tax Code, U.S. Tax Court, 2009, WL 1324022, unreported, Internal Revenue 3532. Taxpayer was not entitled to earned income credit for 1999 or 2000, where his earned income and adjusted gross income exceeded statutory limit for such credit. Major v. CIR, U.S. Tax Court 2005, WL 2078507, unreported, affirmed. 236, Fed, approximately 268, 2007, WL 1544696. Certiorari denied. 128, S Court 402 552, U.S. 951 169, L Ed 2D 265, Internal Revenue 3532. An increase in the taxpayer's modified adjustment of gross income by inclusion of her gambling winnings decreased her earned income tax credit. Petty v. CIR, U.S. Tax Court 2004-2004, WL 1354117, unreported, Internal Revenue 3532. Taxpayer was not entitled to earned income credit, absent establishing he had earned income. Taxpayer's evidence tending to show he received wages for services was outweighed by inconsistencies in witness testimony, failure to produce payer as witness, or corroborating evidence establishing existence of payer, and lack of evidence of services performed by taxpayer. Wouldn't it be great right now if the wind just blew away the tax code? That would work.
Not in our copy. There.
Tax code doesn't count if it makes it off the table.
Agreed. Taxpayer was not eligible to claim earned income tax credit since his income exceeded the phase-out amount provided for credit. Fiegel v. CIR, U.S. Tax Court 2000, WL 387658, unreported, Internal Revenue 3532. This next segment, 7, dedicated to Jason Casella and Guillermo Jimenez for making sure that this tax code reading was well covered and went awesomely viral on social media. Items constituting earned income. Military quarters and subsistence allowances are earned income for purposes of the earned income tax credit, as such allowances constitute compensation for military services. NEF v. US, Fed CL 1999 43, Fed CL 659, Internal Revenue 3158, Internal Revenue 3532. Inaction by former wife seeking construction of and recovery of money allegedly due under agreement incident to divorce. Trial court properly defined earned income to include salary and other income for purposes of provision under which former husband was to pay former wife 40% of his earned income as defined by this section. Dean v. Dean, Tex Amarillo, 1982, 631 SW 2D 215. Divorce 928. All wages that taxpayer received while inmate at penal institution were excluded from computation of earned income credit, regardless of whether she performed her services at location, outside penal institution, and regardless of whether her performance of services was voluntary or compulsory. Rogers v. CIR. So even if you're forced to do it, you're still going to pay taxes on it.
VCR?
Rogers v. CIR, U.S. Tax Court 2004-2004, WL 2397143, unreported, Internal Revenue 3532. 8. Marriage. There's the tax code, getting in the bedroom again. Taxpayer could not claim earned income credit, EIC, as she was married. She did not file joint return, and she did not satisfy requirements to be treated as unmarried. So, Tony v. CIR, U.S. Tax Court 2004-2004, WL 1559198, unreported, Internal Revenue 3532. Married individual is not entitled to earned income tax credit, EITC, since he was married and did not file joint return. Taxpayer was not considered as unmarried since he and his estranged wife lived in the same residence with their children. Chiosi v. CIR, U.S. Tax Court 2000, WL 349749, unreported, Internal Revenue 3532. 9. Principal place of abode. Taxpayer was not entitled to earned income credit. Taxpayer and his wife did not file joint return. Taxpayer was not entitled to dependency exemption deduction for his son, and son's principal place of abode was with his mother rather than with taxpayer. Anderson via CIR, U.S. Tax Court 2008-2008, WL 465200, unreported, Internal Revenue 3532. It was reasonable to assume that taxpayer confined in jail after arrest but before conviction would return to her household and her 2 children after temporary confinement, and thus period of pre-conviction confinement counted toward taxpayers' time in same principal place of abode with their children for purposes of earned income credit, EIC. Taxpayer's criminal case was still pending, and there were no indications the taxpayer intended to choose a new home. Roe v. CIR, U.S. Tax Code 2007, 128 TC 13, 2007, WL 549500, unreported Internal Revenue 3532. Taxpayer who is confined in jail after arrest but before conviction is necessarily, but non-permanently, absent from his or her home. Thus, time spent in that status counts toward taxpayer's time in same principal place of abode with taxpayer's children for purposes of earned income credit if it is reasonable to assume taxpayer will return to household. Tax Court 2007, 128 TC 13, 2007, WL 549500, unreported Internal Revenue 3532. 10. Qualifying children. This is dedicated to all of the media outlets, Liberty Conservative, Fee, Washington Examiner, several of you out there, Eric McCool who came by, and the attorney at law who came by a little bit earlier. This is dedicated to all of you for making the absurdity of the tax code a reality on tax day. Qualifying children. Taxpayer's physically and mentally disabled aunt, for whom taxpayer had been appointed guardian and for whom taxpayer provided constant and demanding care, was not a qualifying child of the taxpayer, as would have allowed taxpayer to claim earned income credit on her federal tax return. Aunt was not a lineal descendant or stepchild and had not been adjudicated a foster child. Jarman v. IRS, EDNC 2006, 459, F Supplemental 2D 433, Internal Revenue 3534. Taxpayer's sister satisfied age requirement for qualifying child, as required for taxpayer to claim earned income tax credit for sister. Although sister was 54 years old, where sister was permanently and totally disabled from various ailments including congestive heart failure. Bobo v. CIR, U.S. Tax Code 2010, WL 2195278, unreported Internal Revenue 3532. Taxpayer's nephew and niece were his qualifying children for purposes of the earned income tax credit for one of 2 years at issue. There goes a paper. With respect to first year, it was not improbable that taxpayer lived with his sister and her children contrary to terms of her leases, and it was likely that after death of children's father, taxpayer assumed paternal role toward his nephews and his niece, as well as making payments toward their support. But with respect to the second year, there was other evidence suggesting a taxpayer maintained an address separate from his sister's. Scott v. CIR, U.S. Tax Code 2009, WL 2950609, unreported Internal Revenue 3532. Because taxpayer's minor nieces with whom taxpayer resided were qualified children, taxpayer was entitled to earning income credit. Pavia v. CIR, U.S. Tax Code 2008, WL 5100856, unreported Internal Revenue 3532. Statute under which defendant was convicted for aiding and assisting in the preparation of fraudulent tax returns, that's a bad man right there, was not unconstitutionally vague in terms of defining foster children whose foster parents were eligible for tax benefits. Term, quote, authorized placement agency, meant a state agency or one of its subdivisions, or a tax-exempt child placement agency licensed by the state, and plain meaning of the statute would not include within its definition of an eligible foster child a taxpayer's fiance, boyfriend, girlfriend, roommate, siblings, parents, or grandparents, each of which were claimed as foster children on the tax returns prepared by the defendant. U.S. v. Gina CA4 SC 2007 258 Fed APPX 592 2007 WL 4426644 unreported post-conviction relief denied 2009 WL 5031311 Constitutional Law 1133 Internal Revenue 3532. Male taxpayer could not claim earned income credit based on children of his live-in female companion, regardless of amount of support taxpayer provided to children, where children were not taxpayer's children, stepchildren, descendants, nieces or nephews, or foster children. Nobles v. CIR. U.S. Tax Court 2007-2007, WL 2687617, unreported Internal Revenue 3532. I think the next event is going to be a tax code burning. Taxpayer who was father of one minor child was not entitled to one qualifying child earned income tax credit outside of taxpayer's self-serving testimony. There was no showing that child had same principal place of abode as taxpayer for more than 1/2 year in question. Baker v. CIR, U.S. Tax Court 2006-2006, WL 8000764, unreported Internal Revenue 3532. Taxpayer was not eligible for earned income tax credit since her sons did not share her principal place of abode at any time during taxable year and thus were not qualifying children for purposes of EITC. Linton v. CIR, U.S. Tax Court 2003-2003, WL 212-54884, unreported Internal Revenue 3532. Taxpayer was not eligible for earned income tax credit since her sons did not share a principal place of abode at any time during taxable year and thus were not qualifying children for purposes of EITC. Linton v. CIR, U.S. Tax Court 2003-2003, WL 212-54884, unreported Internal Revenue 3532. Taxpayer was not entitled to earned income credit for foster child since child did not have same principal place of abode as taxpayer for taxpayer's entire taxable year. Dickerson v. CIR, U.S. Tax Court 2001-2001, WL 233961, unreported Internal Revenue 3532. Taxpayer could not treat any of his 3 children as qualifying children for purposes of EITC, since no children had same principal place of abode as taxpayer for more than 1/2 the taxable year. Hughes v. CIR, U.S. Tax Court 2000-2000, WL 424230, unreported Internal Revenue 3532. Now, 11. This section is dedicated to all of you on the live stream who commented, made us sing parts of the code, and to fulfill one unfulfilled request, which was to do it in a Batman voice. Refund or reduction of taxes. Earned income tax credit, EITC, is constructive overpayment of tax. Since Internal Revenue Code explicitly characterizes amounts of fundable by operation of EITC as overpayments of taxes, refund amounts generated by EITC are deemed overpayment, since such credit is refundable, even if taxpayer had no tax liability. Israel v. U.S. CA2, Connecticut, 2004, 356, 5, 3D, 221, Internal Revenue 3532. Taxpayer can receive amount by which his entitlement to an earned income tax credit exceeds his tax liability, since that amount is defined as an overpayment, and thus refundability of earned income credit is inseparable from its classification as an overpayment of tax. Harriman v. IRS, ED New York, 2002, 233, F, supplemental, 2D, 451, reconsideration denied, 2003, WL 1950254, Internal Revenue 4957. Earned income credit does not constitute a refund or reduction of Social Security tax. In Searles, DC, Connecticut, 1978, 445 F, supplemental 749, Internal Revenue 3532. Section 33. Tax withheld at source on non-resident aliens and foreign corporations. As we both know, they're the same thing. There shall be allowed as a credit against the tax imposed by this subtitle the amount of tax withheld at source under subchapter A of Chapter 3, related to withholding of tax on non-resident aliens and on foreign corporations. 34. This is dedicated to the tax code. Certain uses of gasoline and special fuels. A. General rule. There shall be allowed as a credit against the tax imposed by this subtitle for the taxable year an amount equal to the sum of the amounts payable to the taxpayer. 1. Under Section 6420 to determine without regard to Section 6420G. 2. Under Section 6421, determine without regard to Section 6421 I. And 3. Under Section 6427, determined without regard to Section 6427K. B. Exception. Credit shall not be allowed under subsection A for any amount payable under subsection 6421 or 6427. If a claim for such amount is timely filed and under section 642I or 6427K is payable under such section. Now make sure you don't get your 642s mixed up. That could be real bad. Notes of decisions. 1. Prior law. Under prior version of Internal Revenue Code IRC statutes, one claim limitation for refunds of diesel fuel taxes applied to claims for such tax credits. Western Company of North America, VUS, CA, Fed 2003, 333, F3D, 1024, Internal Revenue 3520. 2. Construction with other laws. One claim rule limiting ultimate purchasers of diesel fuel to filing one claim per taxable year. For refund of tax paid on fuel used in vehicles for certain non-taxable uses. Also applies to claims for income tax credit for diesel fuel, used for non-taxable purposes. Western Company of North America, V. U.S. Fed, CL 2002, 52 Fed, CL 51, infirmed in part, reversed in part, 323, F3D, 1024. Internal Revenue 3520. Taxpayer filed claim for excise taxes paid on diesel fuel used for non-taxable purpose was not barred by one claim rule of refund statute from obtaining a credit under statute affording income tax credit for taxes paid on fuels used for non-taxable purposes. So question, if we dump gasoline in the tax code and burn it, was that a taxable purpose or a non-taxable purpose? For amounts of taxes overpaid but not recovered under this refund claim, Schlumberger Technology Corp. And subsidiaries, VUS, Fed, CL, Core to the subsidiary, the 2047 Fed, CL 298, Internal Revenue 3520. Wow. Americans with Disabilities Act, ADA, did not apply to determinations of whether taxpayers that provided paratransit services for physically and mentally disabled were entitled to credit for gasoline taxes paid, as ADA was not taxing statute. Medical Transportation Management Corp. VCIR, U.S. Tax Court 2006, 127 TC 96, 2006, WL 2686851, unreported, affirmed, 506 F3D 1364, cert terrari denied, 2008 WL 2002061, Civil Rights 1021, Internal Revenue 3520. 3. Persons entitled to credit. This section is dedicated to my mom for being awesome. Even if vans that taxpayers used in providing paratransit services for physically and mentally disabled qualified as automobile buses, taxpayers were not entitled to federal income tax credit for gasoline taxes paid. Taxpayers' 4-passenger sedans were not automobile buses. And taxpayers failed to give accounting of how many gallons of gas to attribute to each type of vehicle for purposes of gasoline credit. Medical Transportation Management Corp. VCIR, U.S. Tax Court 2006, 127 TC 96, 2006 WI 2686851, unreported, affirmed, 506 F3D, 1364, certiorari denied, 2008 WL 2002-061, Internal Revenue 3520. 4. This one's dedicated to my dad for also being awesome, and my brothers for putting up with me, I think. 4. Paratransit services. Term, automobile bus, as used in federal tax statute, entitling taxpayers income tax credit for gasoline excise taxes paid on gasoline purchased for vehicles classified as automobile buses, referred simply to motor driven bus, or what would currently be understood simply as bus. Notwithstanding contention by taxpayers wishing to take credit for gasoline excise taxes paid on gasoline purchased for vans and sedans that were used in their paratransportation business, that such an interpretation rendered the word automobile superfluous. Medical Transportation Management Corp. V. Commissioner of IRS, CA 11-2007, 506 F3D, 1364, cert denied, 2008, WL 2002-061, Internal Revenue 3520. Paratransit services that taxpayer provided for physically and mentally disabled in sedans and vans that seated under 20 adults were not along, quote, regular routes. Thus, taxpayers were not entitled to federal income tax credit for gasoline taxes paid. Unlike typical local transit systems, there were no published timetables available to general public that sedans or vans were required to follow. And manifests had to be modified on a daily basis to accommodate all changes in needs of passengers using petitioner services, no matter whether they were regular subscribers or one-time reservation passengers. Medical Transportation Management Corps, VCIR, U.S. Tax Code 2006-127, TC 96, 2006, WL 268-6851, unreported, affirmed, 506, F3D 1364, search warrant denied, 2008, WL 2002061, Internal Revenue 3520. Section 35. This shout out goes out to Ford Fisher and the companies who developed his cameras and tripods and the light glaring right in my face for filming this ridiculous event.
Sony, Panasonic, and Neewer.
And who?
Neewer made the light.
Doesn't matter. Sony and Panasonic, you get a shout out. Section 35. Health insurance costs of eligible individuals. In general, in the case of an individual, there shall be allowed as a credit against the tax imposed by Subtitle A an amount equal to 65%, 80% in the case of eligible coverage, months beginning before January 1st, 2011, of the amount paid by taxpayer for coverage of the taxpayer and qualified family members under qualifying health insurance for eligible coverage, months beginning in the taxable year. B. Eligible coverage month. For purposes of this section, 1. In general, the term eligible coverage month means any month if A. On the first day of such month, the taxpayer, 1. is an eligible individual, 2. is covered by qualified health insurance, the premium of which is paid for by the taxpayer, 3. does not have other specified coverage, and 4. is not imprisoned under federal, state, or local authority. And B. Such month begins more than 90 days after the date of the enactment of the Trade Act of 2002. 2. Joint returns. In case of a joint return, which is usually what happens when you return the cartilage behind your knees, the requirements of paragraph 1A shall be treated as met with respect to any month if at least one spouse satisfies such requirements. C. Eligible individual. For purposes of this section, in general, you are a 100% qualified, no money down, zero interest for 12 months, eligible individual if A. You're an eligible TAA recipient, B. An eligible TAA recipient, and C. An alternative TAA recipient, and C. An eligible PBGC pension recipient. So you have no idea what those acronyms mean, and they're not explained here. 2. Eligible TAA recipient. In general, exceptions provided in subparagraph B, the term eligible TAA recipient means, with respect to any month, any individual is receiving for any day of such month a trade readjustment allowance under Chapter 2 of Title 2 of the Trade Act of 1974, or who would be eligible to receive such allowance if Section 231 of such act were applied without regard to subsection A, 3, B of such section. An individual shall continue to be treated as an eligible TAA recipient during the first month that such individual would otherwise cease to be an eligible TAA recipient by reason of the preceding sentence. B. Special rule. In the case of any eligible coverage, month beginning after the date of the enactment of this paragraph and before January 1st, 2011, the term eligible TAA recipient means, with respect to any month, any individual who 1. is receiving for any day of such month a trade readjustment allowance under Chapter 2 of Title 2 of the Trade Act of 1974. 2. would be eligible to receive such allowance except that such individual is in a break-in training provided under a training program approved under Section 236 of such act that exceeds the period specified in Section 233E of such act, but is within the period for receiving such allowances provided under Section 233A of such act. 3. Is receiving unemployment compensation as defined in Section 85B. for any day of such month, and who would be eligible to receive such allowance for such month if Section 231 of such act were applied without regard to subsections A, 3B, and A5 thereof. An individual shall continue to be treated as an eligible TAA recipient during the first month that such individual would otherwise be an eligible TAA recipient by reason of the preceding sentence. 3. Eligible alternative TAA recipient. The term eligible alternative TAA recipient means, without respect to any month, any individual who A is a worker described in section 246A3B of the Trade Act of 1974 who is participating in the program established under section 246A1 of such act, and B is receiving a benefit for such month under section 246A2 of such act. An individual shall continue to be treated as an eligible alternative TAA recipient during the first month that such individual would otherwise receive to be an eligible alternative recipient by reason of the preceding sentence. 4. Eligible PBGC pension recipient. The term eligible PBGC pension recipient means, with respect to any month, any individual who A has attained at age 55 on the first day of such month, and B is receiving a benefit for such month, any portion of which is paid by the Pension Benefit Guarantee Corporation under Title IV of the Employee Retirement Income Security Act of 1974. D. Qualifying family member. For the purpose of this section, 1 in general, the term qualifying family member means A, the taxpayer's spouse, and B, the dependent of any dependent of the taxpayer with respect to whom the taxpayer is entitled to a deduction under section 151C. Such term does not include any individual who has other specified coverage. 2. Special dependency test in case of divorced parents, etc. If section 152E applies to any child with respect to any calendar year, in the case of any taxable year beginning in such calendar year, such child shall be treated as described in paragraph 1B with respect to the custodial parent as defined in section 152E4A and not with respect to the non-custodial parent. E. Qualified health insurance. In general, the term qualified health insurance means any of the following. Coverage. Hey, coverage under a COBRA. I'm good with that. I like COBRAs. Continuation provision, as defined in section 9832D1. B. State-based continuation coverage, provided by the state under a state law that requires such coverage. C. Coverage under a health insurance program offered for state employees. F. Coverage through an arrangement entered into by a state. And I. A group health plan, including such plan as, let's see, come on. Including such plan, which is a multi-employer plan as defined in section 337 of the Employee Retirement Income Security Act of 1974.
Give me the book. Give me the book. Give me the book.
Why?
Because it's 8:42.
Yes, it is.
Give you about 10 minutes to.
I'm good. I'm good. Let me go.
You're gonna wrap it up?
Yes. I need to shoot off. I need to shoot off a link to a very important person, and then once I shoot off said link to very important person, I'll finish the tax code. Not really, but I'll finish. Finish the beginning. This is just the beginning.
Do please mention that if anybody thinks that they're going to fix this problem so that we can file our taxes on a postcard by putting band-aids on this pile of crap here, they're lying to themselves and they're lying to you.
Coverage offered through a state arrangement with a private sector healthcare coverage purchasing pool. H. Coverage under a state-operated health plan that does not receive any federal financial participation. I. coverage under a group health plan that is available through the employment of the eligible individual's spouse. J. In the case of any eligible individual and such individual's qualifying family members, coverage under individual health insurance if the eligible individual was covered under individual health insurance. This sounds like when you tried to get your health insurance, Brandon.
We'll never speak of that.
During the entire 30-day period that ends on the date that such individual became separated from the employment which qualified such individual for I. In the case of an eligible TAA recipient, the allowance described in subsection C2. II. In the case of an eligible alternative TAA recipient, the benefit described in subsection C3B. Or III. In the case of any eligible PBGC pension recipient, the benefit described in subsection C4B. For purposes of this subparagraph, the term individual health insurance means any insurance which constitutes medical care afforded to individuals other than in connection with a group health plan, does not include federal or state-based health insurance coverage. K. In the case of eligible coverage months beginning before January 1st, 2011, coverage under an employee benefit plan funded by a voluntary employees beneficiary association as defined in section 501c9, established pursuant with an order of a bankruptcy court or by agreement with an authorized representative as provided in section 1114 of Title 11 USC. 2. Requirements for state-based coverage. In general, the term qualified health insurance does not include any coverage described in subparagraphs B through H of paragraph 1, unless the state involved has elected to have such coverage treated as qualified health insurance under this section, and such coverage meets the following requirements. I. Guaranteed issue. Each qualifying individual is guaranteed enrollment if the individual pays the premium for enrollment or provides a qualified health insurance cost credit eligibility certificate described in section 7527 and pays the remainder of such premium. I. No imposition of pre-existing condition exclusion. No pre-existing condition limitations are imposed with respect to any qualifying individual. 3. Or III. Non-discriminatory premium. The total premium as determined without regards to any subsidies with respect to a qualifying individual may not be greater than the total premium as so determined for a similarly situated individual who is not a qualifying individual. 4. Or IV. Same benefits. Benefits under the coverage are the same as, or substantially similar to, the benefits provided to similarly situated individuals who are not qualifying individuals. B. Qualifying individual. For the purposes of this paragraph, unlike the other 5,000 we've read, the term qualifying individual means I. An eligible individual for whom, as of the date on which the individual seeks to enroll in the coverage described in subparagraphs B through H of paragraph 1, the aggregate of the periods of creditable coverage as defined in section 9801C is 3 months or longer, and who, with respect to any month, meets the requirements of clauses 3 and 4 of subsection B1A, and II, the qualifying family members of such eligible individual. 3. Exception. The term qualified health insurance shall not include A. A flexible spending or similar arrangement, and B. Any insurance if substantially all of its coverage is of expected benefits described in section 9832C. F. Other specified coverage. For purposes of this section, an individual has other specified coverage for any month if, as of the first day of such month, 1. Subsidized coverage, A in general. By the way, it's freezing out here now. Such individual is covered under any insurance, which constitutes medical care, except insurance substantially all of the coverage of which is accepted benefits described in section 9832C under any health plan maintained by any employer or former employer of the taxpayer or the taxpayer's spouse, and at least 50% of the cost of such coverage determined under section 4980B is paid or incurred by the employer. B. Eligible alternative TAA recipients. In the case of an eligible alternative TAA recipient, such individual is either I. Eligible for coverage under any qualified health insurance other than insurance described in subparagraph A, B, or F of subsection E1, under which at least 50% of the cost of coverage determined under section 4980B F4 is paid or incurred by an employer or former employer of the taxpayer or the taxpayer's spouse, or I, covered under any such qualified health insurance under which any portion of the cost of coverage, as so determined, is paid or incurred by an employer or former employer of the taxpayer or taxpayer's spouse. C. Treatment of cafeteria plans. For purposes of subparagraphs A and B, the cost of coverage shall be treated as paid or incurred by an employer to the extent the coverage is in lieu of a right to receive cash or other qualified benefits under a cafeteria plan, as defined in section 125D. 2. Coverage under Medicare, Medicaid, or SHIP. Such individual A is entitled to benefits under Part A of Title XVIII of the Social Security Act, or is enrolled under Part B of such title, or B is enrolled in the program under Title XIX or XXI of such act, other than under Section 1928 of such act. 3. Certain other coverage. Such individual A is enrolled in a health benefits plan under Chapter 89 of Title V United States Code, or B is entitled to receive benefits under Chapter 55 of Title 10 United States Code. G. Special rules. 1. Coordination with advance payments of credit. With respect to any taxable year, the amount which would, but for this subsection, be allowed as a credit to the taxpayer under subsection A, shall be reduced, but not below zero, by the aggregate amount paid on behalf of such taxpayer under section 7527 for months beginning in such taxable year. 2. Coordination with other deductions. Amounts taken into account under subsection A shall not be taken into account in determining any deduction allowed under section 162, lowercase italic L, or 213. 3. Medical and health savings accounts. Amounts distributed from an Archer MSA, as defined in section 220D, or from a health savings account as defined in section 223D, shall not be taken into account under subsection A. 4. Denial of credit to dependents. No credit shall be allowed under this section to any individual with respect to whom a deduction under section 151 is allowable to another taxpayer for a taxable year, beginning in the calendar year in which such individual's taxable year begins. 5. Both spouses eligible individuals. The spouse of the taxpayer shall not be treated as a qualifying family member for purposes of subsection A if A. The taxpayer is married at the close of the taxable year. B. The taxpayer and the taxpayer's spouse are both eligible individuals during the taxable year. And C. The taxpayer files a separate return for the taxable year. 6. Marital status. Certain married individuals living apart. Rules similar to the rules of paragraphs 3 and 4 of section 21E shall apply for purposes of this section. 7. Insurance which covers other individuals. For purposes of this section, rules similar to the rules of section 213D6 shall apply with respect to any contract for qualified health insurance under which amounts are payable for coverage of an individual other than the taxpayer or qualifying family members. 8. Treatment of payments. For purposes of this section, A. Payments by Secretary. Payments made by the Secretary on behalf of any individual under section 7527 relating to advance payment of credit for health insurance costs of eligible individuals shall be treated as having been made by the taxpayer on the first day of the month for which such payment was made. B. Payments by taxpayer. Payments made by the taxpayer for eligible coverage months shall be treated as having been made by the taxpayer on the first day of the month for which such payment was made. Here's the COBRAs again. 9. COBRA premium assistance. In the case of an assistance eligible individual who receives premium reduction for COBRA continuation coverage under section 3001A of Title III, Division B of American Recovery and Reinvestment Act 2009, for any month during the taxable year, such individual shall not be treated as an eligible individual, certified individual, or a qualifying family member for purposes of this section, nor will they be rescued by G.I. Joe as they've signed up for the Cobra health insurance plan, not the G.I. Joe health insurance plan. 10. Continue qualifications of family members after certain events. In the case of eligible coverage months beginning before January 1st, 2011, A. Medicare eligibility. In the case of any month, did we lose the camera? Oh. In the case of any month, which would be an eligible month, coverage month with respect to an eligible individual, but for section F2A, I feel like the camera went down lower for some reason. Okay, okay. Such month shall be treated as an eligible coverage month with respect to such eligible individual solely for purposes of determining the amount of the credit under this section with respect to any qualifying family members of such individual and any advance payment of such credit under section 7527. This subparagraph shall only apply with respect to the first 24 months after such eligible individual is first entitled to the benefits described in subsection F2A. B. Divorce. We're getting to the good parts. In the case of the finalization of a divorce between an eligible individual and such individual's spouse, such spouse shall be treated as an eligible individual for purposes of this section.
So at 5 minutes left until 9
We're doing an intervention.
No. I'm almost to death. We've been talking about taxes. I'm almost to death.
Literally to death.
Yeah. Yes.
So
I'm in divorce. We're getting to death.
Death,
I'm in divorce.
Taxes.
Well, you gotta say death for next time.
Section 7527 for a period of 24 months.
Folks, will not stop.
Beginning with the data, so it's like crack. Once you have some, not that I'm admitting to anything.
Stop it, Dad.
Except
this is an intervention.
Except that the
you
only
have to tell the audience why you did this.
Except that the only qualifying family members who may be taken into account with respect to such spouse are those individuals who are qualifying family members immediately before such finalization. And C, in case of the death of an eligible individual. Nobody cares because we're probably all going to die anyway, and it doesn't matter. Okay.
Let them know what they can find.
All right.
So tell us why you did this, how the people who watch this entire live stream can find help.
I need to find help first before I am qualified to tell other people how to find help.
And then the EMTs are here for you.
Okay. All right. We just spent right around 12 hours in shifts after arguing with the IRS and a random angry citizen who doesn't like life tried to shut us down. Had to hold the canopy to keep the wind from blowing away. Ran through 4 battery packs and had to get a generator in order to keep this thing going. Carried on into the night. In the morning, it was somewhat chilly. In the afternoon, it was 70, 80 degrees, and now it's so cold that my hands are starting to freeze again. With the tax code next to us, the live stream went down 4 or 5 times. Why did we do this? Why? Why does it matter? Yeah, get behind me. Why does it matter? Why did we take so long to look at this absurd tax code? Because we want people to understand that this tax code is not going to be reformed. It's not going to be tinkered on the edges. It's not going to have a little band-aid put somewhere. And when in Congress they're talking about tax reform this year, they're selling people that most Americans will be able to fill out their taxes on a postcard. And they haven't talked at all about what they're going to do about the 70,000 pages of U.S. tax code. How are they going to make that simpler? How are they going to bring average Americans to the point where they can understand the code? You see, anyone who thinks that we're going to fix the tax code instantly, or fix the tax code without basically setting it on fire and clearing it out and starting from the beginning, they're lying to themselves and they're lying to you. And I hope as you've watched this live stream, you've begun to see how much of an absolute abomination this thing is. So before we go, I want to mention a couple of things. Why is it this way? Well, it's very simple. 50% on around 50% is the per capita income. That between the federal, local, and state governments, plus a $1 trillion in compliance costs every year for Americans with this code, costs the average American, or the per capita income for Americans, 50.71% of our income. Well, when you take, life is complicated. There's a lot of different things in life. When you take 50% of life and you put it inside this tax code here, it's going to be complicated. Well, how does it become complicated? Very simple. Politician passes a new tax. The people being taxed don't want to be taxed like that, so they hire tax lawyers. The tax lawyers create themselves a loophole, create themselves a special exemption, and then the IRS says, well, we don't want any more special exemptions, and they make it more complicated too. And then Congress writes more tax laws. They imposes more taxes, and the cycle continues. Until we recognize that we have to take more of life out of taxes and out of the tax code, this tax code will never be uncomplicated. And this abomination, this absurdity that Americans everywhere, every year have to deal with, that business owners sometimes spend hundreds of hours filling out a simple tax form. It's 130 something pages.
They're afraid of these people in this building. They're jackbooted thugs. It is tyranny. It is the definition of tyranny.
If this isn't the definition of tyranny,
I don't know what is.
I don't know what is.
Y'all are afraid to even talk to people about what's in this book, this whole stack of books, because you're afraid of these people. What did Jefferson say about it? When the government fears the people, you have liberty. When the people fear the government, you have tyranny. This is tyranny, people. Haven't you had enough? We don't need tax reform. We need a tax revolution, and we need it now. Thank you.
Thanks for sticking with us. Y'all have a great night. We are this is Dan Johnson, Tax Revolution Institute, officially signing off after what was probably the most interesting 12 hours I have ever spent in DC.
Do you have a way to formally cut the live stream?
Yes. Yeah.
But for now, we're super slow.
Let's not lose our place.
Put the tax code on
We'll
the
know
seat
what place it
until
is. We'll look at the end of the live stream. We'll be able to tell. Okay, I need to get past this cord. There we go. All right.
It's off.